tension between kind of the New Keynesian approach and what the macro labor people have been thinking about. And so I want to do that by focusing on another flow that Aysegul alluded to, but I want to flush it out a little bit more. How much churn in the labor market is occurring among the unemployed relative to how much churn is coming from unemployment into employment. And so during this recent period, we see that the E to E flows, the amount of churn in the labor market among workers, was at, again, in JOLTS data, I don't want to use the word all-time high here. I could go back further in the CPS, and it is among all-time high periods in the data this period. And so you could see like a 20% increase in E to E flows relative to the other peak periods over this time period. And I don't show it on this picture, but the U to E flow didn't move that much. It wasn't like we were drawing a lot of workers in on the margin from the unemployed into employment around this period. And so is there something in the information between the E to E flows relative to U to E flows that could potentially be important about underlying shocks that are hitting the economy, and then moreover, how those shocks might propagate through future wage and price pressure? And so that's what I'm going to try to talk a little bit about now. So what are some of the stories that people have put forth of why you're getting churn in the labor market relative to drawing people in on the margins? And I'm going to give you 3 stories. We could probably think of a couple more as well. One of which is there's sectoral productivity shifts. In particular, some sectors get more productive during this time period relative to other sector. People are going to migrate from the unproductive sectors to the productive sectors. That's going to have a flavor of a regular productivity shock that we would have in our model. You would get some wage increases and potential price increases coming from the fact that people are doing churn if some sectors are more productive than others. Aysegul, she didn't even mention it, has some separate work about amenity shifts in the labor market during this time period. Work from home, and if work from home is an amenity, that actually puts downward pressure on wages because people are going to be compensated in ways that are not monetary, and potentially downward pressure on inflationary prices, inflation going forward. So if the churn is coming from work from home, we might not be worried about future wage and price pressure. And then there's a third story, which I'm going to spend a little bit more time on the next slide, is that there's an inherent identification problem with inflation and vacancies per se, in the sense that the inflation itself could cause churn in the labor market. In models with nominal wage rigidities, when inflation comes, real wages fall, and then you might get workers resorting to try to escape their nominal wage rigidity. And the data during this period, and I'll kind of allude to some of it, kind of showed stories 2 and 3 might be more important than story 1 during this type of period. So let me just kind of mention that third story a little bit more in depth. This kind of stuff that I've been working on with Hassan Afrouzi and Andres Drenik and Andres Blanco in a paper we have called, A Theory of How Workers Keep Up with Inflation. It's a very literal title. But in that, it was really just what happens when you shock an economy with inflation in a general model of labor flows with nominal wage rigidities. And in that model, as I said before, real wages fall. Churn is going to occur in the labor market as people are going to try to escape their nominal wage rigidity. That's going to create an incentive for firms to post more vacancies. There's lots of workers churning. You're going to get vacancy durations going up as people are going to be wanting to find a job quicker, so the job finding rate's going to increase, the job filling rate is going to fall. You're going to see lots of patterns we have in the data that don't result from any other underlying labor market shock except the inflation itself. Now, we know the inflation is not exogenous. It was caused by stuff. But even in that narrow kind of component, in that partial equilibrium sense, that's where the identification comes from. And I'm going to show you that identification problem is going to be more severe in periods when we think aggregate supply shocks are going on. And so my second comment is going to be, can we use these labor market flows to potentially learn about the underlying labor market shocks in the economy? So this is a picture I show, and I'm going to flesh it out a little bit more in the next few slides. So this is the vacancy to unemployment rate in the United States going back to 1950. So up to 2000s, it is JOLTS data. Prior to 2000s, it is the help wanted ads, from the newspapers. And you will see that there are 8 spikes over the 1950 to 2024 period in the vacancy to unemployment rate. 4 of those spikes are going to look like traditional hot labor market, moving along a beverage curve kind of stories. During these periods, the unemployment rate was falling sharply as the vacancy rate was rising. During this period, nothing else was interesting was going on in inflation. It kind of looks like the story that when we want to put these vacancy and unemployment rates in our new Keynesian models, this kind of looks like what they're trying to capture during those periods. But there's 4 other periods. 1974, 1979, 1951, and the current pandemic period, where the vacancy to unemployment rate was at relatively high levels. The unemployment rate moved somewhat during this period, but not a huge amount during these down periods. But yet, the inflation rate was relatively high. And so what I'm going to do next is I'm just going to try to correlate in a very simple way whether shifts in Phillips curves, which we usually think occur when supply shocks are around, are correlated with shifts in beverage curves when the vacancy to unemployment rate is going up, holding the unemployment rate constant. Now, my Phillips curve I'm running here is not going to pass the new Keynesian test in any sort of way. I'm not or such. I'm just going to correlate the inflation rate on unemployment and unemployment squared. I want to get a little nonlinearity in there as well. I'm going to take the residuals from that regression. I'm going to do the same thing with the beverage curve. I'm going to take the vacancy to unemployment rate, run it on the unemployment rate and the unemployment rate squared, take the residuals of those regressions. And I'm going to ask the question, are those residuals correlated? And then the second question, can we get supply shock potentially aggregate supply shocks potentially driving some of that correlation? Here's the correlation in those residuals in the data. What you could see, again, on the x-axis, I'm doing this 2 periods. Again, my limited new Keynesian knowledge knows that there were periods when the Phillips curve was steep or something like that. So I'm breaking it into a 1950 to 1989 period and then a total period. It doesn't matter on the period. That's all I'm trying to convey here. And what you could see is the periods when the high Phillips curve residuals, or basically high inflation conditional on unemployment, are correlated with high vacancy to unemployment rates conditional on the unemployment rate. In those periods in the upper right quadrant of these graphs are all 1950, 1974, 1979, and this picture doesn't have, but if I included it through the pandemic periods would be in there as well. Now I'm going to do something, again, very simple. I'm going to ask if I project some measure of supply shocks, and again, a very naive measure of supply shocks, just oil price movements on as a potential driver of the inflation. Again, I'm going to driver is a strong word, correlate of the inflation, and ask if I isolate the variation in inflation that is coming from oil price movements. Do we still see this relationship? And the answer is yes. So what I'm basically showing you now is just the regression of those residuals on each other, where I instrument in the second column for the inflation with the oil price movements. And these numbers are kind of big. These are basically saying like a 10% movement in the inflation rate moves the vacancy to unemployment rate by about 0.2 percentage points, depending on the columns you're going through. The average vacancy to unemployment rate is about 0.65. So these are kind of big movements. I don't know, some economist. In the unemployment rate, in the vacancy to unemployment rate over time here. So there's some periods of time where the vacancy to unemployment rate might be picking up something else relative to our notion of
industrial production 0%, forecast at 0.1, manufacturing output negative
in my last few minutes is going to ask one last thing, and again, this will be relatively quick.
Forecast is negative 0.3.
So there's certain types of flows that might be informative of shocks.
India says
In
trade
particular,
discussions are progressing
EDE flows
well.
relative to UDE flows might be some moment we could look at to get a sense of the churn in the labor market by drawing new people in. The third comment is going to be, can we use other types of moments, and particularly the wage data itself, to help us learn about the underlying shocks? And again, this picture has been around now in our discourse among policy and academics for a little while, but in real time, it is something we might have looked at a little bit more. This is the real wages from the Atlanta Fed, just for the CPS data I just downloaded from the Atlanta Fed wage tracker index. The median wage in the United States, they had nominal, I just deflated by the CPI. Started in 2016, ran this forward. And what you could see is during this period of time, when the vacancy to unemployment rate was going up quite sharply, real wages were falling. And if you take a look at where real wages are today for the median worker, it is not too far where they were at the beginning of the inflation period. They fell and they've rebounded, but they're rebounding back to kind of the levels they were at the start of the inflation. And yet, real wages have a trend. And so relative to trend, we are still below trend. Now, maybe the trend changed, okay? But in that world, if there was something like a productivity shock that reduced the trend, that should have also had some downward pressure on wages. So using these wage metrics could help us a little bit to think about, in real time, what is the underlying shock? I'm going to show one more moment.
JPass spoke already but I think he's also on the panel.
Wages of those who are churning might actually rise.
He might speak again.
They didn't in this data. So this is, again, from the Atlanta Fed. I worry about the switcher data in the Atlanta Fed because they miss all the people who change houses at the same time they change job. The ADP data, which I have the micro data for that, you get slightly higher growth for the job changers, but still it's not like the job changers were getting a boom. It looks like the job changers were just relatively keeping up with inflation, where the job stayers were actually taking real wage declines. And this is my last one. The sectoral data also provides us some information of potential underlying shocks. The story of sector reallocation, you might see flows moving from one sector towards another sector in the data. Here, I'm again using a combination of JOLTS and the Atlanta Fed data. You could see there is variation across sectors. But the first thing that sticks out for me, every sector had massive increases in vacancies during this period, and every sector had real wage declines during this types of period. Consistent with the inflation itself eroding away the real wages and maybe potentially generating some churn in the data. I should mention that the real wage declines for the top of the wage distribution have been much greater than at the middle and the bottom. And again, if we think working from home is something that hits more the top of the wage distribution than the bottom, that could also potentially explain some of these patterns. And Aishigal has some work on that as well. Okay, so that's my comments. So, the labor market flows, I just want to echo what Aishigal was saying. The labor market flows can be informative of future inflationary periods. She focused on the U-star part. I'm saying, just in general, there's another moment, the churn in the labor market relative to among the EDE switchers relative to who we're drawing in on the margin could also be informative. Periods of aggregate supply shocks, which we all tend to think there was at least some component of an aggregate supply shock in this recent period, tend to be associated with both shifts in the Phillips curve and the shifts in the Beveridge curve. The real wage decline generates churn itself, and the labor market responds to that churn. And then the wage data and the other sectoral data could shed some light on some of these potential underlying mechanisms.
Build the gap?
Okay, that's it.
Might get rejected off of it at first.
Okay, so now we have 30 minutes for Q&A, and since this is the first Q&A session, I'm just going to lay out a few rules about how this is going to go. To make sure we hear from a wide range of people at the start, I'm only going to let people ask one question. If there's time at the end and no one is asking questions and you have a second one, we can come back to that. Also, I have a reminder that we're not going to be taking questions today from the esteemed members of the press who have joined us here. There are microphones in the room, so before you ask your question, Make sure that you've received a microphone. And although it doesn't say this in my instructions, I actually think it would be nice if you introduced yourself before you ask your question so we can all hear from who's asking the questions. I'm going to take 2 or 3 questions at a time, then give our presenters a chance to respond, and then I'll take some more questions. So with that, Larry, you've had your hand up already, Adriana, and Mark, why don't we take your question, and then we'll get to Joe after. So Adriana, you can go and then give.
Maximum employment is one of the most vacuous terms.
Ball rising following the VIX-piration is kind of interesting. Correlation's turning around pretty hard this morning. Leverage on the carries falling. Forward yield on vol is still really low, though.
You get away from that in a while. It has to be a zero slack concept. It has to be a zero slack. And of course, there are many of them, but we could look at many of them. We can't look at everything, but that's what we have to look at. So you get away from the maximum employment, fair enough, and get to that point. But it's very important. I won't win this battle. They'll always refer to maximum employment. The previous statement looked at minimum sustainable unemployment. Got it right?
Thank you. Adriana Kugler, Governor of the Federal Reserve Board. So congratulations on a great paper. There is a lot to like about it. I think something that was really helpful was how you really embrace all 3 definitions of U-star. The bottom-up approach with flows data, the NIRU, consistent with the stable prices, and the FERU, which is the full employment rate of unemployment by using the V2U as well and incorporating that. So lots to like. I had some concerns about how you move along with this, especially in terms of measurement. So in terms of measurement, I had 3 concerns. So it's one question, but 3 different measurement issues. So I'm sticking them all in. So first of all, your measure of inflation expectations is really reliant on the forward-looking nature of inflation expectations, but yet we know from recent literature, including the paper that will be presented next, including some of the literature that I cited in my speech at Princeton, that consumers and businesses really rely on recent experiences, right, to understand where the inflation expectations stand. So I'm just wondering how you would address that tension in the model, because you're relying on forward-looking inflation expectations, yet what we know from the recent literature is that what really counts is these short-term experiences and short-term inflation expectations in terms of forming inflation expectations even in the long run. The second issue that I was concerned with is the fact that you use CPI to measure inflation. And we know that, in particular, the CPI relies a lot on housing inflation, which has been incredibly persistent, and that would likely push up the U-star. And that takes me to the third issue, which is when you move to that second step of getting from the trend to U-star and from your flows data to measuring U-star, then you get something very, very odd, which is that we get a negative U-gap for the most recent period. Somehow you must be overestimating U-star. Something that you don't do when you get to that second step is actually to use the labor force participation flows. And so that concerns me, because you started the talk by saying how important these labor participation flows are, and yet you don't use them in that second step. So again, I'm worried about really biasing up your estimates of U-star, which in turn lead to this very odd result that you have a negative U-gap all throughout the past few years. So thank you.
Marco Del Negro, New York Fed. So great presentations and great discussion. I have one really quick question. So, Ashiko, when I look at the
Sold
picture
puts coming
of the
in
level
at
of
75,
unemployment that is consistent,
65, 70,
2%
bot
inflation,
calls at
my
80.
reading of that
Looks
picture,
like they're trying to
with
bounce
the
this.
gray line, was that level right now is about 6%, so that we have
Some
to
in the
bring
money
unemployment
calls
up to
closing
6%
35,
to achieve
45,
2% inflation.
55.
And the gist
Small
of Eric's
numbers still
presentation
though. Bot
was,
calls coming in at
as my
spot
reading,
58,
very
70.
different. In particular, the picture on the real wage suggests that the labor market and the real wages are still below trend, so the labor market is not that hot. And I
Out of
find
the
it
money
hard to
bot calls
reconcile the two
59.15,
stories. I wonder if you can help me. Thank you.
59.10.
Okay, yeah, let's turn to the panelists now.
Okay. First of all, Larry, in terms of maximum employment,
Now they may
I think
try
it's
to
a
push the
holistic, definition, and that's what I try to reflect. But
More
one thing I try
aggressively.
to do is how far you can go by just thinking about job loss and job finding that are main drivers of the unemployment rate, and I use unemployment as my aggregate proxy for those forces by showing that even though we tend to think of participation as additional slack, it doesn't necessarily have to be that way when we think about the cyclical pressures on it. And I think I totally agree with your statement, but one issue with declaring a full employment, unemployment.
This is a
level
seminar
is
for like
obviously
the
ongoing,
like
the ongoing
Fed
trends.
monetary
Again, a
policy
couple of,
changes.
Comments. First of all, we use short-term inflation expectations along with long-term inflation expectations as well, and they are the reason why we are seeing the U-star elevated. We have tried different measures of inflation. I think what the model is interpreting as the remaining persistent inflation is it's related to what we are seeing in the labor market. And one thing Eric showed is what happened to real wages, and you have seen that they actually started going up after this time period. And in terms of Marco's question, no, it doesn't mean that we have to increase unemployment to 6% because as I have shown, the future component, the determination that we will reduce inflation even if unemployment has to go up to 6% was behind the disinflationary
calls,
process.
60, 65,
so in that case,
70, some coming
when you
in
look
at
at when
80.
the inflation progress stalled,
There
it
was
was
a bit of
when those
profit taking on the
expectations
75
of
call, but still
hard
more puts
landing
being
actually
sold.
declined.
More
so
calls
that's
being
the
bought to the
connection
upside.
that I see. But
above
I've
the
shown you
gap.
that job fill rate, matching efficiency, those indicators are still looking different in the labor market, and our indicator is picking that up. But I want to emphasize that the 6% does not
50 and
really
90
mean
calls
that
being
we
bought.
need unemployment at 6% to see inflation at 2%. It's just a proxy measure that's telling us that there's a persistent component of inflation that's driven by what we are seeing in the
These
labor market.
options all have some interest.
I'm just going to say
long
one more
interest.
part to Marco's question. You know, when we see the real wages today, I show relative to trend, and it does look like there's a gap. But there's an implicit assumption in there of what is trend and where things are. That part I get a little bit more,
They're always
uncomfortable
separate,
with
for
in
now.
the sense maybe the trend had
We
fallen
will,
during this period.
we
So you
will
need a little bit more
aggregate them.
structure in order to do relative to trend stuff. Now, at the same point, there is a work from home component that might be an amenity that does show up in wages that could also be floating around, which does complicate that inference a little bit more. I just want to end back, though, to where we started, that, both shocks and future responses is going to be a function of supply and demands in Allmark. And so focusing only on the quantities without the price seems like we're throwing away information. And so I just want us to be thinking that the price also has some information in it as well. And it doesn't look like the labor market is overly hot by any sort of these measures. Now, the question of how far below trend we are, that, I need a little bit more structure with some assumptions in order to make that conclusion.
Joe Gagnon, Peterson Institute. My question for Aysegul is, have you considered, in your estimation of the U star that you use the linear New Keynesian Phillips curve, and have you considered something that's more nonlinear like we actually see in the data? I conjecture it would make a big difference in the following sense. You find a very high U star of around 8% in the late 70s, and I think that's because with your linear model, you need a big unemployment gap to explain why inflation pressures are so high. But if you were actually allowing for the fact that the curve is much steeper in that region, you wouldn't need such a big gap, and you'd actually get a more sensible U star. It would be lower than 8%. And conversely, after the Great Recession, you have to have a very small unemployment gap to explain why inflation is so stable. But in fact, if you allowed for the fact that the Phillips curve is much flatter there, you wouldn't need to force U to equal U star anymore, and you could actually allow
left
the
a
fact
gap at
that U star was
75.
much lower than U at that point.
Yeah, so I just wanted to ask a little bit more what the intuition and also sort of the data reasons behind the low match efficiency. And the reason I ask is, if I look at figure 15, it looks like there's a downward trend in the job filling rate. And this is putting a lot of demands on the data. But the source of that, if it relates back to sort of the willingness or duration of filling vacancies, and there's a trend in that behavior, that would change how we think about other things like
being bought,
a potential
8,
trend
20,
in
25,
ratio,
15.
the slope of the beverage curve, the number of structural components we're looking at in this paper and elsewhere.
Hi, Alp Simsek from Yale University. A great session. So I have a quick question for both Eric and Aysegul. I really like the mechanism Eric presented, that inflation induces people to leave their jobs to get higher wages. But if I think about that mechanism, I would expect it to show up in a higher quits rate. And while quits have increased in the recent cycle, Aysegul showed us a decomposition exercise that if you kept quits at historical rates, vacancy to unemployment ratio would be a little lower, but not much. So I was wondering if you could help us understand quantitatively how much the mechanism Eric described contributed to the vacancy to unemployment in the recent cycle.
First of all, I'm sympathetic to thinking about nonlinearities, changes in slope, or changes in indicators. But the reason why I prefer this approach is it gives me something that's called U star that I can relate to the secular trend of unemployment, and then I can actually look at mechanisms. For example, during the Great Recession, when we looked at the impact of mismatch unemployment or recruiting intensity, it was really picking up that disruption in the labor market, even though all around inflation remained pretty stable. So that's why I'm not thinking about nonlinearities. And as for the 70s, again, part of why we have seen very high inflation is the natural rate was severely underestimated to be at 4%, while demographic factors was already making 7% a pretty good goal in terms of reaching maximum employment. Low matching efficiency, I mean, obviously we have looked into the details of this, and this also relates to Alp's question. So from a simple decomposition perspective, the impact of separations was small.
Yes,
but
fell a little bit below VWAP.
Composition shifted towards quits, and quits left vacancies. And those are called replacement vacancies, and they became more important over time in the US economy. And replacement hiring is less efficient. You take your time to think about how to replace someone who left because they produce a certain good or service that you want to make sure you can fill in. So that's one of the reasons why we are seeing this decline in matching efficiency. And this is the link between turnover and job filling rate that we started to recently appreciate. Replacement hires and expansionary hires are very different. And the initial time period where people were looking for remote job opportunities or they were looking for jobs to reset wages created a big vacancy chain. And these vacancies were harder to fill, so they pushed up the stock of vacancies, even though they weren't really increasing employment. So there's a wedge between vacancies and employment growth that's accounted for by the rate that you can fill separating workers.
So more
and I
puts
think
sold at 60,
that's
55.
what's been happening here. And in terms of remote
Some
work
puts getting sold
opportunities,
at
as you
65,
know, this
70.
has stabilized about 2 years ago. So this inflationary
Still
force is
resistance
no
at
longer there.
75
Now, when you look
to
at
the upside, but
high
there's a
wage
gap
workers,
up
they are
here
back to the
also.
usual job letter considerations. So they are getting their wage increases because there is less to extract in terms of humanity. We are back to
80s
more
now
or less
positive
25-30% days worked remotely. Thank you.
I just wanted to add one thing to Alp's comment. The quit rate was at a historic highs as well, also by about 20%. So the quit rate and the vacancy rate tracked each other extremely closely over the cycle. And the quits weren't going to unemployment. It wasn't like we were seeing a huge amount of people quitting out of the labor force. So the quits in the churn are exactly the same phenomenon. And I love lots about the Icicle's paper. We got to take those counterfactuals a little bit with a grain of salt, because those are kind of definitional counterfactuals. They're not, you're holding one part fixed when everything else is the constant. If you run those through models, those things some of those things will co-move together for various reasons.
Great. Okay, more questions? Lou? Oh, Chris, sorry.
Hi, Lou Alexander, Rocos Capital. Thanks, this has been a great discussion. I'm thinking about a lot. One of the things I find remarkable, though, is you're talking about all of this and there's no discussion of the technology of how people go about doing these searches. If I just think about how much the world's changed over this period, how the fact that it's all online now, we used to have to use help wanted advertising. That's got to have some effect. And I've seen some research that suggests vacancies are easier to post now. So part of the reason they have sort of trended higher is it's just easier to have one. So I'm curious how you think about how that's changed over time, and does that have any effect on how you think about this? Thanks.
Yeah, just a couple comments on Eric's point. So first on the real wages, I mean, whenever you have a supply shock, you're going to have a fall in real wages. That's going to be true regardless of the model that you have. Second thing is using a kind of a spot market measure is maybe not the best way to think about people that are professional in that. They're not going to go out and immediately look for a new job or quit or anything. We may hope that because it's a long-term relationship, our wages come up later, which kind of is what you showed. And the last thing is on the shift in the beverage curves because of the supply shock. I mean, that was one of the things that Andrew Vergara and I were looking at.
Should get a little less
Joe's comment. When you're on a very steep portion
also,
of a non-linear
gamma at the 80 strike
beverage
has
curve,
moved positive.
and then you have some matching inefficiency that maybe shifts the curve up.
Easier to hit
when you're
that
on the
ramp
vertical
to the
part, it's
upside
not going to have much of a quantitative impact. That's exactly what Andrew and I did. We took the
as long as we can
plan
get
chart
like
and some
over
of the matching
77,
inefficiency, plugged it into ours, and
78.
basically it didn't really change the quantity effects because you're just on these vertical portions, and shifting up a curve when you're looking at the vertical portion doesn't really change the fundamental results.
On vacancies, I agree. There's a change in technology in terms of where vacancies were. In the Great Recession, actually, there was a shift. But I don't think there was a big change in technology of vacancies relative to 2019. But this speaks to the point that I was trying to reflect. If we want to think about a different measure in a Phillips curve framework, it's going to have its own natural rate. An economy with high turnover will have a high V over U to accommodate that. So we can't just get rid of this concept of the natural value of that indicator. A trend, such as you mentioned, would actually drive vacancy to unemployment ratio to a different level. But I don't think we have had enough changes relative to the pre-pandemic in terms of the technology. Even though if you go back, obviously there were changes. Thank you.
I'm just going to kind of echo one thing. The cyclical variation should be relatively robust to the trends. The long-term relationship, I think that is true. If my booth deans are listening, my real wage and my nominal wage chugged along at about 3% per year through the whole thing. My real wage, the whole contract had shifted down. And I do want to say when we see these E/E rates shift, we went from like something, 2.3% of us churning per month to something like 2.6 or 2.7% of us churning per month. So that's a big change. But 0.4 churning per month integrated over, a 25-month period, we're only getting the extra churn we're seeing in the population. There's only like 6 to 8% of us kind of going through. So there was some, even though many people are in these long-term relationships, there was some on the margin that actually turned a little bit more. I just want to make sure we keep the magnitudes, even though the percentage shifts are a lot, the actual amount of people that were doing these churns were modest in scope, even though they were big in percentage shifts.
What's up, Slot Machine?
Yes, Lorenzo Giorgiani from Tudor. One of the features of the pandemic recovery was the fiscal policy activism and the fact that because unemployed people were being made whole, the unemployment rate was not really, or any other labor market indicators were not capturing demand shortfall. How do you think about bringing in
Delta to flip
fiscal
back
policy
above Gamma
if it remains activist in the future?
What's this stream about? This is like the Fed,
the right
like monetary policy
it seems to me
conference.
They're focusing only on sort of measures of slack based on.
And so basically, they're discussing.
You want to define them.
They did one of these in 2020.
The fact that demand may still be strong.
But basically, they're discussing like the future path of the Fed's
Hi, Julia Coronado
mandate.
from macro policy perspective. So I don't have a particular question. I reiterate the concern about
So it's
upward
kind of
trends and
important.
vacancies.
I mean, it's
I
not
think
finalized.
Idea
It's
that there
just
was
a
sort of
discussion
level
about
shift
it,
in
but
the pandemic,
understanding
and since then, this is a perfectly
or having an
reasonable
idea of
conclusion.
where the Fed is looking to shift their mandate.
But I
This
just
could
want
be
to
an example
say
of
that I love this work. I love this work and the discussion. I think it's incredibly valuable to connect the mandates and think about the dynamics of the labor market in a way that can be measured in real time. This could be so, so valuable for Fed communication and understandable by the public. So congratulations on this work. I love it all, and I love this discussion, and I think this is really important advancement.
Any thoughts on UNH? I bought some leap puts on it yesterday.
Actually, feel free to weigh in as well.
Still some more room to the downside.
In terms of the three sources, the three sources of shocks, maybe like sexual productivity or amenity, changes in amenities or nominal rigidities. I was wondering if you don't also have to think about worker heterogeneity.
Kind of somewhere
so you showed heterogeneity across industries, but not everyone can work from home, for instance. And if I'm not mistaken, I think the real wage behave differently at the lower end of the skill distribution than higher skilled workers.
So it's dropped to about...
I'll start with Sylvain's question. It's true, and it's actually consistent with the fact that high-wage workers got increasing their job values through amenities. This allowed them to probably save some money, commute time, and there's a lot of evidence on that, spend more time with their families, also be able to move to areas where housing costs are smaller. So there is definitely job value increase for high-skilled workers, while for workers with lower educational attainment, since there was no that opportunity, there was higher wage increases. I think it's consistent with this mechanism. But now that reallocation is pretty much over, we are back to the good old job ladder, where job-to-job transitions create real wage increases. So that's consistent with this idea.
Yeah, going long is definitely dangerous.
Evaluated. In terms of fiscal policy considerations, I mean, one
I went short on the
one thing that
rejection
we always
yesterday
do is
because
we
it
always
looked
try
like
to
it looked
think
like there
about
was
what's
about
different
$30
this
more
time.
of downside room,
And when we
down to
talk
like
about entry and
282.
exit,
It's obviously printed far more than I expected, but
because we thought the dynamics would be different.
I do think it'll like
With
start
the
to run out of
exception of the
gamma, and there'll be
lockdown
some
curve, there was a
capitulation
way
to
of
the upside
exit
at
that
some
was
point, if
followed
nothing
with
else.
entry. The dynamics of participation looked the same.
Here's
Having
pushing
said that,
into
we
that
have
gap
seen
now.
real increases in reservation wages of especially for workers with lower education.
75
So we
becoming a little
see
bit more supportive.
fiscal policy affecting willingness
There's a
to
ramp
work
to the upside,
along that
some
dimension.
resistance at
But
90,
in terms of
95.
participation dynamics, at least the
That
forces that
probably
are
can fill the
driving
gap
it, things
before
look,
that.
things look very similar.
So,
And
just-
thank you, Julia. Of course.
I'll just, one thing on Savant's quick. There is heterogeneity across the wage distribution. Real wages at the bottom have now just kept up on trend. So if I show those gap kind of relative to, so even though nominal wages were higher, if you kind of put it in real wages and relative to trend, they're right back on trend. Relative to the top is not. And in models where we could calibrate with data, the bottom just churns more for some of the reasons we were just talking about. We're in long-term relationships, we don't
broke
churn
out
more.
above
And so that
5,900.
elasticity of when you have an inflation shock and you want to reallocate, it is much easier at the bottom where the long-term contracting is less, more spot market-like than it is at the top of the distribution. And that's exactly in our model, we match the distribution by just for exactly the same reason of the elasticities of different wage groups.
And if I may add, in terms of remote work as an amenity, its cost, its effect on productivity, the jury is still out there. We don't know if this was actually reducing the values that the firms were getting relative to what the workers are getting. So that's something
Careful
I think we
profit
will have to
taking
figure
can
out
pull
as
this
time
back a
passes,
little.
because it's
Support's
possible
back at 75.
that providing this amenity was also costly for the firms, and that triggered changes in productivity. So I think that's an open question that I think time will tell us.
Great. Okay, well, I think I'm going to let that be the last word. This was a great first session, so I think we should give a round of applause to our great presenters. And we're now going to have a half-hour break.
The 350 test on Tesla is probably a decent put entry, but I'd have to look at it. Risky to buy puts on support and a pullback. $338 right now. So it fell back below Gamma Max, but it's kind of starting to get support around 35 here. Next at 42. There's some decent support at 30, so maybe if it like retested Gamma Max and then failed, that might be a possible entry. But if it gets back up above like 4150, it's probably gonna retest the 50 level. Also, indexes are rising, so not necessarily the best time to get puts on it. Hmm. I need to do. One sec. Failure to fill the gap is a little bearish, by the way. One sec. Failure is kind of interesting. This bull's just capitulated. There's like another section of this meeting. Oh, EU's discussing, an EU trade chief is speaking right now, too. Business inventories are falling, but still a little bit elevated right now. After rising in Feb and March. Ticked down a little bit, and looks like they ticked down a little bit in April. Or maybe that's the year over year. Let me go look at the... So capacity 77.7, industrial production 1.5, manufacturing production fell to negative 0.4, which is not great. Manufacturing production year over year went up slightly. Business confidence, that's Brazil. Shit about that. Why is that fucking coming up? God damn it. Japan. Don't care about Russia. Savage. All right, so yeah, business inventories rose 0.1, falling from 0.2 in Feb. NAHB housing market index fell to 34 from 40. Ouch. Retail inventories rose from 0.1 to 0.4. So still some backlog in stock at least. We have a 4 and 8 week auction at 11:30, but nothing super crazy there. Continuing jobless claims rose earlier. Retail sales fell to negative 0.2. Fed employment. New orders rose. Fed prices paid rose. Okay. Manufacturing index fell. Yeah, none of the data this morning particularly great. None of it really bad either. Some recessionary data points. Rate cuts are what people want, though, right? No, I don't think anybody. And Trump wants rate cuts. The Treasury wants rate cuts. I don't think anyone else does. Oh, one sec. Just a phone call. I got an email saying it's going to take 90 business days for my student loan processor to review my IDR plan application. That's wild. It used to be like 1 to 2 days. That's because everyone's trying to keep themselves from getting their wages garnished. Nope.
Outlining our approach to achieving our congressionally assigned dual mandate. The framework laid out in that document broadly aligned with best practices for a flexible inflation targeting central bank.
Wait, is this a...
The structure of the economy evolves over time, and monetary policy
This is like second speech?
tools, and communications need to evolve with it. The challenges presented by the Great Depression differ from those of the Great Inflation.
Or are they just
and the Great
replaying his
Moderation,
first one during the
which
break?
in turn differ from the ones we face today. A framework should be robust to a broad range of conditions, but also needs to be updated periodically as the economy and our understanding
Any reason why GME is dropping so much today?
From 2012 to 2018, the FOMC voted at each January meeting to reaffirm the consensus statement in most years.
Did it test Gamma
changes.
Max?
In 2019, we changed that practice, conducting our first
Also,
ever public
Bitcoin's
review,
down
and said that we would repeat
1.37%.
such reviews at roughly a 5-year.
Although correlation
There's
between
nothing
GME
magic
and
about a
Bitcoin
5-year
isn't
pace.
very high right now.
We
It is
believe that frequency
positive.
is appropriate to reassess structural features of the economy and to engage
Looks like
with the
Vol's
public,
coming down pretty
practitioners,
sharply.
and academics on the performance of our framework. Several
Some
of our global
shorting.
peers have adopted similar approaches to their framework.
Possibly through XRT.
At the time of the last review, we had been living for about a decade in a new normal characterized
Shitty
by
retail
proximity
sales
to the
data.
effective lower bound, with low interest rates, low growth, low inflation, and a very flat Phillips curve. If I
Is
could
Discord
capture that
dead, or
era
is it just
with
my
one
end?
statistic,
I
would
think
be
it
that the
might just
policy
be
rate
your
had been
end.
stuck at the lower bound for 7 long years
Yeah.
following the
Well,
onset of the global financial crisis. in
There's like
late
20 people listening on the
2008.
Discord right now.
After
I'm
liftoff
sure
in
one of
December
them can weigh in.
2015, we were able to raise the policy rate only very gradually over a period of 3 years.
Let's get back
to
on
a
that
peak of
ramp.
just 2.4%.
Well, we're still on
7
the
months
ramp.
later, we
We
began
didn't-
reducing
we only
it,
fell
leaving
off
the
it
rate
a
at
little.
1.6% in late 2019, where it would be when the pandemic arrived a few months later. Policy rates in other major advanced economies were even lower, in many cases below zero, and in all such economies,
Quote,
inflation
people.
regularly ran below its target.
Yeah. Real
The sense
people.
at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another
We're not
extended
getting
period.
Discord audio either.
The post-financial crisis decade
hold
had
on.
demonstrated the pain that that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at
Let me
zero.
know if that's better.
Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations.
Okay.
Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound,
Does
and
it
the
seems
need
pretty
to anchor
evenly
longer-term
distributed
inflation
today?
expectations at 2%,
Well, look like
we
anyone
said
really
that
has an
following periods
edge.
in which inflation has been running
So
persistently
far, we're
below
just like
2%,
climbing up
likely aim to
the
achieve
gamma
inflation
to like
moderately
80,
above 2%
85,
for
falling
some
back
time.
down it to like
We also
70.
concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment.
75 being far more
The
important
change
than
to
I'd like it to
shortfalls
be
was
today.
not
But
a
there's
commitment
bot
to
puts right
permanently
now,
force wear preemption
75,
or to ignore labor
80.
market tightness.
Sold puts at
Rather, it
70
signaled
and lower.
that apparent labor market
so
tightness would not, in
probably
isolation,
unlikely
be enough
to
to trigger a policy
slip.
response, unless the committee believed
There's
that,
some bot
if left
calls out of
unchecked,
the money
it
to
would
the upside, but not
lead
very
to
many.
unwelcome inflationary
Interest
pressure.
on the entire chain is very, very
This
low.
change reflected
Which
our
makes me
experience with long
kinda
expansions
wonder,
that featured historically low unemployment amid low and stable inflation, suggesting that a
the
policy
market's
approach
waiting
that
on
carefully
something.
probed
Are there any
for the
planned
maximum
like
level of
meetings from
employment
Trump today?
could bring about the
Trump's
benefits
rush
of
for
a strong
AI
labor
deals in the
market
Gulf
without
opens a
risking
rift
price
with
stability.
China hawks.
In
Some
the
Trump
years just prior
officials
to the
want to
pandemic,
slow
for example,
NVIDIA and
unemployment
AMD
was at
sales to the Middle
multi-decade
East.
lows,
People
while
familiar
inflation
with the
ran below
matter.
2%.
Oh boy.
By December
The greatest
2019,
market
estimates of
predictor.
the long-run
Familiar people.
unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our
You
consensus
really missed the
statement were
stream
thought to be
title
rooted in
of
slow-moving global
Javian
factors that would likely persist
affluenza.
for an extended period, at least until our
All right,
next five-year
pretty good.
review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today.
What's
There
up,
was nothing
McChuggets?
intentional or moderate about the global inflation that arrived.
So
a few
chop
months
all
after we
day?
announced the
Probably.
changes
It's
to the consensus statement.
like flat
And I acknowledged
spreads.
as much publicly in
Only
December 2021.
probably only people selling
We fell
options,
back
not a
on the
lot
rest
of
the
options
framework, which
buyers.
called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation
What's
was
the gamma
likely to
flip on
subside
NVIDIA
fairly
at
quickly in
$5?
2022,
I don't know.
with only a moderate increase in our policy rate. That projection was consistent with other central banks with
That's an
different
excellent
frameworks
question.
and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data
That's
suggests
on the
that
weekly
12-month
contract, I
PCE
guess.
Inflation was 2.2% in April, far below its 7.2% peak in
I'm not sure why.
2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020.
It's just flat.
Our review
Yeah,
will
I'll
reflect our
admit
assessment
now.
of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility
Thanks for
that
giving me the
inflation
heads
could be
up.
more volatile going forward than during the inter-crisis period of the 2010s.
Get it fixed.
We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020.
What a put and
Anchored
call on
expectations are
UNH,
critical to
put
everything we do,
200p,
and we
30
remain fully
DT,
committed to the
call
2% target.
900Cs, Jan
In the current
26.
review, the
Why in
committee
the
is
fuck would
engaged
you
in
buy a
discussions about what
900C?
we've learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in the coming months. We're paying particular attention to the 2020 changes.
Why call
as we consider
down?
discrete
This
but
makes me
important
big
updates,
sad.
reflecting
Well,
what
because
we
I
have
bought
learned about
puts
the
on it
economy
yesterday.
and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement,
YouTube audio is on Discord, only your mic. That's correct.
Policy communications,
I
particularly
could.
regarding the
Hold
role of
on.
forecasts
I mean,
and
if you.
uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in
If you put the
relatively
webhook in it,
a critical question is how to foster a broader understanding
kills
of
the
the
YouTube
uncertainty
feed.
that the economy generally faces. In periods with
I have no
larger,
idea if
frequent,
this is
or more
Powell
disparate
live or
shocks,
if he's just
effective
repeating his
communication
earlier
requires that we
speech.
convey the uncertainty that
They
surrounds
should
our
be on a
understanding
break
of the
right now.
economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to us. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
I know it says live, but I think they're just filling in the gap in the meeting.
All right, thank you very much. We are going to just roll right into our first paper session today. On the agenda today will be sessions that address the two sides of the Federal Reserve's dual mandate, employment and inflation.
Yeah, this is just
and also the
replaying.
strategies and tools used to pursue those goals.
This is not even
So I'm going to turn
live
it over to
anymore. Yeah, they said they were taking a 30-minute break, but I don't see a secondary stream popping up for the. Oh, okay, I found it. It's still on break. I think Wall Street Journal just replayed the fucking thing. You get some extra bit of audio software to multi-split that feed. I don't want to. That sounds like a pain in the ass. Like, if you want to hear what's going on the stream, just fucking join the stream. I saw that sick little exposure by expiry tool in Pickles Picks. What are you talking about? What? New features? I wonder who could have spun that up so quickly. The latency is worse on YouTube. It's like fucking it's like less than a second. I know Discord's like instantaneous, like milliseconds, but it's not really like a very noticeable difference. It is, and I don't want you to, because going to Discord is how I escape it when you're streaming Trump. You have to listen to his crazy shit. He's still the president. It must have been a dream. A dream of PPs. Not a good opener. How's your day going, Nick? Slept in an extra 40 minutes and it doubled my commute. Oh, you're in the office today? Gross. Any companies you're expecting will do well in this environment, besides Mag 7 pumping? I mean, every other sector besides utilities is pretty exposed to tariffs, so even utilities, actually, some of them. But, no, I still think there's a shitload of uncertainty. Leave for Germany on Saturday, so if everything blows up that week, well, good luck, us. Yeah. That's why I was trying to get everything sorted. Before you go, we had a whole big meeting yesterday on getting some stuff and clarified in DevOps. Oh, did you see the DM I sent you? I'm in the office every day. That's terrible. How low do you think AQN might go? I have no idea. $550 is an important level previously, so maybe it'll get hung up around there. It's not like tradable. It's just something you buy and like take the yield on, and hopefully it grows over time. It's not like a super interesting stock. You don't need to ask about it every day. We are below the Delta float. There's just support here though. Like 70, 65. So probably not all that interesting. If we slip further, things could get a little squeezy to the downside. But I think it'll be hard for us to lose 60 right now. We need more puts to come in. And nobody wants to buy them. Everything's just fucking sold. Sold calls, sold puts. The only place puts are really getting bought is like right around where gamma goes negative. Like here. Like 75, 80. And then they close them when we test like 65. Which is what happened earlier too. UGI has been nice since since it was a pickles pick. Very, very nice. Turns out it was cheap as fuck. It's only up like 73%, but it's not bad. I think WBD still has a metric fuck ton of debt. And unless they've found a way to solve that, it's going to stay low. I think they've got pollen problems in El Salvador. Probably. It's like a jungle. Is it? I think it's jungly. It's near the equator. How much downside do you see Tesla having on it? It's got support at 330. I wish I found the stream at 18. They put the pollen in prison and that solves it. Moving to El Salvador? Maybe. There's still pollen in the ocean, though. It's in the air. I just shilled Gamma Strike to a colleague. I'm ready for my referral code. We don't have those. Submarine might work. I'll take a hat then. When they're for sale. You could buy yourself a hat as a bonus for the referral. No, we'll set something up for that later. It's a little complex though, and like right now we're focused on We're focused on building functionality and tools, not referral codes. But I'm sure one day we'll have some kind of referral thing. Maybe to like get you points for the merch shop. I don't know how we're gonna do it. Do you want referral codes or a better product? No, Nuke. Stop everything and spend the next 3 months building out a full referral system. UNH at 251. I know, I'm short it. Waiting for my puts to get stopped out. Honestly, it'd be easier than some of the stuff on my plate. Yeah, I know. Give me a second. I'm gonna go grab my food from downstairs. Oh, and this looks like it's like starting to turn around a little bit. If we get over 77, we might push back up towards the gap.
Inflation expectation and inflation dynamics, that is basically at the center of what we do here in central banks and at the Fed. and was a crucial ingredient of the 2020 framework review. And so I'm delighted to have two great speakers with us today. We have Yuri Gornichenko, who's Quantage Presidential Chair in Economics at UC Berkeley, a good friend of the San Francisco Fed. I think we're a neighbor on top of that. And also Mark Gertler will be our discussant. He's Lucy Mose's Professor of Economics at NYU, well known for his work in macro and finance. We're delighted to have you here, Mark. And so I'll turn it over to you right away. You have 30 minutes, Yuri.
Well, thanks very much for inviting us to write a paper for this very important conference. We had a very simple set of instructions, just summarize what you know about inflation expectations and give us some ideas about how we can use this knowledge for policy making. That's what we try to do here. Fortunately for this audience, I don't have to spend a lot of time explaining why we care about anchored inflation expectations, right? So a lot of what we do in this room and in other central banks is about achieving better macroeconomic outcomes, macroeconomic stability, and we know we need to have anchored inflation expectations to deliver this objective. However, macroeconomic stability is not something we have been blessed with in the last 5 years, right? So we had a pandemic, we had an inflation surge, we had another invasion, Russian invasion of Ukraine, we had all sorts of trade frictions. We saw a lot of chaos and volatility, right? That's something we don't really want to see in the economy. And we want to avoid this kind of situations. But from the perspective of the economics research, it's actually a great opportunity for us, because when you have so much volatility, so much variation, you can see things clearly, something you would never be able to do in a stable macroeconomic environment. And so one thing we wanted to do in this project is also try to utilize this volatility, this natural experiment, to learn something about how people form and use inflation expectations and what we as policymakers can do about that. Now, we have many lessons from this exercise, but I'll focus on the main one, which is we don't believe that inflation expectations are anchored. They were not anchored before the surge, they were not anchored during the surge, obviously, and even now they're not particularly anchored, right? So what you see in the US and in other advanced economies is that inflation expectations are very volatile. They don't seem to be very anchored. In fact, what you see is a clear pattern, which we call a cycle of selective inattention. And in a nutshell, the idea is this. When inflation is low and stable, people don't have strong incentives to pay attention to inflation. It just doesn't matter if inflation is 1.9 or 2.1%. Right? So people are not paying attention to that. As a result, they have very diffuse beliefs about where inflation is, where it's going. And it's going to be very easy then to change their beliefs from low numbers to high numbers, just because when they look at prices of the goods they buy often, like the price of eggs, price of milk, price of gasoline. These are very volatile prices, and as a result, their expectations may be also very volatile. Now, at the same time, when you look at periods when inflation was high, we know people have very strong incentives to pay attention to inflation. But what they see is kind of very discouraging for them. They see that inflation is very high. It is going to be very different from the inflation target. They sort of learn that the central bank is failing. And as a result, they're also going to have unanchored inflation expectations. So it seems like no matter what you do, you're going to end up with unanchored inflation expectations. It's not a very pleasant situation. And obviously, it has many, many implications in terms of what we should be thinking about the sources of the business cycle, sources of inflation.
They have financials out, slot machine.
Anchor inflation expectations.
Some,
so for
just
example,
not
if we
a
take
history of
unanchored
them. That's the
inflation
risk with
expectations
any
as a
new
starting
company,
point and try to understand why we had a surge in inflation in the US and in many, many other countries, our conclusion is going to be that we were just unlucky. We had a period of elevated energy prices, all sorts of disruptions, and if you combine this with unanchored inflation expectations, you can easily generate a big surge in inflation. On the policy side, we did a few experiments with people participating in our surveys, trying to understand what kind of buttons we can push to make inflation expectations more anchored for an average American or for an average European. And we found that varying policy framework from inflation targeting to price level targeting or some intermediate case is not going to be enough to anchor inflation expectations in itself. You have to dig deeper. And what we argue need to do is to bring inflation as quickly as possible to the target when inflation is high, to make sure that people don't learn their own lesson, that the central bank is somehow failing them. And once you achieve this objective, you should be working very hard to penetrate this wall of inattention that people typically have in low inflation environments and make sure that they learn that inflation is low and stable most of the time. It just sometimes we have unlucky situations and inflation can be out of control.
What an asshole do you with reflection?
Now, in what follows, I'll try to
Recessionary
elaborate on
data.
each of these points and
Why
hopefully
do you
convince you
expect
that
the
what we
bulls
do
to be
makes sense. But before I do
over-exuberant
this, I
today?
wanted to make sure that everybody is on the same page about what kind of measure of inflation expectations we should be looking at. Right, so there was already a discussion earlier this morning about is this SPF, short-term, long-term, and it is a very important question. We have expectations from different agents at different horizons. For example, you look at firms and you very quickly realize that some decisions are going to depend on their long-term inflation expectations. If you build a factory or something like that, long-term, obviously you have to be thinking about long-term expectations. But for many, many, many decisions that firms are making, it is really short-term inflation expectations that are most important. Think about pricing. If you set your price and you know you're going to stick to it for another 6 months, maybe 12 months, you don't care about where inflation is going to be in 5 years or 10 years. What is important for you is where inflation is going to be over the next 6 or 12 months. After this, you can fully re-optimize. You don't have to worry too much about where inflation is going to be. The same story applies to consumers. Many decisions depend on short-term inflation expectations. Many decisions depend on long-term inflation expectations. But I would say the vast majority of what people do in their daily lives is a function of their short-term inflation expectations. Financial markets, another big player in the economy. Here I think it's a more balanced situation in the sense that we should care about long-term and short-term inflation expectations. You know, pension funds, they definitely care about long-term inflation expectations. Short-term traders, they just care about where inflation is going to be next instant, next week, next month, and so on. We also have professional forecasters, maybe the most overstudied group in the field of economics. You know, they give us very precise answers. We love to study them. But, you know, when you look at their role in the economy, it's not clear what they do exactly, right? Their consumption choices are not, you know, reflected in GDP numbers. You know, their inflation decisions are very small. They can inform us about where the economy is. They can signal to us how credible the target of the Fed is. But, you know, fundamentally, they are not the right people for us to look at because they account for such a small fraction of, you know, what is happening in the economy. So the main point I want to give you with this table is that there are many, many agents out there. If you care about the real side of the economy, you have to be thinking about firms, consumers, and financial markets, of course. And these guys are going to be, you know, behaving very differently, as I'll explain in a moment. But we shouldn't discount firms and consumers just because they're crazy or have some unusual expectations. They're making very important decisions based on those expectations. We should take it seriously.
Why
Now,
would I
going
get
back to the
long-term
point,
calls
the
on
main lesson
Upstart?
about unanchored inflation expectations. There are different ways how you can measure how anchored inflation expectations are. This is some metrics. There are different ways to establish whether expectations are anchored or not. I'm going to focus on these 5. You go to the data and very quickly
How the fuck
you
you still
realize
timed
that,
out in
you know,
Discord,
none
but
of
not on the
these
YouTube?
conditions is satisfied in the data. Inflation expectations are very different from the target. You see a lot of disagreement, huge revisions from one survey wave to another. All of this is signaling to us that inflation expectations are not anchored. Now, how big the departure you see in the data from anchoredness? To appreciate the difference, I think it's very useful to look at the dynamics of inflation expectations during the surge. This time series here is headline CPI inflation in the US. We see a massive increase. We almost hit double digits. Then inflation quickly collapses, but it remains elevated. Okay? Now, we want to study how different agents revise their inflation expectations during this period.
What did Poopy do? Mildly irritated me.
Which is inflation expectations of the FOMC members. If these expectations are unanchored, we are doomed, right? So we want to make sure that, you know, this group of people believes that they can deliver 2% inflation. And you can see that most of the time there is a success, right? So inflation expectations are anchored at 2%. But in 2022, there was a fairly significant departure from 2% inflation target, right? We had almost 2 percentage point gaps, so to say. Anyway, so this is going to give us a benchmark for thinking, what is anchored inflation expectations. You look at first people who are probably some of the most informed agents in the economy, professional forecasters, financial markets, inflation traders, and I want to thank Julia Coronado and her colleagues for sharing data with us. It was super informative. When you look at this group of people, some of the most informed agents in the economy, and compare them to FOMC members, you very quickly realize that they're very, very similar. Everybody agrees that inflation is, roughly 2% in the long run or short run, but there are some deviations from one month to another. So this is good news for us. These expectations are relatively anchored. When you look at expectations of, for example, households using the Michigan survey of consumers, you see a very different picture, a massive increase in inflation expectations. Then inflation is collapsing, but inflation expectations are not going down fast or fast enough for us, right? And in fact, if you look at recent readings of inflation expectations from the survey, they are growing up very rapidly, and this is not something we should take a lot of comfort in. And obviously, this is not consistent with anchored inflation expectations. You see big departures there. Firms. We don't have long time series for firms, but now there is a survey run by the Cleveland Fed, which surveys managers of US companies, asking them to tell us about their inflation expectations. Their expectations are very similar to households' inflation expectations during this period. Massive increase.
Just what we needed, a Russian financial comedian.
But they remain elevated, and the most recent readings of the survey suggest to us that they still have very high inflation expectations, and these expectations may be increasing. So we have different agents in the economy. Some agents are more anchored than others. But when you think about households and firms, we think it is a wrong starting point to think that these expectations are anchored.
DKS is a big holding in XRT.
Now we can do another test. We can say, okay, forget about
down
short-term
14%
expectations.
today.
Volatile, they change for all sorts of reasons. Let's focus on long run, 5-year ahead inflation expectations.
It's gotta be rough when everything you sell comes from China.
Kind of set the benchmark here. You see expectations are very close to 2%. This is how anchored inflation expectations should look like. This is the expectations from some of the more informed agents in the economy. And there is a lot of kind of similarity there, but at the same time, you see that there are cracks in this
Buying Foot Locker.
agreement we saw before in short-term.
Yeah, not really a great
Sometimes
time.
The difference between financial markets and FOMC members is going to be as big as 1 percentage point. The most recent data suggests to us that they expect at least 0.5 percentage point higher inflation over the next 5 years. It's not the end of the world.
Foot Locker looks like it's enjoying that 85% jump.
That for some reason, these people think inflation will be higher than FOMC members. Now, households and firms. Here you see, again, a very different picture. A massive increase in long-term inflation expectations for households and firms. And again, the most recent readings of this data suggest.
I wonder how long that pair trade will continue for.
A serious problem.
We're offering 24 cash or 0.1168 shares per Foot Locker share.
Now, one kind of line of thought we can have to deal with this situation is to say, well, there is all this noise and biases and other issues.
So people are going to go long Foot Locker, short dicks until the merger.
There is a lot of noise and biases in this service, but we shouldn't discount this as being pure noise or anything like that.
That's SPX.
Kind of one way how we can see this is to look at this figure, which shows the time series of the average price of gasoline in the U.S. and 1 year ahead inflation
overnight
expectations
gap
in the U.S. And we call it internally with Oli,
85 to 89 is still left.
Right. If you want to know what is the level of inflation expectations in the U.S., you just need to look at the price of gasoline. This is very striking, right? You see a very strong correlation, not only at low frequencies, but also high frequencies. And you might say, this is crazy. We're comparing levels of prices with changes of prices.
Oh, they're doing the super stock thing where they put one chart over another and then use different y-axes to make them look the same.
Capacity to collect and process information. It makes total sense for you to look at the price of gasoline because we know historically it's correlated with the level of inflation. It's very easy to observe. It's a homogeneous good, very easy to compare across time and space. And so it's not crazy for you to use this price, this specific price, to form your inflation expectations. So it's telling us that inflation expectations are actually related to some type of fundamental force in the economy. People are responding to incoming information. There is another set of tests you can do. One was suggested by Ben Bernanke that inflation expectations should be insensitive to incoming information.
That's how you predicted the market crash? No, it just like the trading action was just the same as it was
you regress
going into the crash in 2020.
Inflation expectations on short-term inflation expectations. And if your expectations...
Man, that really works out, too.
It means we should see zero correlation between these two objects. Because where inflation is today should have no bearing about where inflation is going to be.
But that was the same axis.
Everybody should believe
I didn't use two axes.
2%, close to the target. Now, you can run these regressions, and you can see very quickly that at least in the most...
That's okay, Pepe. They're using a regression.
The correlation between short-term and long-term inflation expectations is very high. Again, this is not consistent with anchored inflation expectations. You can do other versions of this test. For example, you have a transitory shock. It should not affect long-term inflation expectations for agents in the economy because they should be anchored. One of the shocks will be a monetary policy shock. You can do this with financial markets, and you will find that even this transitory shock can have a significant impact on long-term inflation expectations. Again, this is not consistent with anchored inflation expectations. Now, final test of how anchored inflation expectations are. This figure here shows the time series of actual inflation in the 1970s and inflation expectations from the Michigan Survey of Consumers for the same period. Right? You see a massive increase in inflation, massive increase in inflation expectations. We say it's not surprising what happened then because this is what happens when you have unanchored inflation expectations. This is the narrative we have in our textbooks. Right? It kind of illustrates the dangers of unanchored inflation expectations. You will have a situation where inflation and inflation expectations feed on each other. Right? You expect high inflation, you end up with high inflation. You see high inflation, you have even higher inflation expectations. That's the narrative we have in our textbooks and research papers. Now, this figure here is the most recent episode.
Still no bot calls.
Massive increase in inflation, a massive increase in inflation expectations. But we have a very different popular narrative out there, which is saying we actually have anchored inflation expectations. The reason why inflation fell so quickly is because inflation expectations are anchored. But when you compare these two figures, it's really hard to escape thinking that maybe we don't have that much of a difference between these two episodes. And then we have to make a decision which narrative is probably more appropriate. We think the 1970s narrative is right. But we need to do obviously more research to confirm this. One thing I also wanted to mention in this context is when you look at the 70s, specifically this first surge in inflation in the 1970s, we know once you have unanchored inflation expectations, if you have a one-time shock from supply side or demand side, it doesn't really matter.
I don't think AGL is very important in the broader scheme of healthcare.
And sustained level of inflation for quite some time. Right? So this means that once you have unanchored inflation expectations, you can't really ignore one-time shocks. If you have unanchored inflation expectations, you have
definitely don't benefit from the new healthcare plans and budgets.
Very quickly. So we want to avoid
they provide like nursing services and shit.
You can have one-time shocks. And in the current conditions, who knows what
so cuts to Medicaid, Medicare would be very bad for them.
Tariffs, whatever it may be. We're in a dangerous state if we believe these two figures.
Healthcare?
Now, to summarize,
just generally, like the whole sector?
There are different horizons. Our main conclusion is that inflation expectations look very unanchored to us, especially for households and firms. For other agents, there may be different degrees. But for many
or like a specific company within it.
Unanchored inflation expectations seriously as a possibility. Now, obviously, people don't have in their DNA anything that will tell them that they have to have unanchored inflation expectations. We know people respond to incentives; they change their beliefs with the macroeconomic.
Oh, UNH?
And obviously,
UNH is at like 250.
We can do something about this unanchoredness in inflation expectations. Right?
Use the ticker.
Now, how do we know that people can respond to this? Here is one kind of test you can do in the data to see it clearly. And this is based on a randomized control trial where a random subset of people is told something about inflation, a past inflation number or an inflation target or a forecast for inflation. And you can then compare their beliefs to the control group, people who don't receive this information. And if you see big differences between treatment and control,
I have a stop on my UNH prints at 260. So far it hasn't hit that.
So it's a very simple test. How does this work in practice? This is from an experiment Oli Corbion, Michael Weber, and I did in 2018.
Definitely not trading it in the short term right now.
Subject. Nobody cared about inflation. And this figure is for the control group. We have prior expectations, posterior expectations. These people, remember, are not treated with information. They should have no reason to change their beliefs. The relationship here should be very close to a 45-degree line. We don't have exactly 45-degree line, but we are very close to it. Now, what happens when you tell people
still didn't fill the whole gap.
Inflation target or
There's like
inflation
another
forecast
5 cents left.
You see massive revision in the beliefs that these people have. Posteriors are very close to the signal you provide to them. It's telling us that people didn't pay attention to the statistics before.
Because I shorted it in the middle of the day yesterday, beginning of the day yesterday.
The signals, it's consistent with Bayesian learning. Right? So when you have a big change in the slope, it's telling you people are not paying attention to this information. If the change in the slope is very small, it means we are not surprising these people. With
it wasn't something I was even going to play after the drop, but we saw like a one-day opportunity, and I entered it in the middle of the day. Pickles Picks is generally planned positions, not shit that I just grab during market hours. Otherwise, I wouldn't be able to write them up the night before.
And in a nutshell, what you see in this figure is that when inflation is low and stable, people are not.
I don't have any calls on UNH.
When inflation is high and volatile,
I have leap
paying
puts.
a lot of attention. So we have a change with the macroeconomic environment. It's telling us also that if policymakers do something differently, people may change the way in which they form inflation.
No, I didn't get the first big failure on it.
Now, one final figure I want to
I
mention.
shorted it like 320 yesterday.
Before, again, in 2018, people struggled with answering a basic question. What is the inflation target of the Fed? What is your perception? You know, people would say, 20%, or just say, I don't know. Very few people would say 2%. When you ask another cross-section of people recently, in April 2025, many, many more people now know the inflation.
I bet UNH
they
put
know
some
it's 2%.
WeBull.
But they continue to forecast that inflation is going to be 5% or 10%. Right, so this is a very dangerous sign for us. Even though they understand that the Fed wants
can one still enter
they are
leaps
not
here?
believing that
Leaps
number.
for what?
I think inflation is going to be much higher. So in a way, it was a
Did you
lesson
realize
to
that like
tell
the
people
upside
that
of
inflation
UNH is
2%.
very, very
That's the
dangerous,
target.
right?
But it was a very expensive lesson. And in fact, if you ask people how much consumption you would sacrifice to ensure a price stability, they would say in the US something like 5 to 6%. And that's consistent with the numbers Eric showed earlier this morning when he said that the wage gap relative to the trend is something like 5%. So it was a very expensive lesson. People hate inflation. We know this now for sure. They learned the inflation target, but they also learned that inflation is very different from the inflation target.
Why did I
It's
buy
teaching them
WeBull
a
at
very low
15?
lesson,
I don't
so to
know.
say. Now, what do you do when you have something
Because you got
like this?
excited about
Obviously,
the
you need to
IPO
communicate
price?
to the public at the times when inflation is low and stable. This is going to be challenging because people are so inattentive. But we know in principle we can penetrate through this wall of inattention. We can see this in our experiments. In the high inflation environment, it's obviously very different. You have to focus on bringing inflation down as quickly as possible to the target to make sure that
Benjamin
people
Graham
learn the
would be
right
so
message, that the central bank can deliver the inflation target instead of learning that the central bank may be failing. Now, if inflation expectations are anchored, what do we do with this? Right? We can have some normative exercises, some positive exercises. And I'm going to start with
I think my stop triggered on UNH,
positive
but I don't think
exercise.
it hasn't closed yet.
Phillips curve, right? We can use this object to learn something about how people think about inflation and how this translates into actual inflation. You know, one basic question when you try to do this, what kind of expectations we should use? Theory is telling us it should be inflation expectations from firms, and this should be short-term inflation expectations. Okay, we can check if this is true. We'll use Michigan Serve Consumers as a proxy for firms' inflation expectations. Run a horse race of Michigan versus SPF, and very quickly you will find that it is the Michigan Serve Consumers that has most predictive power in this context. You can also look at different horizons in the Michigan Serve Consumers. And again, you very quickly realize long-term expectations are much less important than short-term inflation expectations in explaining what we see in the data. Cost push shocks, you know, usually we have a hard time explaining what it is because it's a residual. We say it's a markup shock, and so it's very hard to know what it is exactly. But for this period, we have a very
There's a lot
clear
of support
story
at
what that was.
1350.
Right, so we know it was the Russian invasion of Ukraine is one of the forces that drove energy prices to really high levels. And once
There's
you
a lot
increase
of
the
vega on
prices
the
of
15
natural gas,
strike.
it means we're going to have high prices for fertilizer, and then it means high prices for food. Okay, so we can have a very direct
getting near a
channel there.
low.
We also know that during the COVID crisis, there was a massive change in the composition of demand. Maybe not so much in the level of demand, but composition for sure. And again, we know this is not related to many things that were happening in the world. The final thing I want to mention here is when we work with this Phillips curve, we can rearrange things a little bit to make it easier to visualize everything. And so we'll move inflation expectations to the left-hand side and work with inflation gap versus unemployment gap and see what happens there. Now, this is a situation where you take incurred inflation expectations seriously. Right? So here we just assume that inflation expectations are perfectly anchored at 2%. This would roughly correspond to a situation where we use long-term inflation expectations from the SPF. And when you use this as a measure to construct inflation gap, you see that during the COVID crisis, we had, at least in early stages, movements more or less along the Phillips curve. But then sometime in 2021, we start to develop a massive deviation. And it keeps increasing in 2022. And then we have a vertical movement in the space. Right, so we can be very creative here and say, oh, this is nonlinear Phillips curve, or maybe we should use alternative measures of slacks. And this will be very reasonable explanations, but you don't have to do it. If you can take Michigan Survey consumers and say, this is the expectations that should apply to the Phillips curve, and use that to construct the inflation gap, you see that the deviations from the historical relationship are going to be much smaller. And when you adjust this gap for these cost push shocks, the price of natural gas, the changes, the bottlenecks in the shipping industry, there is very little unexplained variation. Right? So it's basically telling us that we can explain what was happening in this episode just by appealing to
90 is a little bit supportive if we can get above it.
And an incurred inflation expectation.
But if we fail 90 here, we'll pull back again.
Very far.
Delta flip moved to
the
upside
interest of time,
again.
I will mention just a few more cents. We can do a natural experiment here and say, some countries worked very hard to make sure that their energy prices are not going up. For example, you look at Latin America, Bolivia made a conscious decision to subsidize and control energy prices. What we see in this data is that relative to its peers, Bolivia didn't really have a lot of inflation at the peak of the crisis. Right? Eventually, the subsidies were extremely expensive. They had to print money to monetize these fiscal deficits. But in this critical juncture in 2021, 2022, they actually didn't experience a ton of inflation. Taiwan, a similar story. They really subsidize and control energy prices, much less change in inflation. In Europe, it's a little harder to find a comparable story, but probably Switzerland is as close as you can come, where you can see that there, in this country, they rely a lot more on hydropower and nuclear power, and so as a result, they are much less exposed to changes in the prices of natural gas in Europe after the Russian invasion. So, it's kind of a striking story then if you look at this data. It basically tells us that we had a situation with bad luck followed by good luck. We had this massive increase in inflation and inflation expectations because we had a very bad supply side shock and we had unanchored inflation expectations, but then we had a massive reversal just because the energy prices collapsed so quickly. This means central banks should not be blamed for the rise of the inflation, but they should also not take too much credit for the rapid disinflation. Now, what do we do with this? Okay, how we can make sure that something like this does not happen again? We do a bunch of surveys to see what people would expect for inflation if we offer them alternative policy frameworks. Suppose inflation is going to be, controlled through inflation targeting or price level targeting or some intermediate case. What would be your inflation expectations? In a nutshell, we see very little difference across these frameworks. So it's telling us, this is in itself is not going to be enough to anchor inflation expectations. Now, of course, the data is more nuanced and you can see different stories there. For example, if you ask people, what do you think the Fed is doing in response to a one-time increase in the level of prices? Most people will say the Fed is going to do nothing. They're going to look through this, okay? When you ask people, what do you think the Fed should be doing? many more people would say we actually want to have some price correction. We want to have a reversal towards the initial level of prices. So maybe there is some demand out there for some form of price level targeting or average inflation targeting, but people probably can't really formulate it in terms of policy frameworks. You have to change the communication with them. Now, so if you can't really, anchor inflation expectations just by having this variation in IT versus PLT, then what can you do? Our story is that when inflation is high, try to bring inflation as quickly as possible to the target. When inflation is low, this is your opportunity to make sure that people learn that the vast majority of times, central banks are extremely successful in delivering low and stable inflation. This is our window of opportunity there. Now, we know it's too late to do something like this, but nonetheless, we still have some very important questions. What do you do with this now? And one important question you often hear in press conferences and in general discussion is, what the Fed is going to do. What's the trade-off between inflation and unemployment? Now, the science of monetary policy, I'm very glad Mark is our discussant, is very clear on this. You anchor inflation expectations and you're going to improve the trade-off between inflation and unemployment. This is what we want to do. However, this is not the luxury we have today, we think. We don't have anchored inflation expectations. What do you do with this? We have some ideas from the 1970s. Paul Volcker, one of his first speeches as the chair of the Fed, he's saying, once you have unanchored inflation expectations, there is really no trade-off. You have to focus on bringing inflation
resistance
to low
of
numbers.
5,900
That's your main
now.
objective. You don't worry about anything else. And then in later speeches, he developed this point and said, everybody understands what we need to do, but the key question is, are we going to do it? Are we going to be persistent in our attempts to bring inflation down? And he said, unqualified yes. It's kind of striking that he had a separate line in this speech saying, and I'm not going to have any caveats to that answer. So to summarize, I know I'm out of time. We all want to have anchored inflation expectations. When we started this project, we wanted to find anchored inflation expectations in the data. However, we don't see a lot of evidence out there, at least in surveys, suggesting to us that you have anchored inflation expectations, especially for households and firms. And if we ignore this fact, we may be in all sorts of problems. What we can do if we take it seriously, one thing we can do is to break the cycle of selective inattention, right? Try to communicate to people when inflation is low and stable. I know this is hard, it's difficult, but it can be done. We also need to make sure that we focus on inflation expectations that are most important for most agents. We don't have to look at professional forecasters. They don't matter for anything. We have to look at households and firms and financial markets. This is our objective. And then more, I think, importantly, in current conditions, we should not be thinking that one-time shocks are not going to ignite a high and persistent inflation. If you have unanchored inflation expectations, we have to be very aggressive in responding to these one-time shocks. Thank you.
All right. Thank you, Yuri, for a provocative presentation, and Mark will give the rebuttal, I guess.
But I am going to try and be a little more upbeat. Let me, first of all, say I'm a great admirer of Yuri's work on expectations, and so I really appreciate the opportunity to read and discuss this paper. Now, at the core, what the authors do is estimate a Phillips curve, which relates inflation to the unemployment gap plus expected future inflation. And the distinguishing feature is they use survey measures of expected inflation to proxy for actual inflation. And four main results. First of all, short-term expectations matter more than long-term.
59,
Second,
23, 50
households
to the
perform
upside
better
on
in this
ES is
equation than do
resistance.
firms, and professional forecasters are at the bottom. Third, household and firm expectations are unanchored. And fourth, watch out, households are signaling inflation. So nothing controversial here. All right, now to frame my discussion, I'd first like to describe the conventional wisdom on short versus long-run expectations
I looked
of
at a few of
inflation,
those.
and also what anchoring can do. So what I want to do is modify the Phillips curve I just showed you to allow for time-varying trend inflation, which I'm going to call pi bar t. And I'm going to call x hat cyclical unemployment. That's the difference between unemployment and long-term unemployment. Now, the main difference between this Phillips curve and the one on the first slide is now expectations are a convex combination of the short run and this long run trend. But this discount factor beta is close to unity. So it's correct that the short-term forecasts have more impact in the structural form than does the long-term forecast. However, the short-term, or inflation has both a cyclical and a trend component, so the forecast of the short-term is going to depend upon what the trend is. And we can illustrate by assuming that the output gap follows a first-order autoregressive process, solve out, and what do you get? You get, in the reduced form, inflation depends upon a set of shocks. There are demand shocks and supply shocks, plus trend inflation, okay? And where does the trend inflation come from? We think that comes from central bank credibility. So a central bank loses credibility, trend inflation drifts up, actual inflation drifts up. Okay, what happens when we have anchored expectations? And here my definition, I think, is a little different from Uri. I think anchored refers to the trend, whether the trend is at target, because it's recognized the short run can differ from target. Now, to be credible, you can't differ for too long, like 3 to 4 years or something like that. But what's key is that it's the trend that's anchored. So bottom line is whether or not trend inflation expectations are anchored is going to affect both short-run inflation and the expectation of inflation, okay? Now, a common way to illustrate what anchoring can do is with this figure which plots the 10-year forecast of inflation by the Survey of Professional Forecasters against core inflation. It's from the late 70s to the present, and I divide the sample in half. And you see in the first half, long-term expectations are unanchored, and also the correlation is very close to unity, and that's just as the simple model would predict. Then over time, as the Fed establishes credibility through its actions, through communication, long-term expectations drift down near target, and also the correlation between inflation and long-run inflation weakens. Now, a main point of the paper is you shouldn't be looking at the forecasts of professional forecasters. You should look ideally at firms. Firms aren't available for a long sample, so a reasonable proxy would be households. So here I do the same exercise, but I substitute the Michigan survey long-term expectations from the Survey of Professional Forecasters. Now, first of all, you do see a similar pattern. In the first half of the sample, long-term expectations are way up, and there's a pretty strong correlation with inflation. Over time, in the second half, long-term expectations drift down, and the correlation with inflation weakens. But two important differences. First of all, expectations don't go all the way, okay? So maybe the Michigan consumers aren't paying attention to Fed communication. Okay, they're at about 3.5% to 4% above the target. Now, a key point which I want to return to later, they're also above actual inflation. They're not just only missing the target, they're missing actual inflation. The second difference is expectations take off in the second part when there's really no observable shock. So what's going on there? How does it matter? And I want to return to that later as well. Okay. Now, I want to take up the author's suggestion that you can formalizing the degree of anchoring, I guess, with the Bernanke test. So I want to look at the pass-through of short-run expectations into long-run expectations. The coefficient of beta, it measures pass-through, and the higher beta, the less successful is anchoring. Now, there's going to be some bias in this regression because long-term expectations, a shock that affects long-term expectations maybe affect the short run. So think of beta as an upper bound on pass-through, okay? But the key prediction is in the early part of the sample, beta should be high. When there was no anchoring, it should fall in the second part where there was anchoring. And that's what you see for both professionals and the households. Professionals, the first part of the sample, the coefficient pass-through is about 0.8, drops to a little over 0.2 in the second part. Something
Not a ton
similar
of support
with
at 90, but
households,
there's a
but it
little
doesn't
bit.
quite go all the way. Okay. Well, as far as with professionals. Okay, now the authors estimate pass-through in the second half of the sample using a panel data approach. I use time series. There's pros and cons of both, but we get similar results, okay? So my estimate of pass-through for the Michigan households is the same as what the authors was. Now, one difference is they look at the 5-year forecast instead of the 10-year forecast, and they see high pass-through for the 5-year survey of professional forecasters. But I checked, and actually I do as well. So there's no controversy there. But there is kind of a puzzle. There's low pass-through on the 10-year forecast, but high pass-through on the 5-year forecast. So what could be going on? I think what's key is the Fed doesn't really target a single number like 2%. It targets a range. So it's content with inflation oscillating between 1.5% and 2.5%. So it'll tolerate very persistent behavior of inflation within that range. Inflation goes outside the range, they will act very regressively. So you have kind of a nonlinearity in behavior. What do I mean? Okay, so this figure on the left-hand side, I plot the 1, 5, and 10-year survey of professional forecasts over this period. The right side is the pass-through estimates, again, high for the 5-year, low for the 10-year. Now, you can see that pre-pandemic, the 10-year forecast is pretty steady. It drops about 20 basis points. But the 5-year and the 1-year move around a bit, but it's all within the target range. So, like I said, if the Fed doesn't care if inflation's 1.75% and it persists, it's just so long as it stays in the range. Then what happens in 2022, there's a potential loss of anchoring. Both the 1 and the 5-year jump well above the range. The 10-year jumps a little bit above the range as well. So what happens? We get very aggressive monetary policy. We're not quite back there, but we are closer, okay? Now, the central question, whose expectations matter? Okay, as you already said, they tried different forecasters. The forecasters that work best are the Michigan survey, a beta of 1.5, an R-squared of 0.7. Works better than the survey of professional forecasters, although you get a more reasonable estimate of beta, the R-squared is lower, okay? And also in a horse race, the Michigan consumers win. No issues. One, possible reverse causality. Here, the authors are totally open about it. They're estimating by OLS. So could household forecasts be more sensitive to current inflation? So as you already said, they're less sophisticated. They'll look backwards. They're not paying attention to Fed communication. They're just looking at what's out there.
GF not moving at all.
Now, I want to really be fair about this because in Yuri's other work with
it's all sold
narrower
positions.
data sets, he's very careful about exaggerating.
More importantly.
Okay. But it is an issue in the conclusions you draw here. That is, endogeneity and measurement error are going to create problems for the counterfactual. There's going to be an upward bias.
We're chugging along. We're just trading flat for like the last 3 days. We ripped up. We hit resistance.
Estimate of beta for
Wait for
households
more
is
information.
1.5, so more than 1-for-1 effect on inflation, and that could be endogeneity. Another question is large firms. Okay, I saw an interesting paper by Alvarez, Blazer, and co-authors that show that the 10 largest firms account for 41% of sales. If you look in manufacturing, the top 1% of firms account for 75% of sales. And you kind of
some kind of confirmation of downside, or should I put
although it'd be really interesting
here? You're just trying to time the top or hope you're right. seems
and
like
that's
a bad
something
idea.
that I suggest looking into. Okay, let's dig a little bit deeper. So here I want to compare the 1 year ahead inflation forecast from the Michigan survey against actual CPI inflation. The Michigan
Why
is the
overnight
red,
strangles?
dashed blue line
Because of where
is
VIX
the
is?
CPI inflation.
I don't
And then
know.
below,
Realized
I'm
vol should be
putting
coming
the
down.
forecast errors from a
Risky.
year earlier. Okay,
Straddles
the
are
error in
probably better.
year-ahead
They're just more
forecast.
expensive.
And here, okay, first the bad news. If you look
We could just
within the
consolidate
inflation
here and
period,
move higher. It's
okay,
really,
the
I mean, it's really
forecast
risky to
errors
buy puts
average
unless you
about
can buy a
2
lot of
to
theta.
3%. The Michigan forecasters are above by about 2 to 3%. And we think we do need a story of if these are the price setters, okay, why is inflation low over this period? Now, maybe we can work that out, but I think that's the next step. Now, the good news, they catch the run-up. They catch the run-up for the 70s inflation. They catch the run-up for the recent inflation. Although if you look more carefully, they tend to under-forecast the run-up and then over-forecast inflation as inflation is coming down. And again, that's kind of suggestive of adaptive expectations. But here, it seems, the message seems to be if you pay attention to what's going on and not try to do some fancy forecast ahead of time, you do better. And that seems to be the case. Okay. But again, we want to get at the deeper issue of, are these Michigan forecasters, are they like canaries in the coal mine, or are they actually affecting price setting? And I think that would be a very interesting avenue for research. Now, the last point is, what's going on at the end of the sample, whereas
Did we pull back enough?
there is this jump in inflation expectations.
What, like 60,
And
65, 67?
it doesn't seem like gas prices
Sure.
are jumping or anything like that. It just seems like they're going up. So again, are they canaries in the coal mine, or are they affecting price setting? If they're affecting price setting, you'd kind of expect to see it in current inflation, and we don't yet. So what possibly could be going on? Oops, okay. All right, if you put in tariffs and inflation in Google Trend, it skyrockets just about the time that the Michigan consumers forecast done. So they're aggregating information. And so what this, let me be clear, this doesn't suggest you should ignore the Michigan consumers, okay? They may be providing useful information, but we need a little bit more to be convinced that they're actually involved in price setting, okay? Now, just as a benchmark, let's compare with the professional forecasters. I'm doing the same exercise, except
Average working
now
conditions,
the red line
squawking
is the
birds.
year-ahead inflation expectations of the survey professional forecasters.
What's up,
Once
Eric?
again, the forecast errors are in the bottom, and you could hear in between the two high inflation periods, they do pretty well, okay? The mean looks to be 0 and the variance is lower, okay? But for the high inflation periods, they're bad, okay? So I agree we should not, for these periods of inflation surge, we should not rely exclusively on their forecast, okay? How much time do I have? Okay. All right, one other point. Now, if you buy the story that expectations are anchored, what is it that's causing inflation? Well, you need large shocks. And the point is, I think we had large shocks. The top panel plots CPI inflation, that's the lowest curve, against something meant to indicate demand and supply shocks. The first is consumption growth. This is total consumption growth, which did go up. The second is, the top one is global commodity prices, meant to be a supply shock. Now, the two shaded lines are two significant points. The first is where these shocks kind of hit their peak, and that was the time when CPI inflation took off, okay? The second shaded line is the Ukraine war, which gave another kind of dose to supply shocks, okay? So what could underlie these movements? Well, look at the bottom panel. Government transfer payments, okay, jumped way above the rise in consumption, and most micro estimates suggest there was about a 6 month lag before the transfer.
Straddles were net green today. Thank you, Gamma Strike. Nice, dude.
Stimulus and supply stimulus, okay. Then you see from the New York Fed index that the
I'm still
supply
kind of
chain
sitting in the
tightening,
calls in case we push up
continued.
above the
So,
collar.
I agree, supply shocks are probably most important, but I think demand shocks had a role as well. So these two shocks, compared with short-run expectations of inflation, okay, might be able to explain what happened. By short run, taking into account how these shocks infect inflation.
Vol's rising a bit.
All right, so bottom line,
Might be something to be concerned with here.
interesting and significant research.
I should put a stop on that.
My view, though, is that it's important to keep
straddles
long-term
there.
expectations anchored, but I totally agree that we need more work on whose expectations matter for price setting. And I think, and I know Yuri's done this in other work, will involve modeling how beliefs are formed in order to sort out causality. And finally, we need to figure out what's going on with the Michigan households.
All right, thank you, Mark. I'll make a wild guess and suggest that this is going to trigger a lot of questions. So, Neil Kashkari first.
Thanks for the provocative paper. Yuri, I would just offer one other source of data you might consider looking at, which I don't think you mentioned, are labor union agreements. During the COVID pandemic and the big inflation surge, we had a lot of roundtables at the Minneapolis Fed. I'm sure many of my colleagues did too, with labor unions to understand what their negotiations were, what they were asking for in their 3 to 5 year agreements. And I took some comfort from the fact that if you just did the math of what they were asking for, mostly they were asking for their members to catch up, and then assuming that they'd have lower, moderate wage growth in the future. You also look at cost of living adjustments in union contracts. In the 70s, almost all union contracts had them. They fell away by the 90s. I think as inflation expectations got anchored, to the extent that those start getting reintroduced and those are a priority again, that would be supportive of your thesis. Thank you.
Okay, let's go to Larry Myers. I get Chris Ursak after.
I loved Yuri's paper. Mark's comments were fabulous, so I'm going to have to absorb them, and I'd like to hear what Yuri thinks about it. Let me tell you why I loved Yuri's paper. Number one, I love the fact that he said, got my attention at the beginning, inflation expectations are unanchored, period. Okay, that's good, interesting. Second, I've never been able to, he said short-run expectations are more important than long-term expectations. I've thought so, but haven't been able to get that into empirical Phillips curves. You did. Now, you said the reason I didn't is I was looking at the wrong measures of inflation expectations. I was looking at professional forecasters and market-based. Okay, I'll take in stride your comments on professional forecasters, but that was important. Now, and the supply side shocks were more important. There's one thing I really disagree with you about. What you said, when inflation is high, the most important thing is that the Fed work aggressively to bring it down. I think that's inconsistent with other things you said in your paper. The Fed wasn't responsible for the surge in inflation. They could do nothing about it. It would come down on its own. So you got to make a real distinction between demand and supply forces affecting inflation. In a sense, the Fed did what it should, nothing. And they shouldn't get blamed for it, and they shouldn't get credit when it comes down. Okay, my views.
Let's take one more from Chris Ursak here, and I'll let the authors and panelists to provide comment.
Well, thanks for a fascinating paper and a great discussion by Mark. So one of the more provocative messages on the monetary policy side is that households might prefer some form of price level targeting, where if you have a cost shock driving up inflation, the central bank would bring it back down and perhaps even induce deflation. So I was wondering if it might be the case, though, that households regard, just like they regard inflation as a shock, basically an adverse supply shock, that they like deflation, and that's what comes across in the behavioral studies, mainly because they like favorable supply shocks, and they don't understand the general equilibrium effects. So if the central bank actually had to do this, it would drive up unemployment, it would generate the sort of debt deflation that was very familiar 100 years ago and tended to be loathed by the public. Thanks.
Okay, Yuri, Mark, comments?
Okay, I'll start by saying thanks to Mark for an excellent discussion. You know, as a student of his many papers, as I said, you know, we wanted to have inflation
59, 2350.
They don't seem to be there. We obviously have many measurement questions and identification issues. This is one of the most challenging subjects out there in macroeconomics because expectations are so endogenous. And that's why we have randomized controlled trials to know for sure causally that inflation expectations are translated into actions from firms, from households. I must say it's a very expensive research agenda. We will welcome any funding we can receive from people in this room and otherwise. One question is, you know, what's happening with the Michigan survey of consumers? And, you know, historically we didn't have tariffs. It was not very visible. Obviously, as I said, people are very responsive to changes in the macroeconomic environment. And if they understand that tariffs are going to be translated into higher prices, it will be you know, stupid to ignore this information and not change their inflation expectations. And we see they are proactively responding to this. They accumulate you know, stocks of things which are going to be expensive in the future. We see that inventories were very high. So to me, this is a signal that this may be more like a canary rather than just some random aberration in the data. Firms versus households. I wish we had a long time series of firms' inflation expectations to know for sure what these guys are doing, especially for large firms. But you know, when you look at what captains of the business are talking about inflation, I think Michigan survey of consumers is not necessarily a bad starting point. For example, Elon Musk at the peak of inflation was saying that we see a lot of deflation in the data. I don't know which data he was looking at, but we didn't have a lot of deflation at the time. Some other questions. Labor unions. You know, that's a very useful piece of information, but we have only a small fraction of labor force covered by unions. As an example, in Berkeley, everybody has a labor union but faculty. So I don't know what would be a consensus view there. It's true we have some positive developments. We don't have COLA agreements as often as we used to have. It's, you know, it's good for us. But on the other hand, and echo what Aishigul and Eric were saying earlier, you look at the survey of consumer expectations from the New York Fed. They ask people to report their wage expectations. Wage expectations didn't really go anywhere. It was one of the bigger lessons we have from this episode, that inflation expectations went through the roof, but the wage expectations didn't grow. And that's maybe because people have anchored inflation expectations, or maybe they don't expect their employers to respond to inflation in the first place, and the only thing people can do is basically switch jobs to keep up their purchasing power. Larry's question about you know, what do we want to do when inflation is high, especially if it's driven by supply-side factors? You know, there is no simple solution there. Paul Volcker was saying, I don't care if it's oil prices or whatever, I'm going to focus on bringing prices down. So from his perspective, the source of business cycles of inflation was not terribly important. I should say, you know, in the surveys, people really want to have, you know, some correction after price shocks, right? So if prices go up, they want to have at least partial reversion in these price increases, and they don't care if it's supply or demand. And we should also know that in household surveys, when you ask people, where do you think inflation is coming from? The vast majority of people will say it's a supply-side view, right? So from them, inflation is really bad for purchasing power, something they really hate. And this is also related to Chris's question. One thing I didn't have time to cover
Still
a lot
is
this, you know,
sold
survey
calls
evidence
up
we
here,
have
10,
in
15.
recent you know,
Only
months is
block
when we ask
calls
people,
to the
what is your
upside are
desired
money
rate
at
of inflation today?
905.
very many people want to have a deflation, right? They want the level of prices to go to the pre-surge level. They probably don't internalize that this may mean a big recession. It may be very costly, but they try to signal this preference through other means. Right? So they go to the polls and they express, what they want to see among policymakers. And so even though these guys may be, doing, having some beliefs which may seem not well justified by what we see in the data, at some level it doesn't matter as long as they act on these beliefs, and we should take it seriously.
Okay, I've got Bill Dudley here, Joe Gagnon, Ben Bernanke.
I have a question for both Yuri and Mark about how the Fed fits into all this. You have a little bit of a sort of instability in sort of equilibriums. Like if everyone thinks inflation expectations is well anchored, Fed's confidence about that, therefore the Fed doesn't have to do anything. Versus if inflation expectations are unanchored, then obviously the Fed has to respond. But there's a risk if there's a risk that the Fed sort of decides that inflation expectations are anchored, don't have to do anything, which actually then feeds into inflation expectations itself. How do you feel like inflation expectations are influenced by what the Fed does or doesn't do? Because it seems to me like that's relevant to the conversation.
Can you just pass the next to you question?
Yes, Benoît Maujon from the BIS. I'd like to bring international perspective in terms of the frameworks and their impact on whether inflation expectations are anchored. So we look over the last 50 years or so, and there's been a lot of convergence across central banks in terms of their monetary policy frameworks, and inflation targeting has been adopted very widely, and typically when it's adopted, it's followed by better anchoring of inflation expectations, at least of professional forecasters, people who do not matter at all, but maybe if they influence the large firms, they express themselves in the press, it still matters. So, I mean, in the data that was showed in the excellent presentation and discussion, it's not the case that households, they're spot on at 2%, but there are long instances where, it's flat, as is inflation. And then if you look at this international evidence, inflation is much more stable across countries in the last 20 years than it was in the previous 30 years, and that's very clear. And even the recent inflation episode, which had an impact on inflation, and inflation rose in a number of countries, it's also the case that it came down relatively rapidly and with a soft landing. So, it seems like the inflation targeting framework from this standpoint has delivered.
No, I still think it's really hard to hold prices above
it's not perfectly
like
anchored,
905.
but I wonder
we'll
whether
need,
in
we'll need
the,
more
the
positioning
description
to
that
the
you did
upside.
use, there's not a half-empty bias, which is very useful for the discussion, but maybe I take it more as a half-full glass perspective.
Yeah, Joe, and then Ben.
Thank you. This is more of an recent empirical observation than a question, but it supports Yuri's point, which is if you look at across countries where inflation rose more under COVID, so which countries had a higher increase in inflation under COVID, and it's true for advanced and developing economies. What explains that? Well, there's one variable that explains more than any other by a lot, and it's very robust. And that variable is where inflation was 10 to 20 years before COVID. It seems that people, when COVID hit, people who had a memory of high inflation in their past were much quicker to demand higher wages and prices. And this is also true for bond yields. And if you didn't have an experience of high inflation, you didn't. And it's true in the negative side too, whereas the smallest increase in inflation under COVID was in Japan, which had deflation. So this does raise the concern that having just primed people with a few years of high inflation, they may be more sensitized going forward.
Nice paper, Yuri. Nice line of work. Good discussion.
If consumer expectations either cause inflation or even just are a better signal of inflation, then you seem to have discovered a permanent and large market inefficiency because market measures of inflation, like break-evens, for example, are quite different from the consumer index. So I was just wondering if you have made any appropriate investments.
I guess you have to answer that. Okay, so I'll take some time to answer, and then we'll take another round after.
All right, I'll respond to Bill's question about how the Fed could make use of expectations. And I think back to the figure I showed where during the pandemic, survey of SPF forecasts were within target until 2022, where they all jumped outside the target. And that I would take that as a serious sign that you may be losing anchoring. And so the appropriate response is very aggressive tightening to get back within target. I mean, the SPF is sort of the Fed's most loyal base. And if you're losing them, you need to take action.
Mm-hmm.
And I'll start with Ben's question about property investment. At a recent conference, I was approached by an investment banker, and he was asking me, how can we use the evidence to make money? And I gave him free advice. I said, look, we see a lot of polarization in the Michigan survey consumers. People who are more conservative believe inflation is going to be low. If you're more liberal, you're going to expect a lot more inflation. So when you go to Texas, you should see a consumption boom, and if you go to California, you should see a depression. And so if you want to invest in companies, you should invest in companies in Texas, not in California. I gave him this advice on the condition that we will talk again in a year, and he'll tell me how much money he made from that advice. So I don't know, we'll see. To Joe's point about, people now having, sort of a very sensitive attitude towards inflation, I think it's very much there in the data. We know from previous research that we have scaring effects from this, traumatic experiences. And even now, when you look at the Michigan survey of consumers, there was a decrease in 2023, 2024, but we didn't go all the way down to where they were. And this is one of the points we try to emphasize in our analysis, that once you have a situation where everybody is so sensitive to price shocks, it is very easy to move actual inflation just because everybody expects it to happen. And so then firms can raise prices just because they can. They don't have to justify anything because consumers are expecting these prices to increase. Benoit, you want to see half full glass. I agree with you. I think the purpose of this conference is to have a debate, so we wanted to have a half empty glass. But also I should say that we have a lot of survey evidence, and we can have different empirical approaches to study the data. You can certainly tweak and torture the data to make it look anchored. Right? You can work with medians, truncated means, all sorts of things to kind of minimize variation in the data, and then you can conclude that inflation expectations are going to be anchored. My favorite example is the Reserve Bank of New Zealand. They used to run they still run a survey of households, and before they record your response, they have two questions for you. One is, if they ask you, do you know what inflation is? If you say no, then they hang up. If then you go to the second question and they ask you what's your inflation expectations, and you say more than 10%, they're going to raise you from the survey too. And maybe in the olden days it would be a sensible strategy when you draw people with extreme views. But now it's very hard to make a case that somebody expecting more than 10% inflation is a crazy person, right? And so, the range of possible is much bigger, and we have to look at means rather than medians because the right tail is so active. Going back to a question about what do we do with this, there are obviously better people to talk about this. But, Paul Volcker is very clear what we should be doing. We should be very aggressive to re-anchor inflation expectations, improve our trade-offs, and then we can work after that on other issues.
Julia Coronado, Macro Policy Perspective. So first I want to say that I'm questioning my decision to share our data with Yuri given the disrespect I'm detecting for professional forecasters. But nonetheless, I am sympathetic to his conclusions. I wanted to share another observation from our survey. So our survey is of more than 100 market participants every quarter, so very rationally attentive people. There's no inattentiveness here. They are, to Ben's point, putting their money where their mouth is. And one question that we've been asking since 2017, so through a range of inflation cycles,
at 5,900.
is, do you believe that the
So you could
current
slip back to
monetary
95, where there's a bit of support at 90.
Of generating a sustained period of 2% core PCE inflation
Holding
within
5,900 is probably
years.
important
So
for bulls here.
When we think about credibility, there's both the willingness and the ability to influence inflation, and is there a sacrifice ratio in periods of high inflation that's just, so high that the Fed will tolerate a miss for a sustained period? So it's kind of a supply side. You're getting at the supply side. So one thing that comes out of this, which Yuri notes, and I'm very sympathetic to, is inflation expectations move around a lot in this very, very attuned group since 2017. That the percent of people saying, yes, the toolkit is capable, went as low as 20% right before the pandemic, because inflation was just sticky low and the Fed just couldn't get to 2% no matter what. And then it actually rebounded through the pandemic as inflation went up. Well, now we're away from the zero lower bound, and then the Fed actually followed through, and then the inflation came down. So that percent saying, yes, the toolkit is capable, went as high as 80%. Here's the cautionary tale. That has fallen back to 50% in Q1. So this, I think, ties together this, like Governor Kugler and this idea that the recent experience may be influencing people's perceptions of how the economy works. So, yes, the Fed conquered the last bout, but now we've got another one. And, are they going to be willing to kill the economy? Are we in a world of supply shocks? So I do think that, I don't know that we go so far as to say inflation expectations are unanchored, but there's certainly more risks than we've seen, and I think the sequential inflation episodes are playing a role here.
Okay, let's take 3 more because we're getting out of time. Let's take the questions from Governor Kugler, one in the back here, and then we'll end with Mike Kiley.
Thank you, Yuri, for a very provocative paper and very nice discussion, Mark. So,
the correct inflation should be 0.
I think I agree that you can
we
think
get
about
under 80?
reverse causality and
Probably
different
not.
limited variables.
And
as you
I
well
would say
said,
not right
these
now.
cost push shocks are not really unknown. They're actually quite well known, including not only commodity prices, but just all sorts of import prices. I would also put in there supply shortages as measured by natural language processing models, which this stuff here at the Fed has very nicely developed. So definitely worth including. I guess my key issue is about not only this measurement, right, and what your coefficients will be if you include all these other supply side shocks. And by the way, the supply shortages also includes demand. So that would take care of that as well. But it's also about interpretation. So, you for example, interpret this pre-pandemic period as having both unanchored and unattentive consumers and businesses. But if you think about it, former Chair Bernanke defined anchored to mean relatively insensitive to incoming information. Or former Chair Greenspan defined that as general price level, not affecting or altering business or household decisions. So one could just say, well, in fact, it's not that people are inattentive and inflation expectations are unanchored, but in fact, you could say they're anchored. So I guess there is an issue of interpretation there. And when it comes, I really appreciate your work, and I have cited it, and I appreciate the measurement of short-run inflation expectations. But there, again, you have, I think, to be cautious because We know inflation expectations, short-term inflation expectations, are certainly affected by short-term economic shocks, but these shocks could last more than a year. They could actually last maybe for a couple of years, right, and longer. So again, I suppose it's an issue of inflation, of your interpretation, if you have reasonably persistent shocks as well, and how you interpret that. Thank you.
Okay, question in the back.
Yeah. Hi, Angel Ubide from Citadel. Two questions for Yuri related to telling skill versus luck. So if households are the best predictors of inflation compared to professional forecasters or market participants, households are the ones that don't use any technology to forecast inflation, right? So is this another way of saying that inflation is impossible to forecast, as Stock and Watson have done many times, and they simply use an Era 1 model, and they are luckier than all of us who try to devote hours and hours to forecast inflation using models? Mm-hmm. And the second one, inflation averaged 2% in the 2 decades before 2019, despite inflation expectations being an anchor as per your paper. So was the Fed lucky or just very good?
Okay, Michael.
Hi, Mike Kiley. Great paper, very interesting discussion. So on what I think it was very interesting, and I agree, inflation expectations may not be fully anchored, but thinking of whether the glass is half full or half empty, right? Under an optimal policy under discretion in a simple model like Mark's science of monetary policy, you're going to see persistent short-run movements in inflation if you have persistent supply shocks. And if you look across the historical episodes that Mark showed, right, I think you had a considerable degree of anchoring, whether in Michigan or others, during periods
Lower
when you
high,
might use
bearish,
demand
could
shocks
be.
as being
Gotta
more
lose 5,900.
prominent, which is what would
That's
be true
what's
under optimal
bearish.
policy,
I mean,
and then less anchoring under
trading in
short-run
this range
expectations
doesn't really
during periods
matter.
when supply shocks are more common, as again you would expect. And so I wonder if you've looked at that, in more detail to understand that better, or whether the data is just a little hard to do that with. I think secondarily, it would be interesting, given the importance of household expectations, to step outside of the price Phillips curve approach and think about a wage price system and the role of household expectations in wages, sort of building on Neil's observation, right? It's more than just, do we see it in union contracts, but have you done the same sort of experiments in wage dynamics, and what do you find in those exercises?
Okay, Yuri.
All right. Many excellent questions and suggestions. Julia, you should not regret your choice. You did a lot for the progress of science, and many more people would like to use your data. But one thing which I agree with you is that when people start saying the Fed doesn't have tools to control inflation, it's a very troubling sign. And as a result, they should also create a lot more variation in their inflation expectations and more uncertainty. So we should be very careful about that. How torturing data, I was not exaggerating. In one central bank, which I'm not going to name, there is a survey of inflation expectations. It's a multiple choice, response question. The options are 1%, 2%, or 3%. Obviously, if you answer that survey, you're going to end up with very anchored inflation expectations. But that's not going to be the reality. We can see very big differences there. Now, the definition of insensitive expectations, it's a very interesting one. And this is related to an later question about, should we think about Fed as being successful when we had low inflation and everybody had more or less low numbers. In a way, it's a sign of success. If inflation is low and stable for a long time, people start paying attention to this. Right? This is, Greenspan definition that I don't want to have inflation to be, anywhere, in the decision making. But the flip side of this, if people are not paying attention to what the Fed is doing, again, that's a sign of success. It means when something is happening in the economy, they will not be aware of the fact that there could be some other policy decisions that may be important for them to think about. And so they may be changing their inflation expectations, not so much because of the Fed is telling them something, but because they see a different gas price and they start to think, different things. So ignorance
Are you
versus
buying puts up here?
attention
What is
versus
wrong with everybody?
emptiness,
Stop
I think
buying
that's a very
puts when
delicate
we're in
balance.
bullish
But from what we see in the data, for example, when oil prices were high in 2007, mostly because of demand-side factors, this was also the time when household surveys were reporting
Set above
high
5,900
inflation
bullish.
expectations.
It's bullish up here.
The question about, skill versus luck.
Why do you have puts? What the fuck? What was bearish?
It's very hard to answer this kind of questions. And why would we trust household surveys more than professionals? After all, what do these people know? But on the other hand, these people make many important decisions in their daily lives. They may be not perfectly informed, but there is a wisdom of the crowd.
It went up, so it must go back down. That's not a thing.
Noisy inflation expectations and have an average of some type, you can actually see a lot of information in there. And going back to Mark's slides, professional forecasters made a terrible forecast error during the surge. Households didn't. Right, so in some sense,
you can literally show us you going full port calls, and half of us will go puts.
Village crew with wage expectations.
When we tested 5,900, I was like, I'm keeping my straddle calls open, and then everyone just bought puts.
They can use in research. Wage expectations are collected only recently by the New York Fed. Most other surveys don't collect this information. And this is obviously a big barrier for anybody who is interested in these questions. So again, I want to encourage this group of people to fund more research on inflation expectations, wage expectations. I think we have a lot of questions to answer here.
All right, let's thank.
The only thing I'm mad about is I could have just massively overheld my calls from the first gap fill attempt.
Trevor will guide us for the next steps here.
At least I still have some exposure.
Thank you all for the great discussion. We are now going to take our break for lunch. That will all occur on this floor of the building. We have various areas set aside for seating. If you need any guidance
Fucking
on where to
Barrick?
go, we
I have
staff
no
members
idea.
outside who could help with that. If anyone wants to exit the building during this lunch break, please check in with our conference planning team back here in the corner so they can make arrangements for you to get back in the building. And everyone, let's regroup here, ready to go at 1:30.
Barrick has their
Thanks.
ex-div date coming up, so be careful with that. I don't see a Head and Shoulders anywhere. But, okay. Could technically sip a little bit further. Might wait too long at the gap fill. It's decent interest out to like 20 and then it falls off a little bit. VN's at 36. GM's above VN now though, so the dynamic's a little bit different. VN's not going to be as resistive. Overholding some calls would have been pretty cool. I got like 50% on him and I was like, oh, that's awesome for 10 minutes. So I closed him. It ghosted Seth Short at 5,900 guy and got stopped out. So something about that is like, that position will probably stay open. I'm pissy over 100%. What's too loud? You guys ready for round 3 of this fucking thing? Why are we watching this? This is the discussion for like Fed monetary policy going forward. So these are all changes that they're offering up for a decision by the Board of Governors to change the Fed mandate, or to change how the Fed mandate is, applied. Why are we watching the most important information for Fed policy? Yeah, that's just because I wanted to bore you guys to death. No, I just put the stream on to trick you into buying puts when we're in the most bullish price level of the entire day. Fucking morons. God damn it. It's like you guys don't listen to anything I say at all. Or write. Hashtag Gamma Strike. Jip might talk again? He's there. I don't know what he's doing. Probably just collecting ascots. I forgot to check Pickle's picks this morning. There's resistance at 5,900 and 05. But we have to fall back below it for things to get bearish. Buying puts up here is just a great way to get burned when bulls decide to try to push for like 20 or 30. Remember, positive gamma environment. So if you're going to play puts, ever, which, I mean, is almost not worth it. But if you're going to play puts, you have to time them perfectly. You can't just sit in them because the price will keep going up. You just get progressively more fucked as the day goes on. You're betting against the entirety of the market and the market maker who's buying the fucking dip. Also, I didn't buy puts. I bought leap calls on a dead stock. Which one? How many people went long hams after I said it was at resistance? I closed my calls on about puts today because we're above GM. We're below GM. GM moved up. I have one Riley. 750 left. Are you specifically talking short-dated puts? I mean, long-dated puts aren't particularly great here either. Like, VIX isn't that low. Would you take your shirt off? JPOW knocked on your door and hastily invited you to an emergency Fed meeting? I'd do whatever he asked of me. I want to decide Fed policy. That's fucking exciting. Not anything. But a lot of things. GM went up. Wow, that's sneaky. No, it's not. You have to check the data every night. Because it changes. That's why we update it every day. JPOW should retire and make a bakery called the Grateful Bread. I think that already exists in Portland. Anyway, when JPOW retires, he's just going to be a board member on one of the GSIB banks. Or at a hedge fund. Because of the door. Because he's going to go out there and be like, you guys remember that time I cut rates when I shouldn't have? You owe me. 2027 at the money calls on BlackBerry? It's dumb, but I want to see why BlackRock and Renaissance loaded up on shares. Jim's dead, though. Who cares what Rentech does now? You guys know that I bought a tiny car with a black swan on top? It's a hearse. And this guy says I'm autistic. No, Nuke, we both are. Representing the pickle jar's dead pets. Morbid. We're above gamma neutral. Nobody should own any pets. Unless they're for, like, next year. And now you know the same kind of autistic. We've had many conversations. Deep, meaningful conversations. Riddled with autism. Neither of us get what you guys are so emotional about. It's probably safe to say that all of us dance upon the spectrum in one way or another. That's what makes this place beautiful. We're just the outliers. What is a boxed green buy order on WeBull? I have no idea what the fuck. DM me a picture or something. I'm diagnosed. I don't want to be on the list. Big lot of hundreds, probably limit up. It's been so long since I've traded a stock. I'm trying to get the next futures account ready. I've got it from $250 to $700 so far. But I want to get it to like 12, and then I'm going to start trading NQ. Or, well, MNQ. Then I'm going to switch to NQ. I'm marrying an autistic girl this summer, and I fear that I might be undiagnosed. Any tips on raising mega autists? I don't know. Your kids are going to be like nonverbal. What are you doing? It's like little Mark Zuckerberg's running around. You're supposed to use your autism to find normal people. Like a normal person that makes excuses for you. Like, oh my god, he's so autistic. It's cute. That way you can get into the, like, all the cool groups that you were excluded from previously. I'm just kidding. I hope you guys are very happy together with your super autistic children. But I don't have any advice for raising them. That's why I'm here. Teach them to trade, easy retirement. Oh yeah, you can just teach them to trade options. So the price pushes into or goes above GM. They can just make GM rise. Well, I mean, GM can rise, but it takes quite a lot of buying and repositioning. It's not so easy to push it up. And then remember, the closer you get to the peak of gamma, the more resistive the market maker becomes to continued increases in prices. Remember that MM selling the uptick, so as gamma exposure increases over the curve, right? So you've got gamma exposure peaking here. The MM is selling all of that exposure against all of that exposure to the upside. This is what creates like a soft cap. Because the MM is so positively exposed to gamma that the sell pressure from the MM on the uptick increases, becomes harder and harder to move the price higher. Sign them up for coding lessons early. Your retirement plan. Nice, me too. Standing in corner, they don't know I'm autistic. I mean, you're here, so. I kind of did that. I married the cheerleading captain. She rationalizes my ND. You would need to. Gonna make them learn math on an abacus to increase mental math capacity, optimize their learning time by restricting their internet access to Investopedia and Gamma Strike. Just every night. Did you guys read the docs? Speaking of which, roundtable tonight. We got more new features. And new features coming up. I'm gonna blow your guys' fucking minds. Trump signal? Oh, is he speaking? Jesus Christ. Hold on. Let me make sure I have hedges. What's he talking about? Right now it's just Johnson. He says we're very, very close to a state and local tax deal. We're still on the path to pass the Trump bill next week. Trump tax bill. Qatar Wealth Fund plans to invest $500 billion in the US over the next 10 years. That's gone up. That number's gone up 3 times. Yesterday it was 2 years. And then later yesterday it was 5. Now it's 10. If they keep extending the amount of time, it's going to be the same as just like adding Apple's buyback flows. The proper pronunciation actually is, it's Qatar. But I think as Americans, we just say Qatar. Like the Arabic pronunciation is kind of in the middle of those. It's like Qatar. And so you hear a lot of people say Qatar, but it's like but it's more like a G. If you talk to like Qatari people, it sounds more like a G. Almost like guitar. So you are Persian? No, I'm not fucking Persian. No, it'd be like not tart. Ignore the extra T. Hold on. That's how Qatari people pronounce it. It's like the G sound you make when saying bug. Yerk speaks Arabic? No, I'm just good with languages. I've never needed to learn Farsi for any reason. Google AI is going to see you using Arabic and spelling Qatar, and the stream is about to show up at a whole different level of recommendations. It's okay. Trump has an entire base of voters that just found out the country exists. Hello, Akbar Kirk. I just logged in. What did I miss? If you screamed gutter at somebody, that would be like how it's pronounced. Just really emphatically. Is that Allah Akbar? That's Allah. Wow, you know that because you're Turkish? Hold on. Everyone knows it's Admiral Akbar. And Team Aloha? Aloha's Akbar. Oh, Jesus Christ. This will be an interesting time for the Jesus bot to show up. I think he left. He realized that this was a silly place. Assalamu alaikum, Greg. I'm just checking in for my day job. Fuck you guys. Bastards. Nobody gifted Jesus Bot a membership. It's true. Ooh, hold on. I should do that. Here. What? They don't let me gift memberships anymore? What the fuck is that? That's bullshit. Hmm. That's weird. Hmm. They're fucking weird. Jesus fucking Christ. JWD, I was expecting a few more fireworks. Yeah, that happens. There's a lot of gamma falling off today and tomorrow. Do we keep going up from here? We can. Huh. Do you guys still have membership gifting? Did they just turn it off for me? Do you see the option? Okay, that's fucking so strange. Huh. All right. Anyway. Big Bear, welcome to Tell You Thank you so much. Hit me up on the Discord. I'll get you added to the country club after the stream. Hmm. Mm. Hold on, I'm trying to replace all the membership badge images. Boom, changed them. Probably need to refresh. Maybe. There it goes. Now it's working. Yeah, they gave me extra slots. This isn't Pepto-Bismol, it's hot pink. Oops. Calls on Pits. Welcome to Cornichon, man. Thank you so much, dude. Probably more work than it was for the $5, but well done. Thanks, Willie. I mentioned earlier, ES had a ES 596075 target. I wonder to know if it was possible to confirm with GS. I don't know if I really have a target in that range. I've won at like 75, not 60. 52 and 74. You could, yeah. I mean, you could look out on like SPXW and see what upside interest looks like. It was a little around like 59.50. Some out at 59.75. With the spread, a 75 test would be more like 50-ish. It's like a $15 spread. So that would be like an upside test at 50. Right now, I mean, it's still pretty unlikely we get above like 59.25. So I wouldn't say that there's a very high likelihood of that test occurring today. But, I mean, I guess news could come out or something and shift things. Something went wrong. I think Dork rolled the pods because he had to update something. Here's the thing. ES did break the 59.27 level, which is interesting. New local high. Anything important happened so far today? Not really, no. Jump live with you, eh? That's not live. Hold on. Mm. Hmm. U.S. wants to discuss agriculture and economic security and EU trade talks. Fuck. Hold on. All right. Um, yeah, I still don't see anything. Trump, this is the closest I've got. But there's nothing going on yet. Yeah, Tesla looked like it was going to retest 350. Why would a company ever make a share placement at 50% of its trading price so their buddies can buy in? My 900Cs are up. Can I be a quant now? No. Let's support resistance at known levels. A bunch of gamma is going to fall off, so price action should loosen up and will be less range bound. Still nothing going on with the Trump thing. A little bit of supportive calls at 59.20.15. Sold calls 25.30. There should be some resistance here. Yeah, Delta starts to trail off a bit to the upside. Still a little bit of gamma. Not a ton. The synthetic short at 5,900 is still open, which is interesting. Up 100 bips from the bottom. Yeah. I think I'm going to close my straddle calls around here. This seems like a decent spot. Yeah, I think I will. I can see this getting rejected here a bit. Don't feel bad, Danimal. I closed my 0 DTE calls at like 50% too. Or like 50, I don't know, it was like 54. Ah, you made money. Don't bitch too much. Could have lost money. Could have been like one of the fucking people who bought puts when we broke 5,900 today. Yeah, I haven't forgotten about you guys. How dare you? That's silly. $5,900s were like $2 earlier. The ones I bought this morning, I bought for, let's see. I bought some for $2.74, and then I bought some for $4, and then I sold them all. I sold them all at $6.25 to $5.87, and they're $25 now. It's fine, right? The goal is to make money, not to make all the money. Also, we failed to fill the gap like 3 times. It wasn't a great look. My trading bot is glazing Gherkin. PieFast style is clean because he's not looking at sweeps. He's asking, what impact will those contracts have on dealer behavior? Stop running me through Chat GPT. If I took profits at the very top on my straddle calls, I'm gonna be fucking stoked. $5,900 seemed like it was gonna be hard to break. We could still close around there. Bot puts coming in. 25, 20, 15, 10, 5,900, 58.95. Could be some profit taking. Yeah, it looks like getting over 30 today is going to be rough. Not easy. Delta still falls off pretty nicely on a downside move. Like, the downside's still liquid because of all the fucking bot calls in the money. I hope I put still like 5 minutes ago, so I'm good. Alright. Think we go to all-time highs. If nothing goes bad over the next, like, month, probably. We still haven't made a trade deal with EU, and I feel like everyone's ignoring that shit. It's starting to come up in the news cycle a little bit. It came up today. Because, Sefcovic confirmed Thursday that the two sides are exchanging ideas and positions, but declined to comment on the U.S. document. Treasury in the coming weeks is likely to issue general licenses covering a broad range of the economy tied to rebuilding. Also, still in negotiations with over the Japanese trade deal. S&P GR, U.S.-China tariff de-escalation offers temporary relief. Rubio says the level of team set by the Russian side does not indicate a breakthrough in talks. UAE is promising to invest 1.4 trillion in the US over the next 10 years. Repo dropped 64 billion. Or 60 billion? It's about 60 billion. 25 counterparties. It's a big drop. 109 billion for tonight. Why is there a new icon next to my name? I updated the icons. I had to reformat some images. But yeah, they unlocked the, like, the higher tiers. You don't have an icon, TM. You're not a member. You have to be a member. We haven't had a trade deal with China either, but, but we're saying we did. The EU deal could be just as imaginary. The UK deal isn't even fucking structured yet. It's just a term sheet. We don't actually have a trade deal with anybody, but Trump paused tariffs. That's what matters. He's not going to squeeze US producers for another... Oh shit, how long do we have? Like 40 days now? Oh shit. Fucking back to these Trump speakers. You guys ready to goon to some economists?
Well known for many contributions to the study of monetary policy that include the design of inflation targeting, optimal monetary policy, and the implications for...
We have the concepts of the deal. We have the art of the deal.
He has experience as a business scholar in many Federal Reserve banks and other central banks across the world. And he's the author of an international...
I'm so excited to hear how many more reverse-looking models that they've come up with to solve the problems of the prior reverse-looking models, which is that none of them tell the future.
No introduction. Professor Rogoff is professor from Harvard, has long experience in policy organizations. He was actually an economist, telling me at the board during 1980 to 84. They moved to academia. He's
To listen for a deco.
has many important contributions on domestic and international macroeconomic issues that include his classical analytical...
It's like a rookie trader who just discovered indicators, but doesn't realize they're all just MACD. That's not true. There's stochastic RSI, which isn't MACD. But the rest are MACD. I'm an iconoclast. I bet puts GS says long. What's the success rate on that?
Without further ado, I'm going to give you the floor, Carl, and you have 30 minutes. Thank you.
Thank you, David, and thank you to the conference organizers for inviting me to join in this event today. I was asked to talk about lessons for monetary policy strategy, and there are a lot of lessons, and I'll focus on some that I think are particularly important in terms of thinking about the revisions to the FOMC's statement on longer run goals and monetary policy strategies. Now, a useful place to start is 2012, because that's the year in which the FOMC adopted its first statement on longer run goals and strategy. And if we think of sort of monetary policy lessons circa 2012, I think the most important one was that flexible inflation targeting works. It proved successful in developed and developing economies. And it was quite a simple structure in the sense it involved central bank independence, particularly instrument independence, combined with a clear objective for inflation. And that clear objective for inflation, combined with the ability of the central bank to actually achieve that objective, served to help anchor longer run inflation expectations, and that provided the central bank with the flexibility to respond to macro disturbances and contribute
You're going to
to
read my
overall
member
macro,
chat?
Stability.
All-time
Now, in the
high,
case of the
summer
US,
going to be lit. Got to keep the market
mandate for
out of the
FOMC
skibbity.
comes from Congress.
That's
In
not the
Federal
proper
Reserve
usage
Reform
of the
Act
term
1977.
skibbity.
You can see the origins of the
Boomer.
Mandates in terms of maximum employment, or to promote maximum employment, and to promote price stability. There's also promoting medium long-term interest rates, but that's usually subsumed within the dual mandate of maximum employment and price stability. So the 2012 policy framework provided the operational objectives that translated maximum employment and price stability into operational terms. So it established a 2% target and defined that in terms of
Skibbity is an
specific price
adjective.
index. So it was a clearly defined operational objective that corresponded to price stability. And that was in part because the statement says that in the longer run, inflation is primarily controlled or influenced by monetary policy. It also said that non-monetary factors are prevalent in determining longer run employment, not monetary policy. So it set an unemployment target that was less clearly defined.
I don't know. It
than the
seems
inflation
unclearly defined.
but it was linked to something quantitative. It was
It's
linked
either
to the
it's
FOMC's
either an
longer run
expletive,
projection of the
an
unemployment
adverb,
rate
or an
in the
adjective.
Survey of economic projections. Now, in 2016, that was revised to change the discussion of the target to a symmetric inflation target. And it said that the FOMC would be concerned if inflation were running persistently above or below inflation. Otherwise, the 2% PCE inflation target was not changed. The description of the employment mandate operational objective was not
It's very
changed.
versatile, like the word fuck.
Okay, it's useful to sort of then look at sort of macroeconomics from a very sort of high-level perspective of looking at inflation relative to 2% and an unemployment rate gap. And here I've used the CBO's estimate of non-cyclical unemployment to form the gap.
Looks like there's some
The
call buying
FOMC's
going on at
longer-run
59.30.
projection
Still
is
puts
not
at the
available
money at
starting back at
15.10.
2001, where this
Puts coming in at
starts.
58.95.
The blue
Sold
circles,
puts
the open
at
circles, are the
5,900.
period leading up to the adoption of the 2012 statement. You can see the high levels of unemployment
The 20
associated
strike
with
is
the
still
global
mostly
financial crisis
calls.
and the Great Recession.
Bot calls,
But
but
the
no bot
period
calls above 20.
Immediately prior to the adoption of the 2012 revision to the longer run goals and monetary policy strategy statement.
And there's still a
are
synthetic
indicated
short
in
at
the red diamonds.
5,900.
And almost
Although I do
all
think
of
some of
those
it's
fall
starting to break
below
down.
the zero horizontal line, implying inflation was below 2%. There are also, a lot of the observations are in quadrant 4, where in some sense inflation was too low and unemployment was too
Selling spreads
high.
is so fucking cool.
That
I'm on a
generally
cash
suggests
account,
that
locked in a
perhaps policy had
two-ring with
not been
guaranteed
expansionary
profit.
enough,
And
but
buying
it's
power is not
presumably a signal of
decreased.
the constraint imposed by the effective lower bound. Also,
I can't believe they're letting you
lesson
sell spreads
from
on
the
it.
red
I mean,
dots,
not a lot of brokers will let you
current
sell
Pearson's
spreads on a
data,
cash
but there was a
account.
feeling that the decision to
I
raise
think
interest
only
rates in December
Fidelity
of
and
2015
IBKR allow you to do
was a
that.
policy mistake. And so going into 2019 and the review that led to the 2020 statement, the Fed wanted to deal with sort of 3 issues. One, inflation had in fact
Skibidi,
averaged
Ohio
less than
Riz?
2%.
What?
It averaged the red dots, 1.36%, so it was falling below the longer run target for inflation. Concerns about eliminating or
at
reducing
6,000
the constraint
sold.
imposed by the
I
effective
doubt very
lower
much of that
bound,
spot.
and dealing with this issue that
Oh, it is
perhaps
Tasty?
in 2015 policy had tightened too
I haven't used my
soon.
Tasty account in so fucking long, I don't even know.
So the operational objectives were revised in 2020 So the operational target for inflation became average inflation target.
They'll let you do it on
when
cash settled
average inflation
instruments.
falls
Oh,
short of
okay. That makes
2%,
sense.
and inflation targeting when it doesn't. So it's sort of a hybrid or asymmetric AIT/IT, and I'll generally write AIT/IT to remind us that there was also an inflation targeting part of it, as well as an average inflation targeting. The operational objective for the employment mandate became the shortfalls of employment from its maximum level. And a third change that doesn't seem to be noted upon quite as frequently as the first two is that the order in which these operational objectives were discussed was reversed. From 2012 up to 2019, the inflation objective was discussed, and then the employment objective was discussed. And in 2020, those were flipped. And I take that as a sense that there was a shift in priorities between the two mandates towards the employment mandate away from the inflation mandate. Okay, what are the pros and cons of these changes? Well, if the asymmetric AIT/IT regime is credible, it raises expected inflation, something we've known long time, models from over 20 years ago, that if you have asymmetric preferences over inflation, that's going to weigh responding to low inflation more, the average inflation will rise. And that's going to be, and that was part of the objective because they wanted to more firmly anchor long-run expectations, so they wanted to raise average inflation. And that helps to reduce the impact of the effective lower bound, also one of the objectives they were attempting to achieve. And essentially, AIT works by converting inflation expectations into automatic stabilizers. So if it's credible, expectations will move in a way that helps promote stabilization policy. Now, in the literature, this regime has been studied.
Do you think they realize their
two different
average
ways.
inflation
One
is still
by thinking of it
cumulative,
as
and today's
defining
2%
a
is
new sort of
exponentially
inflation
larger
variable in an
than 10
instrument
years
policy
ago,
rule.
2%?
So
That's how
putting-
inflation
replacing
works.
inflation deviations from 2%.
I feel like they
and putting in
probably
average inflation
understand
deviations
that.
from 2%.
I hope.
And one thing that does, if you're responding to average inflation, it tends to make policy more inertial because you're looking backwards at what inflation had been in the past. And that can be effective or helpful at the zero lower bound where you want to have credible lower for longer policies. Well, under AIT, you're still responding to the low inflation in the past, so it may make more credible your longer for lower for longer policy. And the other way to think about policy regimes is defining the objectives of the central bank, not the variables they're responding to, but the objectives or goals that they're trying to achieve. And so if we, authors have studied average inflation as a goal, you're minimizing deviations of average inflation from 2% and some employment objective. And that makes policy both more inertial, but it also makes policy more forward-looking. Because even under pure discretion, if you're trying to minimize deviations of average inflation, you have to take into account how your impact on inflation today affects the average going into the future. And that's going to affect private sector expectations as well. So it makes even discretionary policy forward-looking, which can be beneficial. Okay, the advantage of the shortfall approach, well, it allows the economy to run hot. You're not going to respond to unemployment when it falls below your estimate of maximum employment unemployment. And that was also desired because it would produce a more broad-based and more exclusive expansion and reduce the hazard of removing the punch bowl too soon in the old language of the Fed cooling expansions before inflation got out of hand. And it also, this asymmetry in responding to unemployment works to raise average inflation. So if this all worked as planned, it would help address the issues the Fed was concerned about. So what are the cons? Well, obviously it may not be credible. Yuri has just talked about unanchored expectations, and certainly among households, his evidence
development will
suggests that
be
they don't
purchased by
understand
U.S.
average
companies.
inflation
It's a
targeting.
massive project.
There's some experimental
be
lab
bought
evidence that
through
actually
the
finds that long
US,
horizon
Trump,
average inflation targeting
leaving
can
tomorrow
lead
to destination
destabilizing
unknown, probably back to
extrapolating
DC.
expectations
Ends
that
report,
go in exactly the
remarks
opposite
to reporters.
direction. And so understanding how people
know, so you didn't
respond
say anything
to
important.
things like average inflation targeting, I think is an open question. There's a lack of clarity. The averaging window was left unspecified. It's again sort of goes against the grain of inflation targeting, where one of the prime things was you wanted to give a clear understanding to the public of what you were trying to achieve. This was more reminiscent of the 1970s, when Congress mandated that the Fed establish growth rate targets for monetary aggregates, and so the Fed obliged by establishing growth rates for multiple monetary aggregates. And so you didn't really know which one they were paying attention to, and they could usually find one that would hit the target or come close to it. And actually, I don't think that there's any evidence on the performance of an instrument rule that actually captures what the 2020 policy framework did. I've got an example here of one that might. So the capital I's there are index variables. So you have a term that says you respond to average inflation if it's less than 2%. That's the first term. The second term is you respond to inflation if average inflation is greater than 2%. And those response coefficients don't need to be the same. And then the shortfalls part is you respond to the unemployment rate, but only when it's above what I've called U star here, which would be the unemployment rate associated with maximum employment. And so there are a number of papers that analyze shortfall, but just have average inflation targeting for those first two terms, and a lot of ones that analyze average inflation targeting, that is combine the first two terms, and don't have the shortfalls. So there's very little evidence on how a rule like this that I think more accurately captures the 2020 framework actually work in models. Okay, what are the cons of the shortfall approach? Well, one thing the 2020 revision did is it changed the language on maximum employment from what had been used, which was that it may not be directly measurable, and they changed that to the more definitive statement that we can't measure it. Okay, so it made it less clear. Now, the point was raised in the earlier session about nonlinear Phillips curves. If the Phillips curve is nonlinear, maybe it's low unemployment rates that you need to respond more strongly to than higher unemployment rates. Again, not that you wouldn't respond, but the strength of your response might differ. More importantly, I think the way I think about policies is, okay, what's the distortion or the inefficiency that we're trying to address here, and what are the appropriate tools?
Q22, what made you think to sell at the top a little while ago?
Most people would agree that
like,
more broad-based,
what made you think we were puttering out?
Inclusive
Oh,
economic
you mean when I sold at the
good,
exact top?
But what really are the distortions that are leading to
we were running into
less
pretty heavy
inclusive
resistance there.
than is
There was
efficient?
no drop off in
distortion there.
volatility, the
And so
upside,
very
which
little
means that the
literature
higher
sort of
IV
linking
contracts
the
are likely to
shortfalls
be
approach
sold.
to the underlying
Which is
distortion
what
that,
happened. We got
we're
sold
trying to
calls
address
outside
here.
of spot,
And
bought
then
puts at
other
spot.
question about whether monetary policy is an
And
efficient
profits were
tool
very
for
likely
trying
to be
address
taken
those
in that
distortions.
kind of resistance scenario.
Just to take an example.
So put buyers come in to capture
Our
the
basic
profit
models in
taking.
Keynesian
And the
framework
profit taking drives more
assume
downside.
imperfect competition in goods
And
markets.
then if we lose
And so in
support
some
here,
sense,
we
the
could fall
natural rate of
further
output
because
is
there's a
below
drop off
the
in
efficient
gamma
level of
below
output.
us.
But
so
we
like
don't ask
failing
the
to
central
regain
bank
that
to
upside
deal
again
with
means
We
that
don't
bulls
think of
aren't
the
still
central bank or
buying out
monetary
there.
policy as an effective tool for addressing that efficiency.
There are still some calls.
And then also,
like
I
20,
think the effects of
but,
shortfall approach, shortfall response in models is
there's
uncertain.
more puts
so,
to
the questions you want to know is average unemployment
closed,
reduced
like short puts
by
that are being
responding to
closed.
shortfalls? Well,
If you look at the change in the IV curve,
it is reduced, and you
like
can find
you
results
can kind
that
of see
it's
like the
less
total
unchanged.
curve. If you notice,
Does
it's
the probability of the effect
it's
of
getting
lower
steeper.
bounds,
Part of that's we're
rise or
moving
fall?
towards the end of the
Well,
day.
you can get both results
But
in the literature.
like
Does
just to the
unemployment
downside of
volatility
spot, it's
rise?
getting steeper because these
Maybe,
short
or maybe
puts are
remains
closing out.
unchanged. Does it increase welfare or reduce it?
We also have a
depending
gap
upon the
back
model,
at
I think the results
5908.
evaluating a shortfalls approach are very uncertain. We just don't know exactly what the consequences might be. Okay, to summarize sort of my impression of the 2020 policy framework, was the new inflation objective clear? No. The asymmetric AIT-IT, it was confusing, and the averaging window was not specified. Was the employment mandate clear? No. Maximum employment is not directly measurable. So
check the
first
wick that
paper
just
this
happened on
morning is very
SPY.
useful in terms of addressing this issue of how you quantify what you mean by maximum employment. And the
I don't see it. Did it just like pop
one
up
of
and disappear?
The advantages of inflation targeting, or one of the objectives of inflation targeting, was to constrain discretionary policy behavior. And so having unclear objectives goes in exactly the opposite direction. If you leave the window unspecified and your employment mandate is not measurable,
58, 98,
then
yeah,
there are a whole
there's another
wide
gap
variety
down
of
there.
potential outcomes you could use to justify the
I think it's a
policy
little
action you
smaller
undertake.
though.
And I think the first lesson
no,
I
it's
draw
about the
also
same.
is that, you can pick
No,
your
that's
inflation
one cent.
target. Okay, so the Fed can pick 2%
This
as
one's
the
5
inflation
cents.
target,
Yeah,
they can
that
3% or
doesn't matter
1%.
so much as just
But the
rolling it.
employment objective is achievable in the longer run only if it picks an operational objective that's consistent with the inflation target. You don't have sort of an independent choice of what your employment objective is going to be. Okay, so now this is the same dot plot as before, but the black squares now represent the observations since the 2020 policy framework was adopted. And you can see most of those fall in quadrant 2, inflation above the target and the unemployment rate gap negative. If you use the FOMC's long-run projection for unemployment, those black gaps would move a little bit to the right towards the 0 line, but basically the same story you would get. Okay? And that's a sign that perhaps over this period policy has been too expansionary. Okay, so the rise in inflation, the quite large rise in inflation we saw in 21 and 22, obviously raised issues about whether we're heading back to a great inflation situation. And so I've listed here 5 primary explanations for the great inflation. Supply shocks,
Things
special
still
factors,
look a little bit distributive.
wrong theory of inflation, forecast errors, overestimating
Maybe get
potential
another like
GDP, or
upside
underestimating
test.
shock persistence.
And then,
Ambiguous and unachievable objectives, that was central to the sort of time and consistency literature on inflation, and a failure of the Fed to acknowledge its responsibility for inflation. And unfortunately, there were shadows of each of those.
I don't know, there's still
recent
puts being bought at
years.
spot.
You know, a lot of talk about supply shocks due to COVID, the war in Ukraine as being the cause of the inflation. A belief that in a flat Phillips curve implying that disinflation would be costly. Forecast errors, certainly in underestimating persistence of shocks, and a shift of focus from inflation to running the economy hot. And finally, sort of team transitory, which said it's shocks, we don't have to do anything. And there were hints of all the things that had been pointed to as causes of the great inflation that seemed to be coming into play in 2021, 22, and I think raised legitimate concerns about what would be the consequences. Now, in this chart, the black circles are PCE inflation. The blue diamonds are the unemployment rate gap, now defined with respect to the FOMC's long-run unemployment projection. And the other lines are various measures of average inflation, 2-year, 4-year, 6-year, and 8-year. And the Fed, the vertical line there, the first quarter of 2022 is when the Fed raised the funds rate in March at the end of that quarter. And it sort of met what the Fed had been talking about, and that is hoping to meet its shortfall or its employment mandate before raising the funds rate. And so we see that was the quarter in which the blue diamond drops down to 0. But at that point, inflation itself was approaching 7%. You would normally have expected that the Fed would have responded sooner, but again, they were looking at or emphasizing the employment developments. And if you look at the signals that would have been provided by average inflation targeting, some of the papers in 2019 that analyzed average inflation targeting used 8-year windows, and that's sort of the magenta
Real
line.
long-term holdings look like a lot of utilities, defensive shit.
In the first quarter of 2022,
2
the 8-year
MLPs.
window was
I
still not
don't
up
generally
to
hold.
2%.
Like I have a dividend account
so I think
that
this is
I put money from trading into,
suggestion
but
that, a long.
I don't
average
hold like a
inflation
ton
target
of
window
long-term
is probably
stuff.
too long because it reduces your
I've been in and out of the
response
treasury
to
trade
new
like
developments.
4 or
It can
5 times
delay
over the last
reacting
couple of
to,
years.
major shocks.
I haven't loaded up again, but generally
Okay,
one of my
so
buy
what are
signals is the
consequences
20-year
of
at
delay?
5.
So the FOMC waited.
So I'll probably start
before raising interest
accumulating
rates.
some
Now, in
20-year
almost all
while
our
it's up here.
models, we assume that policy responds immediately. They may respond weekly,
TLT calendar
suddenly,
spreads.
with a lot of inertia or not. But as soon as things change, the policy changes.
I have like
Policy
a Leap
stance
account. I've got
changes.
some
The
Leaps
rule
on
that
shit.
it may be following
Most of
calls
which
for a
printed
policy
this
action.
like
So,
last couple of weeks.
Mai
So
Hakamada and I
I'll probably
have
be
looked at a
closing
case
or
where
exercising
what
some of
happens
those.
if you have something like an inflation shock? So we're not trying to model COVID. We just think of a plain inflation
I think
shock. We just
economic
focus
risk
on what
factors
the
are still too
consequences
high to
of
be
delaying your reaction. So it's a very simple, calibrated new Keynesian model.
to be long
So
anything,
here's the
and I don't
response
really
to
think
inflation
that there
shock
was
in the standard
that
case.
much good
Policy
value
responds
on the
immediately.
drop. There was a little
Inflation
bit,
goes
but,
up. Policy tightens. That causes the unemployment rate to go up. That helps bring down the inflation, and
I don't
everything
know.
can
I
very
like some
decisively back to
TQQQ too.
the longer run equilibrium. So what happens instead in this model?
I usually
The
post my
policymaker
dividend
waits
account
a
in
year
the
before responding.
Discord
So they hold the
every once in a while.
interest rate constant for a year, and then they respond. Well, here's the path of inflation.
No, I own some
So
Celsius.
it amplifies the increase in inflation,
Celsius and Monster
but it creates an economic boom.
also,
Why?
which
Well,
aren't
this is a rational
dividend stocks.
expectations equilibrium. The large rise and persistent rise in inflation, when the interest rate is held fixed, reduces the real interest rate. It tends to boost aggregate demand. The economy expands.
What's a
Unemployment
dividend?
falls,
It's
but that
money
exacerbates
that a
the
company
rise
pays
in
you
inflation. Eventually,
for being an
this
investor.
is after 4 quarters,
Usually a percentage of their
policymaker
profits.
does respond. They have to raise interest
Distribute
rates
it
much more
out
because
on a
inflation has
set
risen much
interval.
more. So they tighten, and so unemployment then rises. It actually peaks a little bit higher and eventually dies down. Again, long-term expectations are still anchored throughout this. It's a rational expectations equilibrium, but not doing anything affects inflation just as doing something can affect inflation. Now, another perspective on this is to look at the price level. I think we've come to appreciate maybe that people care a lot more about the price level than we anticipated. And so one of the trade-offs faced here is the black line again is you respond immediately. Price level doesn't go up as much, but the cumulative excess unemployment is much larger. So you have a higher cost in terms of unemployment, but there's a smaller impact on the price level compared to the red line where you delay, and there's a much larger increase in the price level. So even when this is a pure supply shock, not responding has an impact as well as responding. So we do some stuff. You obviously have to decide how do you want to weigh those different things. What sort of metric do you use to decide which policy is better? We do find that policy aggression is appropriate if you have waited. And that's what the FOMC did when the FOMC started raising interest rates. I think the first rise was 25 basis points, but then they started doing much larger rises. So that aggression can sort of compensate for delay to some extent. It can help you get back. And policy aggression can be particularly important if the unemployment rate associated with maximum employment is less than the natural rate when there's a sort of a permanent distortion there. Okay, lesson 2, inflation depends on what the central bank doesn't do as well as what it does do. Policies behind
Poopy,
the
how's your
curve,
yield max
response
doing?
needs to be more aggressive. And don't be trapped by forward guidance. Several authors have argued that the delay was due to the forward guidance the Fed had provided. It's important to remember that under an optimal commitment policy, you give forward guidance, but if circumstances change, you modify that because it's a contingent promise. It may be difficult to ensure that people understand that when
Something
you
like
give that guidance, it's a
$37,000
contingent
in the
promise.
last 10
It's
weeks
based
on
certain
it.
assumptions about how the economy is going to evolve. If things start changing, then that guidance will
I'm
need to
break
be
even on
adjusted.
price.
Okay, now I characterize what the Fed did was take a gamble in delaying, and a gamble in not responding to the inflation shocks more quickly. The gamble was that longer run inflation expectations would remain anchored, and also that medium term or short run expectations would remain anchored. And Yuri
What
has
about a
emphasized
dividend
the
stock?
short
Am I an
run
investor now?
expectations. Because without a policy response, so if you're just holding the interest rate fixed, there are multiple possible paths that return inflation to target, all of which assume longer run expectations remained firmly anchored, while short-term, medium-term expectations do not. So I take a very simple stripped-down New Keynesian model just to illustrate this in a sort of finger exercises. So the black line is the shock. This is a demand shock. So the demand
I hate
shock,
those kind of funds and also love them. When equity vol is like bottomed out, they're super good value.
The dash line is the 2% target. The blue line
You're getting
is
like 20 cents a week per share.
Inflation jumps up. It comes back in period 5.
It's fucking ridiculous.
Inflation's back to 2%, and life goes on. You stay there. But that's not the only equilibrium. The black path and the red path are also rationally
getting close to filling that 5908 gap.
Equilibriums in the sense they're consistent with exactly the same shock.
I really did nail the fucking top.
For the policy interest rate.
Like to the tick, I think.
In the black line, the public expects that inflation is going to come back.
I'm just going to gloat for the rest of the day.
At the end of the shock. And in the red line, they think it's going to come back to 4% at the end of the shock.
Somebody say yield max.
Those three paths all solve.
So I bought yield max back in March.
In the model, and they differ only by
and then
what we assume about expectations.
Doubled down on it
the shock has gone
when we dropped, like when it dropped under like 12.
Black and the red line that inflation becomes much more persistent.
So I'm like 10 weeks into holding it,
of short run
and it's been averaging like
and so
anywhere
sort of
from like 24 to
blue line.
like 15 cents a week.
You know, I think it's a dangerous gamble because here's the 1 year, this is based on the 1 year inflation expectations from the New York Fed, the distribution across households. We can see that in January of 2022, over 70% of households thought inflation would be greater than 4% over the following year.
You mean VIX 3-month under 16? I don't think we're going to get that anytime soon.
When the Fed did finally respond in March of 2022.
No, not PAX.
And so, you know, if they
I've been Ulti and Misty relatively strategically. They're not bad if you understand the dynamics of the funds and how to take advantage of the
and this implies the effects on inflation,
like the IVHV spread and the underlying.
Eventually risk de-anchoring longer run expectations. And I think an important
what's the best way to tell when equity vol is low?
Was when Chairman Powell at Jackson
market
Hole in
down
2022 made it clear that price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy.
Could we fall below 5908?
Until we're confident.
I'm not sure we filled the gap. Do we fill the gap?
That sort of message is very strong to emphasize.
Sure. Yeah, we can fall back to like 5,900. Although I feel like if we do, we're going to get big support.
Okay, and then again, here's a recent, another picture.
Get divvy, sell before drop. Yeah.
Where that Michigan response.
No, I'm not reinvesting it.
The New York Fed survey.
I just want to see how long it'll take to pay me my money back.
Sort of look like they're inching up.
If something negative happens economically, I'll just sell the position. But
been resolved just yet.
Okay, I've shaved about 10% of my buying cost off in 10 weeks, which isn't bad.
I surveyed a lot of these at a Jackson Hole paper in 2003.
So like while I'm break even on shares, I'm up 10% on dividends.
You should overestimate the persistence of shocks. That was a problem in the 1970s.
A little more than 10%.
Underestimated the persistence of shocks. It was also the case in the recent inflation surge. There's lots of uncertainty about what the persistence of the shocks will be, but you may get a more robust response if you sort of pretend they're going to be more persistent than maybe in your heart of hearts you really believe. The same
Jesus Christ. I don't want to read about Diddy's
applies to
doings.
endogenous persistence. A paper by Levin and Williams many years ago showed that backward-looking models are more difficult to control than forward-looking models, and you can get more robust policies if you sort of assume things are more backward-looking than maybe you really believe. And that's another thing in running scenarios and evaluating alternative policies is useful to keep in mind. And then finally, another reminder of the Hansen-Sargent work on the beware the evil agent, that there's an evil agent out there that's going to try to make you look as bad as possible. And so what's an evil agent going to do? It's going to hit you with a supply shock just when you're already trying to balance inflation and employment objectives. And so you have to be prepared for that. Okay, and lots of new challenges. Don't need to list those. I think everybody has their list. So lesson 5, policy framework should be robust to changes in the economic environment, employ scenario analysis and stress test proposed policy frameworks. And remember, objectives are often not complementary. The policy statement tends to emphasize the complementarity of objectives. They're often not. Making trade-offs is tough when they're not complementary.
Too early to call the end of day price.
Preferences where you elevate one preference.
No, I would say probably between 5,900 and 5,905 at this rate. But
I discuss this more in the paper.
We could bounce back up from
if
here.
we're going to assign
and close at the high.
Broader responsibilities, including.
Yeah, I mean, I guess it's a little too early to tell, because if we slip into 5,900, the positioning is going to change quite a lot, especially if we sit there a while.
Whether monetary policy is an effective tool for addressing them. Okay, so let me just close with a picture that, and I have to attribute this to John Cochran. I first saw it at a Hoover conference a year or two ago. So here's the 1970s great inflation.
I've never liked bros, but
January
I could take a look at
70.
it. It might be.
The horizontal axis counts months since the beginning of the inflation. We see the two big spikes associated with oil price disruptions. And now picture yourself in 1976, that's 80
but Ulti in particular, I was like, if I had
inflation
all
has
those
come down quite
longs, I'd
dramatically
do that
from the
anyway.
peak. You may be
So it
thinking
appeals to me, sort
about
of.
the
I mean, you
woods.
make way more money
Inflation is still
selling
base
spreads on the
standards,
underlying
too
than you
high,
would off of
but it looks
yield
like the
max,
worst
but
is
they
over.
just
And
kind
then
of
you
do the
get this
work for you.
Big shock. Okay.
And you have a little
Now, here's the
less
recent,
drawdown risk.
inflation.
Not much less,
It
but
looks
a little
kind
less.
of similar.
And yeah, the
It's a
decay is
lower level
atrocious.
because inflation had been anchored successfully down at lower levels. And now we're sitting down there at the trough, and will the next 12 months keep us down there, or could we have other shocks that might push us up
WiMAX.
into the 70s? So
WiMAX or Ulti. I like WiMAX
your
better,
job
but
it's not over, and more shocks may be in the future. Thank you.
I don't watch spreads like a hawk. Just sell them further out.
Thank you so
don't
much,
have to
Gar,
worry
for this
about 'em so
presentation.
much.
Ken Rogoff, 15 minutes to discuss it.
Kava, I'd be a little bit more interested in.
Well, thank you very much. It's a pleasure, first of all, to be here. I was also a discussant in 2019. I'll maybe come back to that. And the first thing to say is it's just an incredibly sweeping paper, really encyclopedic. And I don't know how you read all those papers, Carl. It's incredibly concise. Carl, of course, is the author of one of the great textbooks graduate textbooks on central banking. Many of you have seen it, and you can sort of see this clarity and organization coming through it. I describe it as a master class in central banking. And it covers different kinds of models, different kinds of empirical approaches, has some important history, and also takes into account credibility issues, which are often ignored. It is quite understated. You heard it sort of through his comments, and I will take it my job as the discussant to bring this out. If I ask, what purpose will the paper serve, I think it's very important to sort of mark what we were thinking in 2025. Maybe we'll, nail it this time on the policy framework, we being the Federal Reserve, maybe we won't. But I think it's a pretty good representation of what people were thinking, and not to forget that. And I'm going to come back to what people might have been thinking in 2019. So he goes over a lot of the recent literature where people are particularly trying to deal with the zero lower bound and what are different approaches, and talks about average inflation targeting and asymmetric average inflation targeting. One place I think where there really has been quite an advance now for a long time is in new Keynesian models, the ability to capture many things. One thing, you can do credibility in a much more interesting way because they endogenously capture what problems you might have with inflation. Now, a theme Carl picks up quite a bit, and it's come up again and again in this discussion, is the struggles of having a dual mandate when inflation you kind of measure, but maximum employment, full employment you don't. It's difficult to estimate, and that just presents challenges and how to deal with it. He spent some time comparing the 2020s with the 1970s. He talked about that at the end. But I think an interesting comment he made about the 2020 framework was it somewhat flipped inflation and unemployment and the relative importance. If you were doing an honest assessment of what the economics profession was thinking at the time, that's what they were thinking. So actually there's another survey one can find of AEA members from gives 2020, 2021, and some intermediate years, and ask them, what should the Federal Reserve be doing? And so in 2000, I might get the number right, but something like 75, 80% said inflation, and then their secondary targets like unemployment, et cetera. Same question, I don't know who the 20% who weren't thinking it was inflation are, but it's the American Economic Association. And it's flipped in 2021. Nobody thought the Federal Reserve should be concentrating on inflation. And in my experience, that was very much where the profession was. They just didn't think it would happen. And I can certainly say in teaching, trying to tell people that they should be studying inflation, and maybe fewer of you are young enough to be taking courses at this time, I would teach it, the students would listen patiently, and it was like I was telling them to listen to Frank Sinatra, the music of another generation. And people will say things, you heard it. It can't happen in the 21st century. The internet makes it impossible, et cetera, et cetera. So but I think it's important to put in context, the pressures that were coming in on the Fed and setting up this framework. And again, I think, Carl's paper is very much where we are today. Now, he is, I think it's even a little understated to say a robust critique of the Fed's response in 2021, 2022, and he had to do that for his professional credibility. And I think it's welcome that the Fed has that as this is a central paper at this conference of let's, admit something went wrong. And I'll first say what Carl had to say about it, which is he, basically goes through a lot of models and different ways of looking at things and said almost no matter how you look at it, you should have raised interest rates faster. And he mentions the Taylor rule, for example. And I think there are a lot of qualifications one could nitpick. The Taylor rule depends on having an R star, which was moving all over the place and still is. But he considers a lot of things, other rationales for the slow response, and he talked about the consequences of delay. That's a theme that's come up already again and again to move very quickly afterwards. And then he's pretty tough. This is on the mission creep, talking about inclusive expansions where it's hard to know how to interpret that. I'm going to give a little more generous interpretation because I know what I was thinking and what I was saying at the time. And I do feel there's a certain amount of Monday morning quarterbacking to we economists coming in and saying, what should they have done? Start with the pandemic. There are some very nice papers on this to which some of the people here contributed, but was it more a demand shock or a supply shock? Was it a demand shock and a supply shock? It's very fundamental to thinking about how you react to it. And we have gained knowledge partly because we understand the virus better than we did. I think it was very unclear deep into it that there wasn't another leg down, something else going on. What about the Russian invasion of Ukraine? Did we know that was going to end in a stalemate? Did we know Russia wouldn't use at least a tactical nuclear weapon, at some point? I didn't. And so I think, you have to kind of understand this uncertainty, and especially to say we need to be tough on inflation. Well, let's go back to the last crisis where the whole lesson was we don't need to be tough on inflation. The ECB got in a lot of trouble for raising interest rates, epsilon at one point, trying to fight things. I won't name the person, but you can look it up. I mean, there was a very smart Fed member who was commenting the day after Lehman, we've got to prevent inflation from getting out of control. And it was like, who knew exactly what was going to unfold? I would use a chess analogy, if you forgive me, where when I was a young player, full of myself, I'm probably still full of myself, but there was a young chess player.
My business economics professor in college. They teach because they can't make it in the real world. Sometimes that's very much the case.
Beat somebody where they would make a mistake on move 32, and I would think, they're idiots. I could beat them. And then you play them and realize you're not getting to move 12. I mean, there's many steps, there are many decisions, and you can kind of focus in on one thing, that you did wrong. And I would just want to pick up on a theme. I'm going to come to more in a second. But
25.
Mark has this wonderful paper with Jordi Galli.
I called the top.
Science of monetary policy. There's also the art of
tech.
monetary policy. There's just a lot of unknowns that make it difficult. So let me pick up on some of Carl's conclusions and just highlight some of them. And I think one of the, the first one kind of makes a lot of sense.
As long as that thing
when
isn't
policy
made up,
gets behind the curve, it needs to move
economics.
faster. Yuri said that earlier. A lot of people
or
had
chiropractor.
Okay, I don't want Ben sitting here. I don't want to get in a long debate on forward guidance, but there's sort of a question about, in the literature, about who's listening to the forward guidance besides the Fed.
Just say witch doctor.
Does it constrain people?
I feel like witch doctors actually have more real remedies than a chiropractor.
My last slide will speak to this, but you want to be an independent institution, you've got to bend with the wind. And the idea that the Fed is completely independent, and if everybody's criticizing, they're not paying enough attention to the environment, to inequality, to social justice, and you want to stay independent, and you want to keep monetary policy independent, it's not so easy. I mean, Kevin Warsh wrote about, spoke about this recently. But on the other hand, it is true. If you have mission creep, do something where it's really making it more difficult, and arguably the inclusive expansions is pretty vague of what that means, but it was written at a time when no one thought inflation was going to happen. I will just mention, since I'm here, I think when I spoke in 2019 and I was told I was invited, we appreciate your work on negative interest rates. Please don't say anything about it at the conference. I might have said something in passing. And I personally believe—
Me too. Thank you so much, man. Welcome to Cornichon, guys.
You can look at one of my recent AR with Paul Schmelzing and Barbara Rossi, where we show it's very volatile long-term real interest rates. We probably never should have thought they would always stay zero after the financial crisis.
Why is Netflix at 1,200?
But if you did think they were always going down, I think there's really you need a better tool. We heard earlier, Yuri, in the survey, maybe Carol Corrado said only 20% of people believe that they have the tools. That's probably correct. I think that's actually right. And we need to, I think I don't think anyone's done negative interest rates in the right way, and you don't have to get rid of cash, and it's something to think about. Okay, I said it. So clearly, the elephant in the room here is central bank independence. If you're preserving central bank independence, and I don't just say this now, I've been saying this for a long time, I mean, that's really the core of doing a good job. If you preserve central bank independence, you can make mistakes, you can come back from your mistakes. And I think something Carl does very well in this paper, again, in a very understated, subtle way, is remind us that the pressures on central banks might have been in remission, but they've come back. There's a lot of papers which just ignore this now because we didn't seem to have any inflation. And I think it's
made a bit of money on puts just now. Important. Thanks, Gamma Strike. Yeah, nice, dude.
It's very hard for the central bank.
What do you think of the 5935
island of
AM contract?
Competence in a sea of political turbulence.
Who's Kurt?
You just, have to think about that. And just as
Netflix announced yesterday that they have like 90-something million subscribers on their advertising supported platform. So people are paying them money to show them ads.
And fiscal policy expectations in the current environment. I won't even mention tariff policy, but you're not alone. You're operating inside this larger environment. So I do think having an
Gherkin, remember when you nailed the top tick? Good times. I do. I haven't forgotten.
On average.
Thanks for reminding me, though. I'm still really happy about it.
I will say when I did my 1985 paper in the QJ, which I wrote in 1982, it took me forever to get it published. I got it rejected at every journal.
Do you have on the yield max subject? Not important, just interesting.
Who believes this? They're not really independent. We can debate that, but I think it has been very effective. And I think in designing the monetary framework, we need
what the fuck does that fund do?
Robustness, not just to a supply shock or demand shock, but this larger turbulence.
Oh, that's just because of near-term performance.
Pretty simple things that you're trying to stick to.
From an income perspective, they're totally different. Almost everything will beat yield max in like net
Thank
returns.
you so much.
Because you have the decay.
I think my impression is this is fantastic.
Yeah, it's a reputable. It's just a growth fund.
Possibility to exchange.
It's just high growth.
With the two panelists in the next 30 minutes.
Super index sensitive.
So I'm gonna give you a card. You have,
but the index is up fucking 15% in like 2 weeks, so it looks amazing right now.
A couple of comments. One is
30% on that fund.
Thank you. Let me just make a couple of comments.
But it also ate shit on the drop.
I
was
really
down
agree
26%.
With the points that Ken made. Just note that back in 1999, right after the clearly Golly-Gertler famous paper on science of monetary policy came out, I wrote a piece, an economic letter for the San Francisco Fed called "The Art and Science of Monetary Policy." So I fully agree. Our models give us a science, but that can't be all. There's an art aspect of understanding how the data, what the data mean, how they're coming in, and how you put it together to blend them with the preferences, the objectives you're trying to achieve. And with respect to mission creep, I wrote with Federico Ravenna a number of papers involving search and matching models of the labor market and new Keynesian frameworks. And when I started that research agenda, I thought it was going to help me understand better why the Fed should focus more on the real economy. And Jim Bullard gave a talk at the Ford Foundation.
Talk more about how great Keynes is.
Papers, and his title of his talk was "The Unpleasant Arithmetic of Unemployment Targeting," I think, because it turned out the models suggested the monetary policy was just not an effective tool for addressing the fundamental distortions in the labor market. So I think with all expansions of the objective, the important thing is to be able to be clear about what it is you're trying to address. And so some things like climate change, it clearly carries financial risks, and financial institutions need to be aware of those risks, and that falls
It's kind of
into
funny how
the
they openly
Fed's,
refer to themselves as Keynesians. Like, they
within
don't
the-
realize
the
it's
venue
essentially
of
a
the
slur.
Fed in thinking about
No, they're
how
really proud of it.
climate risks affect the strength and fragility of the financial
These are the
markets.
people that went to college and, like,
our
when
labor
they
market
brought up
distortions are
Maynard
more like
Keynes, they
imperfect
were like, this
competition in the
guy
goods
is
market,
the
where
Einstein of my
that
field.
reduces the natural rate relative
Because,
to the efficient
I mean,
level,
I'll be
but we
honest,
don't
in
think
like
the central bank
undergrad,
really do
which
much
is,
about that. And so being clear about
which is where
which
most of these people learned
extensions of the
everything.
mission make sense, is
They
very
really,
important.
they really
I
don't
think that's part of
explain
the
like
legacy
the
of
bad
inflation
part
targeting. You
of
wanna be
Keynesian
clear about what the
economics,
objectives are
like how the wealth gap has never been fucking wider, or how we have to keep bailing out banks to prevent economic crises
I can't believe that.
with taxpayer money. But it's fine, right? Because like the fucking little needle just keeps going up.
Julia.
So,
That's a Kool-Aid fest in undergrad econ. Yeah, it is. I fucking hate these people. Like everybody in this room.
The
They're
full
the
employment
worst.
mandate as mission creep, or to say that monetary policy is an imperfect tool.
So much
for
pressure for
addressing,
6K tomorrow. The Bulls
distortions.
really want it.
I think, like, if we
I don't think
zoom
there's that
back
much
out to
pressure
the
for
historical
6K.
perspective, the
What
central
weird porn are we
banks
watching here?
were
Oh,
created
JFresh. You missed
in the
a
aftermath
2-hour
of
speech
crises
on
to serve the
non-linear
public
Phillips curves
The dual mandate was
versus
added
linear Phillips curves.
legislatively through a democratic process to hold the central
And
bank
why that's the
accountable for
reason that our economic
that
models
outcome.
aren't as good as they
So
should be.
it is part of the Fed's mandate to serve the public interest. It doesn't have to be the perfect tool or the only tool. It is part of the mandate. It is not mission creep to explore the ways that it can achieve that or the trade-offs that it faces. I think Aysegul's work is an important step forward in connecting them and thinking through the dynamics and the trade-offs in real time. But there's this sort of implied criticism of the Fed's framework review last time that, it was sort of looking in the rear view mirror at a zero lower bound episode. But I think that critique of describing it as mission creep is also subject to the potential danger of looking in the rear view mirror. Conditions
I used
change.
to work with these
We
kinds of
need
people. It drove me
a
into
dynamic
Asperger's.
framework to explore the interactions and the trade-offs between the dual mandates.
Got an undergrad at
That doesn't
Harvard for
always mean leaning one way.
$150K that you could have got for
It means
$1.50 in late
exploring
fees
those
at the
trade-offs in
library.
real time
Yep.
in a sensible way, but in no way throwing that mandate
Cool.
under the
So
bus.
expectations fudge factor wasn't enough. Just keep adding more until it fits. I think you're ready to take over at the Fed, JFresh.
Let me say boldly, there's no AIT in fate. Absolutely not.
If your model
We started
doesn't
half a
work,
sentence
just
in the
make it
strategy
fit.
Statement that we're doing average inflation target.
American
Cross that out.
Economics 101.
Take the second half of the sentence. What they promise to do is, after persistent undershooting, to overshoot modestly and for some time. Okay, this is simply.
Do you
lower for
guys
longer.
believe that these are the people that decide what
What they
happens
promised to do before.
with our
That's all
banking
it is,
system?
lower for longer. Don't confuse it by calling it average inflation target. There's no identification of a cumulative shortfall, no rule for how to get it back. Okay, it just isn't fit.
I'm going to collect another.
I haven't
questions.
watched Good Will
Joe
Hunting
Pan-
in like 20 years.
Thank you. Joe Gagnon, Peterson. I worry that there are...
Actually, yes. Knowing the history of our banking system, they're exactly what I expect.
For some good reasons and some bad reasons, and we could learn something about that. I've actually written on that too, but it seems to me that we don't want to put too much weight on a once-in-a-century shock when designing our framework. So it seems to me before COVID, we had learned some lessons, and I think they still
You
may
made
be
a
valid
stream
in the
code
future.
reference
So I
to
wanna
Good Will
align
Hunting and
myself
Dork
very
getting
much with
engaged.
what Chair Powell
True.
said this morning, and based on his speech in 2018 on the stars of monetary policy, we need to have some humility as to where the stars
I'm going to need
are
the
when we're
economist slander to
designing policy. And
end.
I
I'm
think
feeling personally
exploring
attacked
the
here,
idea
and
of
this is no
maximum
longer a safe
employment and
space.
pushing,
Although I did leave the
you down
field,
to see
so
how far
maybe
you can
you're
go without
right.
causing inflation was exactly the right thing to do at that time.
So what are you going to do with With all
we
your
just have to have
mathematical
some humility.
modeling
we
knowledge.
want maximum employment, not stabilized employment. We want the maximum employment. So I think that's important. That's what the law says. It doesn't say stabilized employment. It says maximum employment.
We're at a history
and
book.
I think we saw this morning that if our one reason I think that this was a problem is when we
This is our
do,
third
for
once in a
example, there's many
lifetime
things that can go
financial
wrong, but one is if
crisis.
we have a linear Phillips curve. And we
Fourth?
estimate
Is it the
U-star,
fourth one? Oh,
we're
God,
gonna be
it's like the
biased.
fourth one.
It's going to be the estimates are going to be too high. That's very easy to show. We saw that, I believe, in the paper this morning. And so that's why just aiming for U-star isn't good enough. We want to see if we can do better because we have a reason to think.
Keynesian
we may actually have a
economics
long
is so
list of
great
U-star.
that we
We
somehow
shouldn't forget that.
used a financial crisis to
I'm
create
gonna collect
another
another
one.
questions in the back before you answer that.
You focused heavily on strategies regarding the policy rate, emphasizing the need to be robust and nimble.
Would you be surprised if I've gone back to 1997 and still can't find out how they estimate population between censuses?
Is inherently a less nimble tool. What are the implications?
It's
for,
easy.
QE strategies?
You just take the birth rate and the old census, right? Birth and death rates and then the old census.
On the mission creep, I guess that was a bad term to use. It was
That's how
meant
I
to
would do
be,
it.
Not meant to indicate that you don't want to try to.
We know how many people were
explore
born
what
and how
is
many
the
die.
maximum employment level. I'm really concerned.
I'm
about
assuming they
saying,
don't do
well,
that.
we have this mandate, but we can't measure it. Not that it's hard to measure.
Do they
but
just
we
check
can't
the change between two censuses and like
that's,
add that?
one of the purposes of objectives, like the inflation target, quantifying it, is to serve as a performance
Those have to account for
measure.
population
How do we know-
movement between
how can the
economic
public understand
zones.
whether the central bank is sort of doing what we want it
They
to
do.
We don't ask the central bank to maximize social welfare.
I-
We do in the
I've
models.
okay, so
But
you throw
we
in
want them to have operational objectives that allow
expatriation
people to understand
and
whether they're
immigration.
performing well. And we have a theory of index numbers and various price indices we can choose from, but it's important to focus on one so people have a reference point. And you need something similar with respect to the unemployment rate or the
There's still
employment
people
rate
that are
is gonna
uninsured, though.
correspond to whether you're successful in meeting that employment.
I think it's like a
I
decent
think
chunk of the incorrect population.
The issue of Joe's point is that, you know, it's fine to say, okay, we want to see if we can push the unemployment rate down a little bit without inflation arising. But that's an experiment. And what you have
8%
to think about is,
estimated.
well, what if we do that and we're hit by a commodity price shock? Are we going to be more vulnerable in recovering from that? Are the inflation consequences?
I
gonna
did
be
policy
much
in the boring
larger?
congressional backrooms,
That's
but
part of
now
the
much
cost
of what I do
carrying
is
out the
convince people to
experiment.
vote against their
And so I
interests
think
to an
you have to
extent.
be, you know, sort of
Nice,
think through
yeah,
those
strategy.
scenarios. You don't just want to say, let's use our existing models, no other shocks, we just kind of
Moo moo, WeBull. We need something called bear attack or bull meat.
whether that makes us more vulnerable.
Thanks, Squams.
Should some shocks arise. And pardon the reference to literature, but Elizabeth Gaskell in her 1855 novel, North and South.
JFresh, do I want to know why you're looking back through census
reminds
reports
us
till
that the storms
1997?
We'll face will come from unexpected directions.
No.
And
I'll
I
answer
think
my own
that's really
question.
true.
No, I don't.
Nobody expected COVID. Nobody expected the war in Ukraine. And so we have to think about, you know, if we're
Why are my
what if we are hit
5,900
by these
Ps
things
losing
that we
money?
hadn't expected?
Well, because
do
we're
you think
going
our
up.
Framework is robust enough to help guide
So we
us
bounced
in
on
how we
support,
respond.
which I did warn you about.
Oh, and just Larry, so the 2020 statement does say average inflation targeting. So, but it also, yeah. Oh, Chris, I didn't respond to Chris.
Why make money that way when
Balance
there's
sheet
so many
policies
other
are too
ways? He works for your party.
Okay. Hey, Ken, you want to offer some thoughts? No? Okay. Well.
To figure out how they estimate population. JFresh is an economist now. No, don't ever call him that. That's rude.
There's a question.
I wonder if
he
you
would
could
be
talk
very
about,
offended.
not just the
But he
policy
is.
framework,
Yeah,
how
he
it
is becoming
actually
one.
Operationalized, because you could have the framework and you could operationalize in a different way than the Fed actually did. If you remember, there were 3 conditions for liftoff, and there are some additional conditions added that we can't lift off until we've ended the QE.
This is why
but we
JFresh
can't
would
end
ban
QE
everybody.
abruptly. We have to taper it. You talked about how the monetary policy was operationalized and any changes that you would recommend in that sphere.
Yeah, that's.
So I didn't
Actually, the
directly
Fed's
address
forward
that. I was
projections
looking
of
at sort the broader
inflation
framework,
have
and
been
thinking-
0%
my perspective is-
accurate.
But I mean, you do sort of
over
argue
the
it wasn't
last
much of a
5
constraint.
years.
I mean, that's what the literature says, that it was asymmetric, but it didn't seem to matter that much.
I think the, my sort of overarching concern is, will the public understand what?
At least
the
he
Fed is
provides
trying to
actual
do?
value, like technical analysis on
Maybe
the VIX.
Yuri's evidence just, it's hard to know what the.
Oh,
public
speaking of which,
knows.
just VIX popped up on G-Scan.
How you operationalize it once you define these objectives. That's.
It's in bear
getting more into the
consolidation.
nitty-gritty than I generally dealt with, so.
I mean, Yuri's papers on this are wonderful about how little the public understands and, how much it's like
It's actually
talking to
kinda
your dog,
interesting.
and it's
Was VIX up today
seeing
still?
your mood and not
No.
really knowing, they have no idea what you're saying.
Well, I think this is a great way of ending the session. So thank you so much, and thanks to 2 speakers for these great presentations.
Thanks.
I'm curious.
Oh, I mean, it's a great paper.
Oh my god, I can't believe they're going to have one more session. Right when you just thought session 3 was the end. Nope. Why are we watching this? Because it's the meeting on monetary policy framework that will decide the Fed's the presentations in this meeting are going to decide the Fed's mandate for the next 4 or 5 years. And how they approach their mandate. So it's actually really important, but super boring. Einstein's theory of relativity is not holding science back. What? It's not the same. GPS would like a word. No, not a date with a man. A mandate. Remember my buddy had a mandate at a bar the other night? Oh, God. A collection of economists is called a boring. That was good. Someone always gets me, just once a day, at least. That was fantastic. I'd love to mandate you. Thanks, McChuggets, but I'm not available. Sorry. I'm coming outside for the rest of the day. My mental health can't handle another speaker. Thanks for your help, Greg. No problem, Bull Bear. I'd rather listen to 8 hours of this than one White House press conference. On a scale of things that are made up, this isn't as bad. But GM isn't moving up much. Interesting. I just don't think it's driven that heavily by options. Like, all the options are just in the monies. I don't know, maybe like the delta decay on some of this shit. 516 expiry, 620, 516, 620. So yeah, as all these positions start to fall off, then maybe it'll pull back. I don't think you're seeing gamma move up because there's just like not much gamma being bought out of the money. But all of this shit's gonna fall off. So maybe wait for Delta to start turning, or maybe Delta is just gonna start turning around into this apex next. Yeah, well, gamma there's gamma above spot, it just falls off really steeply. Not much. But this'll expire. And then the curve will smooth out and it'll probably pull back. It's just like a lot of near-term shit. But right now the charm from the in the money delta is probably propping it up. It's just no one's buying out of the money to bring gamma max higher. I'm sure it's not lost on you, but there are many people here who choose to spend 40 hours a week listening to you. It's quite remarkable. It's slightly less than 40 hours. Well, I guess if you throw in the Sunday stream and the Pickles picks and the round tables, then maybe it's a bit more. Is the UNH straddle gonna be the overnight 0 DTE play? I don't know about that. Maybe. It's definitely volatile enough. It would be expensive, though. Over 28 hours a week, by definition, is a cult, FYI. Hold on. Where are you getting that from? What's the source? That would mean that every job is a cult. Teaching me is like trying to get a round table through a square hole. Heckin' like you guys a whole bunch. We like you too, Squamsk. Universally. If more people were like Squamsk, the pickle jar would be a happier place. Take some time off, eat some parking lot berries, slide down your stairs on an old Amazon box. Don't give up on being a child. Even if you're an adult. Mine's around 80 hours listening to Gherkin. I replay the stream at night, imagining what it would be like if he mandated me. God damn it. Jesus fucking Christ. I feel like I need to explain what mandate means. It's not a date with another man, okay? Like Chuggets. It's an official, like, order or the authority to carry out a policy or course of action. It's no, not official order to date another man. God damn it. Where did the population go this year? Have people just been dying and we don't know about it? Like, I understand the drop in population from COVID. Although, I'm not really sure I understand the spike. What the fuck is this? Okay. JFresh is right. Now I'm intrigued. No. Look at this shit. This is mind-boggling. Look at total population, all ages. COVID up. Total population went up. Then dropped massively into the end of COVID. Then rose all the way through mid-2024. And then dropped dramatically at the beginning of 2025. Measles deaths? The two drops don't make any sense. They rolled them all off at the same time? This must be the time. This must be when they update it. Oh, how often is the... It is rate of change. But the rate of change post-COVID was negative. How many babies do we need? I'll do my civic duty. I don't know. Just call your local factory town and see what they're hiring for. Did they stop tracking births since those aren't citizens anymore? Oh, what happened with the SCOTUS ruling today? Did SCOTUS rule unanimously that the president can change the Constitution? I just need to know when to buy my tickets. Bot puts to the downside again. 59.10.05, 58.95. Bot calls closed at 10 and 05. US needs 4.7 million births per year. That's a lot of people dying. I think maybe they just don't update the data frequently. Like maybe once a year? It's clearly not quarterly. Maybe it is. Doesn't look quarterly. Every 6 months. You're looking at census population data. That's annual and also lagging. Okay, so it is annual. Yeah, I know it's, well, at least the lagging makes sense. Yeah, JFresh is trying to figure out how they calculate it. But the census is only done every 10 years. So he wants to know how they figure out how many people there are in between that time frame. First they take a chicken, then they place the beheaded chicken on a grid of numbers. What's up, Wookie? Yeah, I'm hanging in there. It's been a fun day. Head and shoulders. Is it? Almost. Oh. It's not. Well. Kinda is, though. Let me look at ES. It's more of a head and shoulders on ES. Is there a working Discord link? Yeah. In the description of the video and also on the main channel page. I could put one in chat too. Oops, I accidentally just closed fucking Discord. Have you been in the Discord before? I just updated them all today, so it should be working. Here, try that. If that one also shows as invalid, you're probably, like, banned or something. Oh, okay. Population's monthly. CPI is monthly. Okay. productivity is quarterly. This is monthly population. It's total population, all ages, including armed forces overseas. Invite invalid again? Are you in the US? That shouldn't matter. Are you using like a VPN or something? No, there's plenty of people in the Discord from Canada. Hold on. It's got to be something on your end. You might have reached your server limit. Some sort of blocking of your IP address could also cause it. Nope. You found it. Yeah, you can only join up to 100 servers on Discord. I'm gonna make a new account and try again. Okay. Oh, my server has 2FA also. Maybe that's what it is. Give me a rundown of the new charts you have at the bottom. Yeah, over here you got IV curve, or the IV smile. And you have total volume, puts and calls. And over here you have gamma exposure by strike, and then gamma at each strike. A comprehensive explanation can be found on the Gamma Strike website in the documentation section. Yes, at app.gammastrike.com. What do you think of Target here? 5% dividend. I know it could have another leg lower with a beat-up consumer, but start moving into more of a position. Are they still being, like, embargoed by people? For, like after they canceled other DEI programs. And then also still very exposed to discretionary spending, which is a problem, especially if we're getting more layoffs and there's recession fears, and we're definitely getting more layoffs. The macro doesn't sound right for it. And supply chain reorganization, because 90% of the things they sell come from China. I wonder how efficiently Costco is going to manage reorganizing their supply chains. Walmart CEO said they're forced to increase prices late this month and massively next month. Target's going to be worse? Could be, yeah. That's the options tool that we built. Options data. You missed all of this. It's been a whole thing. Mean absolute percent error. The total estimated population change over that period was 2.6%, but the absolute percentage is 2.9. Guys, the population's grown at 2.6% with a margin of error of 2.9. That's beautiful. Does this guy work at the Fed now? Sounds kind of sussy. Are we pumping into close? Define pumping. There's still a lot of bot puts below spot. This don't seem to be shaking out. Almost everything up to the upside is sold calls. There's a shitload of support at 5,900. But we're going to probably need to see more sold calls or sold puts to get any higher than 20. I don't think we're squeezing to 50. That'd be weird. A lot of women around me refer to me as a tool. How do I go about finding a good price point for my services? What are your services? Is there an association of Nemethy with an aggro to 5950? What? Why doesn't all that negative delta at 6K falls off the chain at market open tomorrow? Why wouldn't that delta just fall off in the overnight session? I provide data. What's the means of transmission for that data? He's a competitor to Gamma Strike. His icon's an Arthur Diamond Fist. I don't think I'm worried. Their AM expiration. That's why. Hmm. Eh. Probably doesn't matter. Hmm. Rejected a little bit off of 17 there. Bot calls at 19 and 15. Some bot puts coming in at 15 now. Bot calls at 20. Doing a little back and forth. A lot of puts selling to the downside. Some puts at 15 and 10 being sold. Puts at 5,900, 5,895 selling off. But still more bot puts coming in at 15. So maybe they just juked out a bunch of the put interest. If we slip 5,900, we could drop all the way down to like 5,885 before finding support. It's looking spicy. More bot puts at 15. Look at that. Bot puts did damage. Slip 10 a little bit. We probably need to lose 5907.90 for a bigger failure. But we left a gap at 11, which we didn't fill on the bounce back, so we'll probably get another low. or earlier support. It wasn't very many bot puts. It was like 200-300 bot puts that did that. Could have been the massive pile of 5920 calls that closed. Low liquidity, Trump backing down, too many bears, exaggerated moves. Yeah, that can happen. Although I wouldn't say that we've seen anything very exaggerated yet. We could end up closing the day just fucking flat. Especially if we drop back to 85. There's a new low, but still no loss at no loss at the 5907 level. Mm-hmm. 20% a month? Isn't that exaggerated? We thought so after October of 2023, too. And at the beginning of 2022. Happened a few times. August of 2020, well, June, August of 2022. See what happens if we fill this gap. It's like right here. Let's see. White House fact sheet. Emirates Global Aluminum will invest $4 billion to develop primary aluminum smelter project in Oklahoma. White House, ExxonMobil, Occidental, and EOG partner with ADNOC, the expanded oil and natural gas production valued at $60 billion. State of Wisconsin Investment Board exits Bitcoin ETF position. SEC filing. U.S. Commerce Department, a new comprehensive 5GW UAE USAIA campus in Abu Dhabi is unveiled during Trump's visit to UAE. World Economic Forum chases Christine Lagarde as its next leader after the founder's abrupt exit. The Trump administration targets Europe's digital laws as a threat to basic rights and U.S. business. It's been a busy day. Busy day for the Trump administration. Remember when I told you guys yields were getting too high and they were going to start spinning up the lack of a EU trade deal like 2 days ago? They're starting to spin it up. Russia deploys 640,000 troops in war against Ukraine. Gap filled. Yep. That's fake news. The peace talks are going tremendously. Yeah, they are. When everyone looks left, you go right. Give me a second. I'll be right back. It's almost like high inflation and bad economies lower the birth rates. Oh, shit.
In addition to being a finance professor at HBS, he's worked for an, should I say, esoteric list of institutions, including the Lehman Brothers, the New York Fed, and the US Treasury, where he served as a special assistant and liaison to the White House National Economic Council. With that, let me turn it to Savannah.
Thank you very much, Annette. So thank you very much for having me in this conference named after Thomas Lovac. Thomas was a phenomenal economist and a role model for many of us who started our careers as economists at the Federal Reserve System. So I will talk about unconventional policy tools at the Fed. That was my homework. lessons from theory and practice. And this is based on joint work with MOASS, who's here from Oxford University. Let me start with a very brief motivation. Unconventional policy tools have played a central role since the global financial crisis, and they were extensively used during the COVID pandemic. As part of the Fed's policy strategy review, it's important to evaluate their design, transmission, and effectiveness. So we focus on, in our paper, on the two most important unconventional monetary policy tools used by the Fed: forward guidance and large-scale asset purchases. In my presentation today, I will first briefly discuss the theory and evidence behind these tools. There's a more thorough discussion in the paper for those interested. Next, I will zoom in on the 2020
Meta delaying the rollout of its flagship AI tool,
Behemoth, from the actions taken by the Fed during this period. And finally, I will highlight what we think are the main lessons and some of the open questions that require more research. Just to be clear from the outset, our focus is not on the appropriateness of the monetary policy stance taken by the Fed during this period. That's part of a separate discussion. Our focus is on the tools themselves. Are they effective? Should they be kept in the toolbox? How can we improve their design? So starting with forward guidance, understood as central bank communication regarding the future path of policy or the economy. It was not new or unconventional. The Fed had started using some form of forward guidance back in 1999.
Damn, Meta down like 130 points already.
The global financial crisis. The literature has distinguished between two conceptual forms.
Well, that's not going to be good for the index.
Odyssean. Delphic guidance entails a forecast of the likely future path of policy without any commitment. And this consists mostly of communications of the Fed's reaction function. By nature, this Delphic guidance is state contingent.
Meta's delaying the rollout of their
the second form
new
is
AI
Odyssean,
model, Behemoth.
Which consists of stronger guidance with at least partial commitment to a policy path. And that commitment is often time inconsistent. It goes beyond the boundaries of the mandate. Now, what we define as Delphic or Odyssean depends on the framework's mandate. So, for example, with the Fed's flexible average inflation targeting framework, guidance to achieve an overshoot in inflation in the future to make up for past shortfalls would be considered Delphic. The make-up strategy is embedded in the framework. In contrast, before the pre-2020 framework, any guidance regarding a future overshoot in inflation would be thought of as Odyssean, entailing a commitment that goes beyond the mandate. Now, unlike the policy rate, which is a simple scalar, forward guidance is a multidimensional tool and can take many specific forms, from open-ended and involving perhaps conveying little information, but entailing high flexibility for the policymaker, to the other extreme of calendar-based guidance, which offers greater certainty about the policy path, but limits the flexibility of the policymaker. And everything in between, including state contingent guidance or guidance that embeds some knockout clause in it. Now, over the years, the Fed has used different forms of guidance, and in the paper we discuss those different examples, along with the pros and cons of the various forms. Now, theory tells us that both forms of forward guidance, Odyssean and Delphic, reduce uncertainty, lowering the risk premium and the term premium. And additionally, with stronger commitments, forward guidance can also lead to lower expectations of the policy rate in the medium and longer term. Even without those commitments, some form of Delphic guidance can also lower interest rate expectations if, for example, the market pricing is sufficiently misaligned with the Fed's reaction function. By lowering rates, forward guidance should lead to higher expectations of inflation and growth, and hence increase spending by households and firms. That's the theory.
Bridgewater dumped
And,
SPY
the evidence suggests that forward
and
guidance
trimmed
indeed
NVIDIA, Meta, and
reduced
Alphabet.
interest rate uncertainty and had significant effects on yields, equities, and broader asset prices. And while it's reassuring that this first stage of the transmission mechanism has worked, direct evidence on the macroeconomic impact on output or inflation is less conclusive, and the effects of forward guidance tend to be imprecisely estimated. There is a very nice paper by Thomas Lovak, recently updated by his co-authors, making precisely this point. And there's other work. Swanson has a paper making the point that forward guidance has been important in pushing up output, but there's some disagreement in the empirical literature. Let me now turn to asset purchases. And sometimes I will use QE for short. We examine large-scale asset purchases financed by central bank reserves. These purchases are asset swaps. They change the asset composition of the buyer and seller's balance sheet. And as such, they're not direct transfers of wealth. And this is in contrast with some popular mischaracterizations of QE as helicopter drop or bank bailouts and so on. Again, unlike the policy rate, asset purchases are multidimensional tools. And they can have very different asset structures, purpose, and design. In terms of assets, the Fed has purchased mostly US Treasuries and mortgage-backed securities, and during the COVID pandemic, it also bought corporate bonds. And within those bonds, there are differences in maturity and risk. In terms of purpose, the purchases can be done for monetary policy purposes to stimulate the economy, or for financial stability purposes, providing liquidity in times of market stress. And in terms of design, they can consist of fixed quantity announcement versus open-ended flows. They can be specified in terms of prices or quantities, and so on. Now, the three main transmission channels identified by the theory are portfolio rebalancing, signaling, and liquidity. These channels can affect treasury yields, exchange rates, bank funding costs, and wider asset prices. And through that, they can lower borrowing costs and also push up collateral or increase, produce wealth effects that eventually lead to more spending and income. And finally, the last step is pushing up on inflation and activity. So in our paper, we describe these transmission channels at length, along with the theory and evidence behind them. Broadly speaking, there is evidence in favor of all three channels, and there's also new evidence for what we can call the backstop channel, the idea that the announcement of asset purchases by the Fed can act as a put, reassuring markets that the Fed will act again in times of market disruption. They may also work through a bank lending channel, which was important in Europe, but less so in the US. One point to observe is that often these channels are studied separately, and there's no unified framework to decompose their different contributions or make them add up to an overall impact. And I will discuss this point again at the end. Turning to the macroeconomic effects of asset purchases, the evidence indicates that large-scale asset purchases were effective as aggregate demand tools, pushing up on activity and inflation. And again, here there's a very nice contribution by Thomas, finding significant effects on activity and prices. One observation, though, made by Fabo and co-authors is that there is wide dispersion in macro estimates across times, across countries, and across different methods. And this variation can be explained by differences in identification strategies, modeling assumptions, and transmission channels emphasized. And to appreciate or to illustrate this dispersion, this, I think, is a very instructive graph taken from Gulati and Smith's meta-analysis. The graph summarizes the range of estimated effects from asset purchases mapped into 10-year yield space. So taken at face value, it says that the cumulative impact of asset purchases on 10-year yields is somewhere between 1.25 and 4 percentage points. And this is a very big range, of course. But notwithstanding the range, I think the evidence is firm in the fact that these asset purchases had an impact on activity and prices. And based on that evidence, our recommendation is to keep these large-scale asset purchases in the monetary policy toolkit. They might be needed in case the economy hits the ELB again, the effective lower bound, or if there is market disruption, which would require to intervene with the financial stability goal. In the case of forward guidance, we think Delphic guidance should be standard practice in central banks' communication, and Odyssean should be left for very extreme circumstances. Of course, how effective these tools are depends on how they're calibrated and deployed. And in the rest of my presentation, I will focus on this point and see what we can learn from the recent experience for future use of these monetary policy tools. So let me turn to that post-2020 experience. So regarding forward guidance, during this period, the Fed used at least 4 different types of guidance. First, the dot plots, which was a continuation of a practice started back in 2012. Second, and to a large extent underpinning those dot plots, the Fed had guidance on interest rates, and third and related, guidance on the asset purchases. Finally, there was also guidance on the sequencing of an eventual liftoff or tightening of monetary policy. Let me go through this, through the interest rate guidance and asset purchase guidance first. The rate guidance introduced in September 2020 and maintained until November 2021 indicated the intention of the FOMC to keep the target range of the federal funds at 0 to 0.25% until the labor market conditions had reached levels consistent with the committee's assessment of maximum employment, and inflation had risen to 2%, and it was on track to moderately exceed 2% for some time. The asset purchase guidance introduced in September 2020 and maintained until June 2021 was to continue to increase holdings of Treasury securities by at least $80 billion per month and of mortgage-backed securities by at least $40 billion per month until substantial further progress had been made towards the committee's maximum employment and price stability goals. So it's clear that the guidance for rate liftoff was much more demanding, or the conditionality was more demanding than for stopping asset purchases. It required 3 conditions: maximum employment, realized inflation at 2%, and expectations that inflation would overshoot moderately the 2% target for some time. For asset purchases, it simply required evidence of progress towards maximum employment and price stability. And finally, the ancillary guidance on sequencing of tightening introduced a timing component in the form of 2 conditions. First, the interest rate liftoff would start after the asset purchase program was concluded, and second, the FOMC intended to provide ample warning or lead time before starting the tapering of asset purchases. So we can see here that the rate and asset purchase guidance were state contingent, but the sequencing guidance had a more rigid component linked to time. So potentially, there could have been tension between the sequencing guidance and the rate guidance if, for example, the 3 conditions for rate liftoff were reached right after the conditions for asset tapering. This would have forced the Fed to give up on the ample warning or to delay liftoff. So that was forward guidance. Turning to large-scale asset purchases, the decisions can be split into two phases, given the motivation. The first phase was about smooth market functioning, and the second added monetary policy stimulus to the motivation. Specifically, in March and April 2020, the FOMC announced asset purchases aimed at supporting smooth market functioning, including on the 15th of March, purchases of at least $500 billion on treasuries and $200 billion on mortgage-backed securities.
Still bought puts
On the
at
23rd of March, the program was expanded to unlimited purchases of treasuries
5,900
and
still
mortgage-backed
massive
securities.
support.
And plus, for the first time, the Fed started buying investment-grade corporate bonds. On the 9th of April, the corporate bond
Some
program was
05
expanded
puts
to
being
include
bought.
also some high-yield debt as well. So going to the second phase, in September 2020, the Fed expanded the justification for purchases of U.S. treasuries and mortgage-backed securities to include not only a market functioning goal, but also fostering accommodative financial conditions. So there were, from September onwards, two goals behind the asset purchases. And in December 2020, the committee added the forward guidance I discussed before, which focused on the monetary policy goals of price stability and maximum employment. So what are our main reflections from this experience? So when it comes to forward guidance, it's clear that there is a trade-off between commitment to a policy course of action aimed at achieving high initial effectiveness versus having the flexibility to come out of the policy path or the QE program. And our reading is that the Fed's choices were tilted towards that commitment and having high effectiveness, putting perhaps less weight on the flexibility to exit. In particular, if we look at the forward guidance criterion for rate liftoff, they set a very high bar to increase interest rates. And one could argue that they were insufficiently robust to unexpected shocks that could create a trade-off between the objectives of maximum employment and price stability. This is why we hindsight, and I should emphasize the word hindsight, we think stress testing forward guidance under different scenarios could be highly beneficial and become routine practice in central banks. I will come back to this later. And just to illustrate what the point I'm making, we can compare the conditions embedded in the 2020 guidance with those in the 2012 guidance. And for this, I'm using this graph that I reproduced from English and SAC. The horizontal axis here shows inflation, and the vertical axis shows unemployment. The shaded area in each plot indicates the no liftoff zone. That is, the policy rate is expected to remain without change in the shaded area. So on the left-hand side, we can see the representation of the 2012 guidance. It contemplated the possibility of a trade-off between inflation at target and maximum employment. Rates would be increased, the liftoff area here in white, if either unemployment fell below 6.5% or projections of inflation 1 to 2 years ahead increase above 2.5%. So the wording here was structured to achieve a balanced trade-off between inflation and employment. And the conditioning was based on projections of inflation rather than actual outcomes. On the right-hand side, we can see the 2020 guidance. The conditions for liftoff, the white area, required both inflation above target and unemployment below the natural rate. So the wording did not contemplate the possibility of a trade-off between these objectives. The second point I'd like to stress here is that the ancillary guidance on sequencing could have clashed with the main guidance on rates and purchases. As I said before, if the time between the fulfillment of the conditions for QE purchases and the conditions for rate lift-off was too short, then giving ample warning for tapering would have delayed lift-off. The third point I want to make here is that the guidance was outcome-based, conditioning on actual realizations of inflation rather than projections. And in general, this outcome-based guidance limits the ability to act preemptively in response to a change in outlook or even changing risks. And finally, the last observation here is that the escape clause, there was an escape clause there, but it was not sufficiently integrated in the main guidance, and it was seen as a separate boilerplate statement. Now, let me turn to asset purchases. Here I'll make two observations. First, purchases were successful at restoring market functioning, and there's a very nice paper by Annette showing this. And the various rounds provided impactful monetary policy stimulus, and this is what the evidence I summarized or mentioned before was telling us. The second point is that there was unclear differentiation or insufficient differentiation between the goals behind the purchases, whether it was done for monetary policy stimulus or for liquidity provision in a disrupted market. And related, although the share of long-dated treasuries purchased did increase after September 2020, the structure of the purchase between treasuries and mortgage-backed securities didn't change after that. We think a clearer separation in design and message could enhance the effectiveness and increase the agility of policymakers to change course if needed. So what are the lessons we draw? Again, I think the evidence indicates that these unconventional tools have been effective as aggregate demand tools. They move yields and asset prices, and they can effectively provide monetary policy stimulus. And in light of that, we take it as a given that both tools should be part of the toolkit. There's no reason to lose an instrument. With that as a premise, the overall lesson we draw is that when designing and deploying these unconventional policies, it's important to consider the balance between policy effectiveness at the time of deployment and the flexibility needed to respond to future shocks. And we think that stress testing policies before deployment using scenario analysis should be very helpful in the design and implementation of both forward guidance and asset purchases. And this projection into different scenarios should make policies more robust to changing outlooks or changing risks. And in this way, the policymaker will have more information to decide when and how to use these policies. Let me now move to more specific lessons for each of the tools. So this stress testing, we think, is important for both. When it comes to
Is it possible to leave this riveting conference behind and get locked in for 15 minutes at expiry?
So first, lesson stress testing. Second, state contingent guidance provides a better balance between flexibility and effectiveness.
I feel like something's going to have to trigger the
policymakers should pay attention to the conditionality and perhaps be willing to give up some effectiveness initially to have gain flexibility for later.
Right now, they don't really have any reason to.
The contingent nature of
Gamma's starting to fall negative at the 5900 strike,
with a, perhaps
which means it'll be easier to slip below.
Escape clause that is part of the main statement.
Particularly
Forward
bullish outcome to
guidance
that.
should avoid being too outcome-based and have given the lags in the transmission of monetary policy, guidance should try to be allow for more preemptive adjustments in the monetary policy stance. And finally, it should be clear that guidance could be revised in extraordinary circumstances.
These are very important statements being made.
All these principles should be there at the deployment stage.
I didn't
And
promise
of course,
it.
all these considerations must be weighed against the need for the language to be accessible.
I said if we lost
and clear.
5,900, which we've yet to do,
Turning to asset
we could drop as
purchases,
low as
the
85.
specific lessons. So again, starting lesson 1 would be to stress test the purchase, considering different scenarios. Lesson 2 is to have a clear distinction between the goals. By not differentiating them, the unwind of purchases made for liquidity purposes becomes too tied to monetary policy and perhaps sending the wrong signal. With differentiation, tapering, ending, or unwinding liquidity purchases would be interpreted as a positive signal.
People
about
confuse
market
losing a
conditions
level with
rather
simply
than,
crossing it.
into, monetary policy, and this will allow for less policy inertia. If purchases are kept as a single integrated tool.
Are you saying that you don't
we think
love
the
this
structure
this
of
meeting
the
about
purchase
Fed
program
policy?
should align with those evolving goals, and perhaps we didn't see this as clearly in this episode. Finally, while sequencing liftoff after ending asset purchases might be desirable for many reasons, we think it shouldn't be a hard constraint, and the Fed should be willing to ignore it if needed. So let me turn to the 3 open questions, or rather the pending agenda for researchers. I'd like to emphasize 3 areas. The first one is that the range of estimated impacts of forward guidance and asset purchases remains wide.
I need to close at 59.04.
We're not in a position to answer some very critical questions, like
bad.
how much have asset purchases lowered the curve, and how much past purchases are still currently lowering it. How persistent are these estimated effects? In finance, we tend to interpret the impact of these announcements on asset prices as permanent, and this makes sense if we think about markets as efficient. But the Fed is intervening here when markets are not operating efficiently, so this standard market efficiency assumption cannot be taken for granted. So having a more precise answer, for example, today would
Kirk, we
allow
don't know how
us
to make sense of when
to
you said you're
answer
holding your
a
calls.
very pressing
How are we
question.
going to
What's the
use
impact
anything
of
we get from
quantitative
this
tightening
conference?
on the yield
I
curve
need to
today?
listen to
How
it.
much of the recent increase in yields
You're
is
my
due to
captive
QT,
audience.
and so on. The second point is that while there are many great empirical and theoretical studies of the different forward guidance or asset purchase interventions, we don't have a sound, unified framework to assess macroeconomic benefits and cost.
There's no point in looking at plug.
There is a nice
It's
paper
like
by Dabarnas
sub
and
$1.
authors going in this direction. We need more of
You're
this.
fucking 2
Having an
relevant
integrated
contracts on the
framework is
chain.
helpful for accountability and transparency, and it will allow policymakers to more clearly
I can
answer,
leave whenever I want,
in
man. I've only
Congress
been
or
here
to the
35
public,
months.
questions such as why were the actions taken,
I know.
where they were,
You got this.
and so on. I mean, and this is important because often the discussion outside of central banks tends to be narrowly focused on the fiscal cost of asset purchases.
I made $16 today. Ask me anything. How?
Central bank's balance sheet losses.
Did you get stopped out of a call?
Macroeconomic benefits. So having the framework will be informative and clarify the rationale behind these policies. And here I also like to stress that when asset purchases are done for monetary policy purposes and the economy is at the effective lower bound, it's very natural to have losses in the balance sheet. That's a sign that the policy was successful and able to get the economy out of the effective lower bound. And so this should not be read as failure, but as success. When the operation is done for financial policy, financial stability purposes, maybe there is more scope for gains, but in general, this should loom very small compared to the broader macroeconomic benefits of these programs. Finally, I think other tools should not be ruled out, and Ken is here about negative rates.
There's still that gap at
The
13.
evidence from European countries and the ECB suggests that negative rates can
From the
provide
meta sell-off.
monetary policy stimulus in recessions, opening additional monetary policy space, and this is particularly helpful when long yields, for example, are already very low and doing more.
Didn't read Pickles
asset
picks.
purchases doesn't provide
Fair.
further stimulus. So to conclude, our recommendations are first, keep
I've never heard them say diamond hands once. What do they know?
demand instruments at the effective lower bound. And away from the lower bound, they might be helpful to provide financial stability, definitely for asset purchases, and above the lower bound as well, Delphic guidance.
No problem, Greedy.
Helpful in communicating the Fed's reaction function. Second, at the design and implementation stage, stress testing the instruments to have
VIX 17 is here.
that is
Where?
robust should be beneficial and will allow the policymaker to balance the different trade-offs. Third,
Wait, you said you didn't
clarify
read it.
objectives,
How is it useful?
Which is important and might give the Fed more flexibility to exit some of the purchases done for financial stability purposes.
Filled the gap.
Fourth, encourage more research. We need further work on narrowing these estimates of...
Greg's been holding me hostage here for 26 months. I feel like Diddy's girlfriend minus the baby oil.
Have more work on creating this integrated framework to assess benefits and costs. And finally, remain open to other tools, including
Not gonna
negative
say.
rates
What?
that could provide this extra space if we were to reach or hit the lower bound again. And I hope these reflections are seen in the spirit of helping to strengthen the toolkit.
You got it, NW.
For the challenges ahead. Thank you.
Oh my God, next month you're gonna get a new logo. Holy shit.
All right.
Did we hit our
thank you very
4-year
much,
anniversary?
for having me to discuss this paper. Just to kind of get started.
Didn't I start the
obviously we
stream
think
in May?
much of monetary policy's impact on household consumption and investment, and hence the broader economy arises from its impact on broader financial conditions. In particular,
April?
kind of the most important, our baseline set of financial conditions are just the level of long-term interest rates.
Jesus
I'm a
Christ.
finance professor, so I obviously think of those as reflecting the expected path of short-term interest rates.
It
and
has
then
been
plus,
84 years.
A term premium. And this term premium essentially reflects
You said they were
forces that
likely to
shift the
pull
supply
back
and
into the
demand
end of the
for long-term
week,
bonds relative to
aka
short-term bonds.
end of
You can
tomorrow.
think of this as sort of
How much are
including
you
the
hoping to
return
pull back?
compensation that investors require for bearing the interest rate risk of holding long-term bonds.
What's the date I renewed
All right,
my
so
driver's
conventional
license?
policy is obviously we're moving around the current short-term policy rate. What are the unconventional policy tools that the Fed has? The first one is obviously forward guidance,
Hashtag
communicating
nautical.
about the future path
No
of
problem,
short-term
Jason.
policy, hoping that is
Still have 3 months to
influencing,
go for me. I
expectations
remembered your
of short-term
perm
interest
stream,
rates
and I went back to
and
watch
perhaps,
that beautiful
reducing
perm.
uncertainty,
Thanks to the 45 months. You got it, Tom Tom.
Second, large-scale
Thank you.
asset purchases. We're buying assets using interest-bearing reserves.
Happy
The hope here is
anniversary,
primarily we're
sweetheart.
Influencing this term premium or other risk premium.
April
but it,
26,
might also
2021
end up,
was the
influencing,
first. Jesus
expectations of
Christ.
future short rates. And here the goal is to provide stimulus to the economy by easing financial conditions. And then finally, the kind of other unconventional monetary
Hashtag
policy
free to
would
leave.
be sort of liquidity facilities. So these would be making short-term collateralized loans, but not kind of traditional discount window lending. And oftentimes, facilities like this are essentially designed using Bagehot's dictum, where we're trying to lend freely against good collateral at a penalty rate. And oftentimes here, the goal is essentially to support orderly functioning of key markets. All right, so I'm going to make 3 points essentially.
At the money
just,
calls are
underscoring
$1,500
building,
for 7 minutes to
on
expiry. What the fuck?
So the first is about forward
Dang,
guidance.
45 months is hard to
Here,
beat.
essentially, I would basically kind of
It is,
echo
it's
and completely
nuts.
agree that.
Wait, what was the
we gotta do a
highest so
better
far?
job of
47?
striking, an optimal balance between.
I think it was NW.
And flexibility, and then in some sense we may kind of have opted for a bit too much commitment. So as Silvana said, very sensible way to think about this, to determine kind of the optimal balance.
I remember
we
the
wanna
first
stress
stream in
test
April. I was like, who's this guy
potential,
with the cookies hat, and why doesn't he read
forward
chat?
guidance in the face of
I didn't
large
read
shocks,
chat back
particularly
then, did
supply
I?
Shocks, that could create trade-offs between the goals of price stability and full employment. All right. So to echo
Me
kind of
too,
three
me too.
concrete,
Jesus Christ.
suggestions from Silvana's paper. The first is what, just a simple way to say it is or as opposed to and. So this is.
I don't think anyone's been a
something that,
billionaire longer than
Bill English
47
and Brian
months.
Stack, I emphasized in a recent paper. This is.
I was
kind
like,
of
Warden
quite a
sure knows
significant
more today than
difference,
he did
between
yesterday.
the, 2012 styled forward guidance, which said we'll lift off from the effective lower bound.
I was
if
mad
either,
sussing
the
on you
unemployment
4
rate
years
appears
ago.
at target
Thanks,
level,
Dork.
Or if inflation starts to rise.
Wait,
above
when did
target.
I paper hand
And
my
2020
subscription?
style forward guidance, which
I don't
said
know.
we'll only lift off if both of those occur. Okay.
Maybe it
and
was just like
this, 2020
the
guidance
switch
kind of
to
lacked this clear
Pigeonwheel.
escape
I know
clause,
you've been here
that
forever,
could be
but you
quite
weren't
important
a member for a long time though, right?
Second, seems
It wasn't
quite
until we
useful to
jerked off to
condition,
academic
forward
papers
guidance
that I finally
on
eased
near-term
up.
forecasts as opposed to realized data.
Remember
this
when you
housing
thought
guidance in
BlackRock
terms of
was going to
near-term
come after us for the golden
It's going
biscuits?
to be a much more robust solution in a world where we think that there are
You were
lags
so
between
high that
policy
night.
implementation and its full impact on the economy. And second, where there also may be external shocks that hit the economy that take some amount of time.
The mark of a great coal is not its seeding capacity, but its sending capacity.
Third,
Here's the 4 years of
the
sending it.
suggestion of essentially
Thanks,
trying
man.
to de-link guidance on the short-term policy rate from
Pickle
guidance
drawings
on,
play a song.
large-scale asset purchases. In the last two cycles, the Fed has essentially
I had a
kind of
break and
signaled,
always recently relapsed.
reluctance, to lift off from the effective lower bound until
Allosaurus.
purchases have been completely tapered, so they've stopped buying assets on net. And also, at the same time, a desire to gradually taper asset
47
purchases
months.
in order to avoid disruptions. So the combination of these means
Thanks,
that if we have a
boring.
goal-ended large-scale asset purchase program.
I've been
that
around
has a
since
high monthly purchase
2021,
volume,
before I
that
moved to
essentially
high
becomes
country.
a
Yeah, I
commitment,
know.
to keep short rates low for the length of time.
Yo,
until
did you change your
overheat,
YouTube account,
in order
maybe?
for you to slowly taper. Not clear, not 100%
So here's my
clear to
luck
me
that
why
when we talk
these
about
two
getting
need to be linked,
disappeared,
why rates can't
high
lift
as
off until
fuck.
purchases cease. Also not completely clear.
I know I'm
why
not favorite,
purchases need
but I'm
to
an original.
so
Thank you for
I'll
everything.
kind
I
of talk about it
appreciate
in a
you.
moment.
Thanks,
One of
man.
the key channels that we think of
Tim
quantitative
Apple's
easing
still a few
operating
months
through
from my
is essentially a
milestones before I
stock
realized the
market
iPhone
amount of
arbitrage.
duration that we're moving from the market. That's really the kind of reason. It's not clear why we need to taper the flow so gradually.
Thank you, guys.
In some, obviously we want to learn
Thanks,
from
Bat
past
Bones.
market events, but maybe some worry that
How long until we find
the
out
kind of very
extremely
strong
well the
preference,
China
for tapering so
negotiations are
gradually,
going?
may reflect some amount
I don't know.
of,
So far, Xi
overrunning
hasn't
from,
commented
the
at all.
2013 taper tantrum. A way of saying this is that we may be somewhat stuck.
Thank you,
what
Wyatt.
my good friend.
Yeah, some of you guys might have
Stein
switched from
out of Center
iPhone
call
to
it gradualism trap.
Google.
So this would be a situation where the central bank has a bit of private information, say about its reaction function. The central bank doesn't like bond market volatility, and as a result,
I
it tries
remember
to
Mike buys
gradually
leaps.
adjust its policies in response to its private information.
Wait, are you Mike buys
Of course,
leaps?
the market understands that the market understands the central bank has gradualist tendencies.
What?
And as a result, even if the central bank is making small policy changes, the market is significantly revising its.
Thanks to the meta news. Heads
So,
up, shorted sag because of
gradualism
it.
does not end up reducing volatility, and the central bank would just be better off if it abandoned gradualism. What are some potential solutions? The first is essentially just clearly communicate.
Was that also Mike sells CCs? I don't know.
Purchases in
Now my
response
mind's
to,
blown.
major surprises and shocks. The second
41
would
months
be,
later, I still
kind of
haven't
promoting
learned
policy
much.
culture that is just slightly less
Typical
concerned with
female,
high
I
frequency
guess.
market
Wink.
reactions,
Thanks, Pickle.
to announcements as opposed to kind of long run.
That's ridiculous.
All right. So second thing I want
Puts
to talk
cost same
about
like
is
shares.
large-scale asset purchases.
Re. Thanks, Dega.
Obviously the Fed has primarily purchased long-term treasuries and mortgage-backed securities since 2008. Typically, the goal has been to stimulate the economy by easing financial conditions.
You guys need higher opinions of yourselves. Jesus fucking
By reducing
Christ.
risk premium, and particularly the term premium component of long-term yields. But as Silvana mentioned, some purchases have
We're gonna
often been
close at the
motivated
most
by a
boring
desire
price
to
ever.
support orderly
59,
functioning of the
12,
Treasury.
46.
By orderly functioning here, I essentially mean liquidity in the Treasury market, different Treasury securities that are similar trading.
Mike
at similar
buys leaps.
prices.
Mike sells CCs.
Obviously,
Billy
during the-
Mike.
during the COVID-19,
Which of your mics
period,
was most
the
successful?
Fed began QE4,
Are we here
essentially was an
flexing?
open-ended
Sounds like the
program.
Discord needs more foot
Eventually
pics.
purchased, over $3
Thank you,
trillion
slot
of US
machine.
Treasuries and $1.3 trillion of MBS. Started out based on this, rationale of supporting smooth market functioning during March of 2020 when the Fed was
Thanks.
buying
Jesus,
treasuries
four
at a very,
fucking
very
years.
rapid clip.
I didn't even
But then,
remember the
September of
anniversary.
2020,
My blown up port is
changed
worth the
into
price of
one
admission.
Trying to provide more accommodative conditions to financial markets, kind of the traditional rationale for large-scale asset purchases. All right, so what I want to
What
talk
happened
about
to
is sort of what do
Frag?
we know
I don't
and what do
know.
we not know about
I wish I
large-scale
knew.
asset purchases.
I think Frag might have died, but I'm not
laying
sure.
out what we do know, but probably more importantly, she summarized really well what we don't know about large-scale asset purchases. And this is kind of, the metaphor that I often use when teaching students about
Mixel CC's
monetary
turned my account to
transmission.
7 figures.
I
Nice.
think of kind of monetary transmission as being like a doctor who's treating a patient that has an illness, but the illness is continuously evolving in real time.
Thank you.
Even
Yeah.
if we could
Gamma
figure out
Strike brought to
precisely
you by
how different types of
Pepto-Bismol.
treatments work, how different tools are transmitted into the economy, the sickness would morph in unexpected ways. So, the nature of monetary
Soon I'm switching to
transmission,
Mike Buys
is
Vu.
ever evolving. That's really fun as a researcher.
Are you gonna
but it's
re-pigeon Will?
Much more difficult when you're a policymaker. So, that we need to ultimately approach unconventional policy with the same humility as conventional policy. All right, so what do we know? The first thing I think we know is that large-scale asset purchases do in fact produce long-term
59,
yields.
16, 92
We know that
close.
they seem to work through.
All right, I don't want to listen to this
several
asshole anymore. Although this was the most interesting one. $30 months and still not contributing positively to the conversation. Back after a long time, here to ask again if you started selling your net mix. I'm hoping to get that before GTA 6. I haven't, but I might consider it. To think 2 months shy of 4 years ago, I was just trying to find Warden. Congrats, Pickle Man. Thanks, dude. Willie, don't you dare. All right, so closing out the day, a little bit to the upside of the JPM collar, finally breaking through that, but found some pretty hard resistance of that negative gamma at 59.25, or negative delta from last night. That's a little bit further out on the chain, out past the OPEX expiration, so may continue to act as a bit of resistance into the end of the week. Nothing really bullish today. I mean, we just bounced from the overnight sell-off on the slightly lower PPI. But I don't think a lot of the other data was really indicative of anything. Despite all of that data being dumped today, it really didn't amount to much. 59, 41, 50. So next upside test on ES, 59.52. We did close above the 59.27.50 level, which would fail to break earlier in the week twice. That might leave things a bit supportive into tomorrow, especially if that level manages to hold in the overnight session. If it fails, I would say we probably pull back to like 5,900 and maybe find support there. Dollar declining a little bit today, not as much as you would have expected with the miss in PPI, but yields coming back down after they rose into the PPI print yesterday into the overnight session. Yields didn't come down much though. 10-year still right around 4.49, so still pretty close to 4.5. The 20-year sliding just down to 4.93. Still pretty close to 5%. We do have some more data tomorrow for this week, so we're not past all of the important data yet. We have, I believe, building permits and housing starts tomorrow. And then we have import-export prices. And I don't know if you guys paid attention to Pickles Picks this week, but import-export prices are probably going to be the most important data set of this entire week. More so than PPI and CPI, because they're going to give us a forward projection of what the inflationary pressures are going to be looking like on imports moving forward. And these are going to be this more current data. This is post implementation of tariffs. And then we're also going to have Michigan consumer, which is probably not going to be great. I mean, I don't know, but I know inflation expectations are expected to rise. Maybe if that beats, comes in a little bit better than expected. I'm not really sure it will, but this is the preliminary print, so it's probably the most important one. Been loving it here. Love you, Papa Guac. Thank you, guys. What's the SPX close? 59.1692. Anyway, correlation fell in the back half of the day after rising a little bit this morning and pushed a little lower day over day, both on the 1 month and the 3. So we are getting some longer term dispersion and starting to catch up. Carry trade leverage continued to fall, down from 8.8 to 8.6. Forward yield on volatility down to negative 8.34. But we're starting to see the 10-2 pick up a bit, the forward curve on the 10-2 pick up a bit. That might start to lift vol, but not yet. Bond volatility stayed around 100, despite the continuing drop in 3-month correlation. Bond volatility probably picking up a little bit with today's price action. So out of the money put interest yesterday at close probably helped drive some of our downside today, although I feel like that probably hasn't persisted. We'll have to see if we still see evidence of out of the money profit taking on tonight's options data. Correlation between VIX, cash VIX still rising, now at 98.67%. VIX no longer in backwardation, but still is out on the 3-month. So cash VIX now back in contango, and forward volatility higher than spot. Breadth still not doing great. Yesterday probably picked up a little bit today, but not much. Actually, tech underperformed pretty hard, especially into the end of the day. So even though we got the boost in Dow and Russell, NQ only rose like 13 points. Fed fund futures still pricing at about 15 points of rate cuts by September, slightly up after the PPI print, but not much. Bulls, bear steepener, not really doing anything, kind of just flat. Looks like tech kind of underperformed most of the day, but and some of the larger components of retail, but the rest of retail did pretty well. Utilities, finance, health tech, and durables up. So this might be the start of like a little bit of a shift towards defensives out of tech, because tech's probably a bit overweight right now. And some of this positioning might be indicative that we might get like a little pullback before tech moves higher. So something to keep an eye on. Definitely a little weird that we see like communications and utilities doing so well. Also like consumer services. Like these are generally things that like you see these flows pick up when larger cap things are selling off, and so the sell-off in tech may continue a little bit longer. That doesn't mean people aren't just going to reposition and be bullish on something else, or that the market's going to pull back substantially, but it might mean that tech just kind of flattens out as people allocate elsewhere, and that might continue through tomorrow into Monday. Out here on the technical side of things, we closed like right above the trend here. So I mean it's broken. Obviously, we could still reject off of this, but we're probably still not concerned with any downside levels besides like 58.37 and 57.73 back at the beginning of the week gap. So far, still no weakness into the back half of the week. Even with SLD ongoing, we haven't seen any really dramatic sell-offs yet. Nothing that would put anything at risk. And so the positive delta and gamma still very supportive of the bulls here. I know over the next 2 days we have a lot of gamma and delta falling off, which I can show you guys. This is so fucking cool. So as you can see, like a lot of the delta and gamma on the chain, especially gamma falling off by Monday. A lot of delta falling off by Monday as well. And this is the SPXW. On SPX, got let's see, 1.23 trillion in delta falling off with the AM expiry in June, and 332 billion falling off tomorrow. We have 6.47 billion in gamma falling off tomorrow. So most of the delta interest on SPX next month, but decent drop off in delta tomorrow. So still everything very front weighted on the chain. I think we have like 19 billion and 59 billion. So like 70. This is today. So 19 billion falling off today, 60 billion more falling off tomorrow, and then like another 6 billion in gamma falling off the SPXW chain by Monday. So that should open up price movement and give us a break from all this consolidation. Once that gamma falls up, price action will loosen up a bit. Anyway, thought I'd show you guys that. We have a roundtable tonight, 9:30, as always. Or maybe 9:30. And I'll see you guys there. Thank you all so much for tuning in. Have a great rest of your day. Later.